make them fizzle out? And what are the pieces that you need to watch out for? First, let's get in my colleague Mahima to do this setup for us. Mahima, what's to be watched out for? What's on the list of names that the street is watching out for?
Right. So, a couple of summer stocks in the consumption space, I'll go category wise. First one being beverages. A couple of counters that can benefit from this include Varun Beverages, which is one of the largest franchisee for PepsiCo. In terms of United Breweries, both in terms of non-alcoholic as well as, alcoholic beverages, beer, United Beverages has the biggest market share. And third one is Tata Consumer. Tata Consumer, sells water in under the brand name of Himalayan Water, as well as Starbucks might augur growth in summer. In terms of juices, two brands, there is Real and Active, which is Dabur owned. Dabur 15% revenue comes from juices, and around 53% market share of juices is garnered by Dabur. So Dabur can benefit there. And ITC, Be Natural is the brand under which it operates, and 5% market share is garnered by ITC when it comes to juices. The next counter is bottling and packaging companies. AMD Industries is into manufacturing of articles that are being used for soft drink beverages, which are used by murky brands in India. Hindustan Foods is diversified into making packaging of various brands, and Orient Beverages also makes bottles for Bisleri. So these three companies will also be in focus. In terms of ice cream, Vadilal Industries as well as Hatsun Agro will be in focus. Vadilal Industries garners around 16% of the total organized ice cream market share, and Hatsun Agro is big when it comes to southern markets. In terms of AC and cooling systems, there are counters like Voltas, Blue Star, Symphony, Lloyds, Whirlpool, Johnson Hitachi, Orient Electric, etc., which will be in focus on the back of their AC, refrigerator as well as cooler sales, as well as fan sales. And lastly, in terms of heat powder, that is your prickly heat powder, Imami will be in focus. Dermicool, Navratna Talc, around 40% of market share, and Nycil from Zydus Wellness is one of the products that will be high selling, which is around 34% of the market share. So all of these categories, products and brands, and of course companies could be in focus on the back of summer sales.
Well, the meltdown is in the markets right now, and I don't think any cooling talcum powder is going to help with that, but that's a different story. Meanwhile, what is the blistering summer opportunity for companies? Let's take a view on that. B. Thiagarajan, Managing Director of Blue Star, with us this morning. I'm also speaking with K. Ramakrishnan, MD of Kantar World Panel. So an early summer has begun. I mean, there's a heat wave where we're sitting in Mumbai right now, and we're not quite yet done with February. So let me start with you, Mr. Thiagarajan. You have projected a scorching Q4 with a 300% growth, I believe. Does that seem to be on track, and has summer come in early for you?
Good morning. It's a pleasure interacting with you. I do not know where 300% comes. Let us wind back to last summer. Last summer season, the growth was more than 57% for us in room air conditioners, followed by the festival season, which we thought won't be that great, again over 30%. And I am maintaining that Q4 could be another 30 to 35% growth. My estimate for summer projection on a huge base of last year could be anywhere between 20 to 25% growth over the last year's summer season. The category is doing well. This is the only category which continues to grow, and at this moment, the symptoms are that the summer season will be good again. But I won't bet on again another 50 to 60% kind of growth. It is very unlikely.
Okay, so 25 to 30% growth, which is not half bad. I'm just wondering, and just one follow-up for you, Mr. Thiagarajan, are you seeing the trend of premiumization sort of flagging? We're also right now, one big question in the economy, and all of us who discuss this, is what is happening with consumption patterns. Can you give us any kind of a sense there? Rural versus urban, move to premiumization or higher cost models versus lower cost models, anything that you are gauging and can share with us?
We have been closely watching this for the simple reason many other categories in consumer durables itself and FMCG have been facing slowdown. Therefore, in order to plan the inventory, in order to plan the marketing programs, we have been closely watching what is going on. The first point is that more than 65% of the sales is from tier 3, 4, 5 towns. And that demand continues to be good, followed, it may be due to the good monsoon and agricultural output. The second part is connected with the consumer finance schemes. In our case, as of now, cumulative for this year, more than 37% of the sales happened through consumer finance or credit cards, so on and so forth. And the next factor is first-time purchases. If you take a limited review of that, it is more than 93%. If you take broadly, what is driving the growth? It is aspirational middle class. If you look at all these factors, the entry-level products dominate the portfolio. Having said that, heavy-duty or Wi-Fi enabled products or hot and cold, these kind of products have been steadily moving up. It will constitute all put together around 10% of the sales. Otherwise, you have to reckon the fact that in India, it will be that affordable or affordable premium will dominate the portfolio.
Okay. Well, Mr. K. Ramakrishnan, MD of Kantar World Panel, also with us. And Ramakrishnan, just tell us, what do you feel about this whole aspect of demand that a summer can bring for various products? So, for example, the base effect in the case of air conditioner and air cooling products is going to be very high because 2024 was a very decent year as well. So that also comes into account, right?
Yeah, so I can talk from an FMCG lens.
Sure.
If you look at from an FMCG lens, the base effect that you talk about is pretty much there. In the sense that if you look at all the categories that your colleague spoke about a couple of minutes back on the categories that have a summer push to themselves, it was she spoke about beverages, she spoke about talcum powder, she spoke about juices and stuff like that. All of them saw a bumper year last year. I mean, if you look at just soft drinks, bottled soft drinks, there was a 26% growth from a household consumption lens. And similarly for bottled juices, the number was close to 16%. So all of them have seen bumper growths in the last year. What was different about 24 in comparison to 23 or 22 was only because of the fact that it was a highly intense summer. And if all projections are right and whatever we get to hear from IMD, etc., the summer is only going to be further intensified in this year. So therefore, I believe the wave is likely to continue. Perhaps not another 26 and 16, but in the regions of 20 and stuff like that. So I think we are set up for a pretty strong growth. May not be at the same level as last year, but certainly a strong growth in all the summer-related products in the FMCG space.
Got it. Yeah. I'm sorry. I mean, I was just using this AC as an example for when it comes to cooling products. I will ask Mr. Tyagarajan about his view. But just a follow-up here, Ramakrishna, and that is on just the nature of growth that could come in for the pan-India business, because it does seem that when we look at volume growth in isolation for the pan-India companies, it might be deceptive simply because a lot of regional players have become very strong brands. Some of them are not listed. New commerce is aiding that growth, and therefore, if the volume growth numbers for a pan-India set of players who are listed is seen, it may not be the true depiction of the consumption in the country, because that is also being now dominated by the regional players.
Sure. I mean, see, even that is consumption. Whether it's regional players or national players, it's still consumption.
Agreed.
Consumption
no,
lens.
But what I mean is, sorry, when I see the volume growth number for an HUL or an ITC or what have you, it may not be a correct depiction if the number is low, because the consumption may be happening at other companies which are not listed and therefore not reporting.
Yeah. So which is exactly the place where we come in. Like I said, I'm talking from a household consumption lens. and it's not reflective of brands, it's not reflective of companies. The way we collect data is what enters into a household every month in terms of their purchases of FMCG, whether it's branded, unbranded, local, regional, that doesn't matter. And we're agnostic to even channels. So from that lens, we've seen a strong growth. So therefore, whether it's regional or national, it doesn't really matter. We certainly believe there was a strong growth last year, and that growth is likely to continue.
Mr. Tyagarajan, now, pray come in here. The belief is, sir, that the tax breaks that have come in the budget for the urban consumer, plus the pay commission hikes that will come in next year and so on and so forth, would mean that durable spending will go up. The flip side to that is, as I was asking Ramakrishnan as well, that the base effect for air cooling products is very high. 2024 was, if I'm not wrong, a remarkably good year too. Does that impede growth, or do you reckon you'll have a strong summer?
It's a pleasure interacting with you.
Likewise,
See,
sir.
the summer growth was more than 57%. Post-summer, I thought that the festival season is going to be not that great. But we were surprised it was more than 30% again. Then I thought the Christmas, New Year season will be lower. It is not. The growth above 30% continues in this category. The reasons are as follows. The reasons are the air conditioning category, the penetration itself is around 8% or so. The second is the urban heat effect. It is impacting the people, and they are getting used to the air conditioning environment everywhere. And when you get back home, there is not even cross ventilation. The heat and the humidity is going to make them feel uncomfortable. Now, everything comes from the disposable income. Now, the consumer finance is one indication that even though they cannot afford immediately, they are going and buying there. The next point is connected with you are not having huge burden on electricity bills thanks to the energy labeling program. It has come down. Thanks to the PLI scheme, the manufacturing capacity in the country has doubled, and the prices are stable because due to competition. The prices have not gone up even to the extent of inflation. Therefore, and the important point, we have discussed this in the past, the mobile phone craze has gone. Whenever a mobile phone was launched, people used to rush there. The smartphones sales, I understand, is almost flat. So people are ending up investing money in air conditioners, and this industry has arrived at last. From 8 to the visibility to move up to 16 or 20 is very much likely in the next 5-year period. And even then, we will be a minuscule market compared with many other countries, specifically China. And our by all calculations for energy labeling or refrigerant migration or production capacity, the figure that you have to look at is 19% CAGR till 2030 is given. 1 year it may be 5%, another year it may be 40%. And this particular summer season, looking at all the factors, I think 20 to 25% growth over last year is possible. Again, I will remind you, the 2024 summer growth was over 2023 summer, which was a washout summer for the air conditioner industry or cooling devices industry. So therefore, I think, there are debates that it will be again 50%. I think it is very difficult. One should look at 20 to 25% growth. Blue Star would like to gain market share, so we will be attempting 25 to 30%.
No,
When you plan the supply chain like that, you have a headroom for doing 10% more if indeed the demand is going
Just very quick question, Mr. Tyagarajan, because we're all trying to figure this out, right? With what's happening on the side of US tariffs and the global impact, just trying to understand if there's any supply chain impact or hit probability for you?
I don't think for this industry you should look at Trump 2.0. Post-COVID, we introduced non-tariff measures against China, right? We have been ahead of US in this. and a PLI scheme came in, and under the FTA, we banned import of air conditioners which are charged with refrigerant. We introduced BAS licenses and non-tariff measures. So from that on, you do have multiple issues. One is availability of components. 2, the price of the component itself. 3, you are localizing, and it is going to take time to achieve Chinese cost benchmarks and the quality standards. And this fortunately, we went through this over the past 2 years, and so we have some experience. There are a few components that are left out. The compressors, for example, which you are reading in the media, the supply chain is tight there. The extensions are being given, approvals are taking place, domestic manufacturing capacity is just developing, and this is a transition phase. To me, the US tariff is a different dimension altogether, and that's not impacting this industry. This industry went through this pain, rightly so, if you want to become self-reliant or if you are going to be the largest market in the world in about 20-year period.
All right, thank you so much, Mr. Tyagarajan. Thank you so much for speaking with us, to both of our guests, and joining us on the show today as we get a sense of whether there is some relief for summer. I mean, it's something to look forward to, but frankly, right now, all focus and pain on what's happening in the markets right now. So we'll take a very short break at this point. Mr. Ramakrishnan, thank you so much for joining us as well. On the other side, we come back with what the biggest losers are, what your strategy should be, and a great conversation with HSBC. All of that when we return.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको
Welcome back. You're watching India Market Open, and this is a tough day. This is a day where you brace for impact and then you take a call. on whether you're going to use this as an opportunity, you're going to wait and see what to do next, and we are here hopefully to guide you through what we're seeing today. But just giving you a picture, Nifty has pretty much wiped out all gains for the last financial year. Right now, also 1.5% down, but that's not how you should see it. We should actually pull up the Nifty over the last 12 months and look at what's happening there. We've hit a nearly 9-month low on the Nifty. Nifty IT has hit a 7-month low. Nifty 50, you should pull up the Nifty for 6 months as well, because you pretty much wiped out all gains. Over 12 months, you're now about 1.5% up. Over 6 months, you've lost about 11.5% on the Nifty. Nifty IT, pull up Nifty IT for the last 6 months as well. And you see the pain. Right now, we've fallen to a 7-month low. The Nifty 50 has slipped into negative territory for the financial year 24-25. And the decline, of course, has been 8 consecutive sessions. Just in Feb, there have been only 2 gains in the month of February. This is how painful the situation is. I mean, I don't know if you can pull up the sectoral heat map. There's several. You're seeing Patanjali right now hit lower circuit on first day of F&O inclusion, but that's not the only one. I'm sure you've got a lot of pain point. Only the VIX in the green right now, and Nifty IT by far the biggest pain point. But look at auto, look at media, digital, everything. Advanced decline ratio, if you can see, will just give you a sense of how painful it is. I don't see too many escaping. Maybe relatively BFSI if you want to say that, but here you see the advanced decline ratio, not a pretty picture, just 6 stocks on the Nifty, even in the green. And maybe we can pull up that heat map and show you what those stocks are. I reckon Coal India will be one of them, but overall a very, very painful picture. Reliance contributing to some 6 points to the Nifty right now, but the rest seeming very painful. Coal India, Reliance, Axis, Shriram Finance, in the green. So a bit of BFSI there giving relief. Now, that's one of the sectors we're talking about next. Investec has a positive view, in fact, on Max Finance and HDFC Life. Harsh joins us to tell us more on the note.
Well, so, you're looking at the entire life insurance pack, which Investec seems to be very constructive about. The primary reason why they seem constructive is that while fundamentals look better to them overall, they are believing that the D-rating is owing multiple reasons, and some of those reasons are firmly behind. Let's talk about some fundamentals. One, they believe life insurers have compounded at a healthy rate over the last 5 years. In terms of product proposition as well, there is plenty of value in terms of product proposition that life insurers bring. They also are suggesting that persistency, complaint metrics have all improved over the last couple of years and therefore only looking better now. They are saying that the IRRs for some of the life insurers are 15% plus, and therefore they operate also at very healthy IRRs. Now, given all of the negative news that's come through over the last 8 months, especially on the regulatory front, they believe that the D-rating has been sharp. One, ICICI Pru, what they've done is they've upgraded from a hold to a buy, 725 being the target price, and therefore a very healthy upside from here that they are seeing on ICICI Pru. HDFC Life is where the upside really stands out at nearly 40% upside from here, 850 being the target price, and Max Financial at 1500. They've maintained their buy on both HDFC Life as well as Max Financial, 46% upside from here on Max Financial. Of course, some of the stocks not doing too well today in trade, but nonetheless, the note looking extremely positive on some of these names.
Well, thanks a lot for that. And viewers, all of these should be kept in mind. At some point of time, the markets will reverse. This is not an unending saga. At some point of time, it will. I don't think anybody's in a position to be able to say whether it reverses sometime next week or week after next. Tahir Badshah believed maybe a couple of months as well. So all of that, true. But this is the time, I mean, where there is a fair degree of pricing in your favor. Everybody's waiting for a correction. You've gotten one. Time to make use of it, I reckon. And the government and the regulator are doing their best to help, if you will, the economy. I mean, an exclusive that sources tell your channel is that RBI is all set to conduct a $10 billion buy-sell swap auction today. My colleague Vishwanath Iyer joins in with these exclusive details. And Vishy, yet more in the series of moves that the central bank has done.
Right. So this $10 billion buy-sell auction is expected to infuse about 87,000 crore worth of rupee liquidity into the system. And that's why this is sort of an important move that's coming from the regulator. What is happening today essentially is an auction where the RBI will finalize the banks with which it will trade as part of this buy-sell auction. Essentially, $10 billion worth of dollar liquidity will be taken from the banks, and they will be given this rupee liquidity of about 87,000 crore. And this rupee liquidity is on loan for about 3 years. At the end of the 3-year period, these banks are supposed to give back these rupees back to the RBI and take back the dollars from them. There are a few things that happen here. Essentially, what the banks can do is go out and borrow cheaper dollar liquidity and offer it at a higher rate to the RBI. And the difference of that will be something that the banks can pocket as sort of fee income for essentially facilitating this transaction. It brings in more durable liquidity into the ecosystem because essentially 3 years worth of rupee liquidity is coming to the banks at 87,000 crore. So that will help the liquidity deficit to some extent. What traders are telling us is that rupee might come under a little bit of pressure when the transaction actually takes place on the 4th of March, which is Tuesday. Today, remember, is only the auction, which is the first step of this entire process. So once that happens, rupee may fall to about 87.50. It's not that sharp depreciation on the rupee front, primarily because a lot of this expected weakness hasn't priced into the rupee spot market, dollar rupee spot market, and that's why you won't see that deep an impact on the currency. Some amount of weakness, unless, of course, there is a sudden demand for dollars over and above what the RBI needs, and then there might be some interventions that might be necessary. But let's keep that aside for a minute. 3 years worth of liquidity, what does that do for the system? Essentially, it gives banks more funds available to go out and lend to borrowers who might need that money. Currently, because of a liquidity deficit, you're seeing credit growth drop quite a bit. You've also seen deposit growth not pick up as much. So banks are starved for liquidity. So this infusion is going to help them significantly. But $10 billion for 3 years, that's a very, very sharp move from the RBI, and that's why this transaction is very important.
Okay, Vishy, thanks a lot for that. Now, there is pain on the street, and therefore it's just the most opportune time to get in somebody who looks at India and the rest of the Asia-Pacific region from his perch. Harold van der Linde, Head of Equity Strategy Asia Pacific at HSBC, joins us right now on the show. Harold, great having you, and it's just an opportune day to get you because we've wiped out nearly 4,000 points on the Nifty. Now, I remember you used to be constructive earlier, sometime around 2 or 3 months ago, if I'm not wrong. You turned a bit cautious on India as well. I would love to know, in the current Asia Pacific thoughts that you have, post the corrective moves that we've seen in a clutch of Asia Pacific markets, excluding China, what is the current hypothesis that you have?
Good. So you're right. We actually started to become a little bit more worried about India in August last year, but we didn't anticipate the sort of slowdown that we've seen in India. So here we are, February. What do we do with this from here on? Because we've declined, some of the worries that we had in the past, such as valuations, there may be still a little bit there, but not as much anymore, because valuations have come back to some sort of, you could say maybe an historical average, although against China, that is, on an absolute basis, it's still a little bit expensive. Another worry we have is that the earnings are slowing, but that has materialized to a large extent as well. Is there further downgrade risk to earnings? I suspect there is, to a certain extent. But maybe not as much anymore. I think the risk comes from 2 or 3 fronts. The first risk is simply that locals have continued to remain fairly resilient buyers. We've seen a lot of supply in the market as well. That probably is going to dry up automatically. But if local support would dwindle and people get nervous, and remember, a large part of the people that have invested in Indian equities have never seen a downturn. So that could be something that we need to keep a close eye on. A second thing that we need to keep a close eye on is simply what happens with earnings in India. The general consensus that there's a reset. We've had some really fantastic growth numbers in India for 25% or so over the last 3 years. The feeling is that there will be reset to maybe something close to 15, but what if it is much lower? And we can go deeper into this, but I think there's risk that maybe margins come under pressure. And the third risk is simply China, because China is doing well, it has rallied, but it's not overly expensive. People are still underinvested to a certain extent in China. Things are improving there, and that could, of course, suck more money into India. So yeah, the risks remain, but we have to also be realistic that a lot of the downside is probably paid out as well.
Harold, good morning. Tamanna here. In terms of the doubts playing out, in your view, what is the primary concern that we're seeing reflecting in the kind of foreign investor flows from the Indian perspective? It's been a one-way street, and all of it for the exit door. Do you see any factors changing that soon, since a lot of global liquidity is heading in the direction of the United States right now?
That is right. So money is moving in the direction of the United States, but that is changing as well. So if we see that money is moving out of the US and bond yields come off, then money would go back into emerging markets. That could be a first positive for markets such as India. I mean, it would be positive for other markets as well. If I talk to foreign investors, the key concerns that come up are twofold. One is, what if there's something really bad with Indian earnings? Maybe it's worse than we think it is. That is just normal that comes up. If earnings are being downgraded, people just don't know where the bottom is. But the comparison we, for example, make is with Indonesia. Indonesia invested a lot, like India has done over the last couple of years, infrastructure, roads and railroads and ports and these sort of things. And that has led to increased competition domestically and a decline in margin in certain sectors. So is that something that will play out in India as well? That's uncertain for now. But I think it's fair to say that most of the earnings downgrades we've seen. The other concern that foreign investors have is, what are the locals are doing? Because if they don't really want to buy this market anymore, there could be that there's further downside here. So the foreigners are looking at the locals are looking at the foreigners. We still are not clear where the earnings are ending up. And as you say, rightly say, some money has flown back into the US over the last couple of months or so. But I think that might be changing, actually.
Let me just stick on to that, on why you think it might be changing. And a very interesting point you made about foreign investors looking at what Indian investors are doing. So if I look at DII flows and what is happening with our mutual fund industry, and that's really the big change over here in the last 4 or 5 years, that seems relatively rock steady, isn't it?
It seems rock steady, but these things can change, right? So let me answer the first question first that you had on the US. What we've seen in the US is that bond yields actually haven't moved anywhere. And bond yields are the indicator of flow, if money flows in or out. So despite the fact that initially there was a lot of optimism, we've seen now the US market has come off. Bond yields are starting to trend down. People are talking about maybe, hey, with all the uncertainty in the US, maybe rate cuts are starting to come through. So that's something just to keep in mind. So it might well be that we see money starting to flow out of the US. But for that, really, we need to see those bond yields come down. Now, to come back on your second issue, what are foreigners looking at with locals? We know, for example, that mutual funds in India are now sitting on very high cash levels. So they are increasing their cash positions. And there's a couple of $1 billion coming from these systematic investment plans and these SIPs coming in every month. But in January, if I'm not mistaken, we saw for the first time a number of cancellations exceeding subscriptions to this particular program. So it might well be that domestic sentiment is shifting. And I think foreigners are keeping a very close eye onto this.
Harold, okay, one thing is that the domestic investors have been resilient. If they continue to be resilient, let's say hypothetically, right, because it's a difficult one to fathom, if they continue to be resilient, right, then does the return of the foreign investor depend on valuations going lower, which will be a factor of them continuing to selling Indian markets, or will it be Indian markets having reached the long-term averages? Let's go out and buy, because I remember note after note in 2024 spoke about how the long-term thesis remains intact. This is more a short-term blip which will get corrected.
That's right. So if people were eager to win in the market at, say, 21 times earnings, they would be eager to buy the market at 18 times earnings, right? So, so It's not the absolute level of valuations, but what we need to see is that the valuations have come down. That has happened. And then the other kind of ingredients for the Indian market need to also move in the right direction. So that is, for example, lower US bond yields. And maybe if, for example, the Chinese market loses a bit of steam, then suddenly it is, okay, the China rally is over. So, hey, India looks cheap again. Maybe we should rotate back into that again. And again, the earnings, the worries that people have on earnings that there would be further downgrades, that always happens when earnings are being downgraded. We just don't know where the bottom is. But if the long-term story remains intact, at some point in time, that will stop as well. So we got to look at these particular indicators, earnings downgrades, China, US bond yields, and if they move in the right directions, and the valuations are a little bit lower than they were at the peak, which of course they will be, then I think those flows can come back. And if it's 18 or 19 times earnings, people say, well, okay, I did buy it at 20 times, so I'm happy to buy it at those valuations as well.
Harold, I'm presuming right now, when you are advising your clients, you are saying that, okay, China is doing well right now, they have a revival, let's stick to China. India is maybe at good valuations, but something needs to give, either in terms of more correction or China giving way. I'm presuming that's the thesis right now.
That is indeed the thesis that we have in the moment.
Okay.
China is doing good, and there's things moving in the right direction, China.
Got it.
For a long time.
Got it. I have one more follow-up here. After let's say, in the last month and a half, Harold, we've seen the Indian regulators or the people in power, right? The finance minister, the central bank, all of them putting their weight behind trying to spur consumption, ease liquidity constraints that might be there. So the moves that have been taken have been pro, I'm not saying they've been done for the equity markets, but they are pro equities. Does that stand out for a global strategist like you as a key factor?
Yeah, I must say that is positive. I mean, yes, so they try to support consumption, although the problem with consumption in India is that urban consumption is weakening, and the rural consumption, it seems, takes time to really catch up. It might do so, but that will take a little bit of time, so there remains a bit of uncertainty there. The central bank clearly has been talking about, okay, liquidity needs to be good into the system. So the noises that the policymakers are making are good. Also, I think the sort of fiscal discipline that India has put in place allows a central bank to cut interest rates. If there would be much more fiscal stimulus, then it would be more difficult for a central bank to do so in fear of overstimulating. So I think actually what the local policymakers are doing is probably okay. It's just that the equity market is not only driven by what they do, but also by global factors. And yeah, there's nothing India can do about that. You need to wait for those factors to move in the right direction as well. But domestically, yeah, they're trying to support some of that consumption. They're trying to put liquidity into the system. True. And I think it's possible.
Okay. Now, Harold, just one more slightly inward-looking question. I know you've established that a lot of factors go behind this. I'm saying let's assume China doesn't quite slow down for their markets. I wish them best. But Indian growth, which had suffered in Q2, and we have the GDP print today for Q3, let's assume that is slightly better. And towards the end of March, we hear some fairly positive commentary from corporates, etc., about Q4 growth. So my point is, if Indian growth revives meaningfully because of all the factors done and a natural cyclical upswing after the first couple of quarters which were weak, is that a sharp antidote, or is that not a sufficient condition for the markets to revive and we need global factors to change as well?
No, I'm a believer that China and India can move at the same time.
Okay.
Because the stories in these two places are quite different. So if China continues to do well, and India does also well for all the reasons that you just mentioned, I think, one, we're going to see money rotating within the region. It probably is not very good news for Taiwan or Korea or something like that, because we're going to assume that all these markets are doing fantastic, or ASEAN. And secondly, it would probably mean that people would want to move money into these markets from outside the region as well. So EM funds could come in, global funds could come in as well, as money is being reallocated. So I'm a believer that these two markets can move at the same time in the same direction, in a positive direction, I mean. So if these growth worries are going away and Indian growth looks okay again and the valuations look good, I wouldn't be surprised if people say, hey, there's something really interesting going on in India and the valuations look good. We need to be there while we don't want to sell China. So yeah, maybe we should reduce our exposure into Europe or the US or something like that.
Harold, you know, we've been talking so much about the atmospherics. I must come to you on this very interesting report from your end on top 5 picks in a slowdown from the Indian perspective. So let's come to some of those specifics and go through some of those names. Maruti, PB Fintech, Dixon, among those. Can you talk a little about why you have picked these particular companies in the context of the fears of a slowdown?
Yeah, typically, I think if you are in a sort of downturn in a market, you want to be in companies that have particular sort of dynamics going for them. Either they're gaining market share or they're in a segment in the economy that continues to grow. I mean, if the economy slows, it's not that the whole economy slows, there's always a pocket that does well. But most importantly, you're looking at companies that have a brand or something like that. Because if you've got a strong brand, even though demand is slowing, probably you're not going to slow as much. And of course, you're looking at stuff like valuations and these sort of things. But it's branding, it's resilience of the business that you're really looking at. And you match that with the valuation in the markets to come to key ideas in a downturn. And that's exactly what we've done in this particular report.
Well noted. Harold, thank you so much. This was so informative in more ways than one. Much appreciate you taking the time out and speaking to us today.
Thanks for having me on.
That's Harold van der Linden. And for all of you who maybe missed some part of the conversation, he's saying that something needs to give. Maybe a China underperformance, but to a question of if Indian growth were to come back, even if China were to do well, would money return? To which his answer was yes. But it's not just growth which will determine it.
So my big takeaway, though he didn't say it in as many words, was in the context of all money moving towards America right now, and that could be changing. So once bond yields come off, don't look as attractive, maybe this thought that America is going to boom under the current policies, if that fades, then emerging markets come back on pace, is at least what I thought was interesting. And of course, they're top 5 in the India story.
Yep. Well, so lots of takeaways. I urge you to listen to this on the social media handles, and of course, we'll replay some parts of this during the course of the show as well. But on that note, and a slightly more painful and a somber note, it's a wrap on the last India market open for this week. Up next is Ask Profit. Stay tuned.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Bachrajani, and we will take you through the next 1 hour of trade. It's not a very good Friday. In fact, it's not a very good end to a month that has seen the Nifty 50 drop over 5%. And if you thought at the start of the year in January that 4 months of declines for the benchmark would be the end to that decline, well, you thought wrong, unfortunately. Good morning, Mahima.
Good morning, Alex. Not a very good morning for the markets for sure, but yeah. So just the other day we were discussing that this is the longest 5-month streak where the benchmarks have fallen so much in the past 25 years.
More than that.
Probably more than that. But
I think it's 28 years that you've not seen 5 months in a row, right?
Yeah.
Where you have, or 5 series in a row for the benchmark Nifty 50. So let's take a look at some of those numbers. We have come off the low point of the day for the benchmark Nifty 50, but just about, right? And you're trading with cuts of about 1.1% or thereabouts. And the broader markets are where the heavier selling is taking place. You saw this in trade yesterday as well, where the benchmark ended flat, but you saw considerable selling in the broader end. You have cuts of about 1.9% for the mid-cap index, about 2% or thereabouts for the small-cap index. And the market breadth, as a result of which trade is very, very heavily tilted in favor of the declines. And where do you seek refuge in this kind of a market? Because if you pull up the sectoral picture as well, you will notice that all the sectors are in the red. And while the VIX has come off a bit, it was up 5%, it's still above that 13 mark. But some people are saying that that is also a bit of a positive. We're looking at the relative strength indicator numbers for the Nifty 50 for a 14-day period, and they are in fact in oversold zone. So some people saying that the market may be, of course, oversold. This might be a little too far, but then they've been saying that for some time right now, and we haven't yet found a bottom for the benchmark or indeed for the broader markets. But everything from an IT, which is losing close to 4% at this point, to something like an auto, which is down about 2.5%, the likes of M&M losing quite a considerable amount of ground today. Metal down about 1.5%, was up and about yesterday. Pharma as well, where you've seen a pocket of strength in the recent past, is down over 1% or so. Even Nifty Bank, which has gotten a shot in the arm, or actually a couple of shots in the arm in the recent past on the back of RBI measures to reduce the risk weights on loans to non-banking finance companies, and also to infuse liquidity, as we've heard from Vishwanath Nair, who's got source-based information that a dollar swap will be taking place and will be conducted by the RBI to the extent of $10 billion to infuse liquidity into a system that is still starved of liquidity. Even that pack is down quite considerably in trade today, 0.7%, but falling less than the rest of the market for the Nifty Bank, and off the low point of the day, the Nifty Finance as a whole also losing ground. So where do you seek refuge? Let's go across to our experts. We've got Jatin Gedia, who's a technical research analyst at Mira Asset Sharekhan, or Sharekhan by Mira Asset, and we've also got Avinash Gorakshakar, who is Director of Research at Profit Mart Securities. Good morning, gentlemen, and thanks so much for joining us today. Jatin, I'll start with you. Where do you seek refuge and how do you position yourself? Of course, I'm also asking about the index strategy that you would employ right now.
Yeah, so good morning, everyone. So as far as the Nifty is concerned, yes, since last 3 trading sessions after the gap down on Monday, it was consolidating, and again, once this monthly expiry got over, we have seen a gap down. So that indicates that the Nifty is now likely to head towards 22,000 on the downside. So this is as far as the Fibonacci extension number is concerned, and also if we look at the monthly options chain data, what we have observed is that 22,000 strike put option has a significant overhead. So that is likely to act as a strong support in the case of Nifty. On the upside, until and unless the gap area that we have formed today, so 22,400, 22,500 remains a crucial resistance to watch out for from an immediate basis. So we believe that during the initial first couple of weeks of this March series expiry, we are likely to head towards the 22,000 mark in the very short term. And thereafter, we can expect some recovery or a relief rally. But as of now, the bias remains on the short side, and on the downside, the crucial level to watch out for is the level of 22,000.
So more downside awaits is the view coming in from Jatin. And in fact, the benchmark, that is the Nifty 50, is down about 15% from its 26,000 highs, about 26,000 highs. Okay, moving on to our first caller for the day. Ajay from Ambala is calling in. Ajay, very good morning. कैसे मदद करें आपकी?
गुड मॉर्निंग मैम, गुड मॉर्निंग सर, थैंक यू मेरी क्वेरी लेने के लिए। मैम मेरा क्वेश्चन है रिगार्डिंग टीसीएस का। मैंने कुछ दिन पहले ये टीसीएस की पोजीशन ली थी 3725 पे 1000 शेयर्स पे। अभी ये काफी थोड़ा नीचे आ चुका है, क्या मुझे इस पे एवरेज करना चाहिए या निकल जाना चाहिए?
अच्छा अजय, आपने चार्ट्स दे के लिया था ये शॉर्ट टर्म पर्सपेक्टिव के लिए?
नहीं मैम, मैंने लॉन्ग टर्म के पॉइंट ऑफ व्यू से ही लिया था, क्योंकि जब नीचे आ रहा था मुझे लगा कि दैट्स द राइट टाइम टू बाय, बट उससे भी नीचे आ गया 2-3 दिन।
ओके, और ये आपका कितने पोर्टफोलियो का कितना पोर्शन है एज अ परसेंटेज? बिकॉज अभी आप ऑलमोस्ट 2.5 के लॉस पे बैठे हैं।
मैम मेरा ये कम से कम 60% है, मैंने 60% पोर्टफोलियो का ये उठा लिया।
Alright, Ajay, I'll go to Avinash and also, ask Avinash to advise you that such a heavy amount should be invested in one particular stock when it, constitutes almost 50% of your portfolio. क्या ये सही चीज़ है कि नहीं? Avinash, I don't think, according to me, that's the right strategy to adopt. Your view on that, plus TCS as a company, what's the view like?
Yeah, good morning, Mahima. I think clearly, as you rightly pointed out, 50% in one stock is definitely not an advisable option. Because having such concentrated bets in such volatile markets is very risky, because now, obviously the investor has purchased the share at around 3,700. Now it's quoting at 3,480. See, my sense is that at least going forward, investors should make it a point that at best you should try to allocate initially only 5% or maybe 6% in every stock, because in this kind of market taking concentrated bets can go wrong. As far as TCS is concerned, I can only tell him that if he has taken it as a long-term investment and by not looking at the charts, then I think he definitely can hold on. I think TCS is not a company which is a weak player in the IT market. In fact, IT is one sector which is unlikely to be badly impacted, because clearly the tailwinds in the market clearly show that the rupee is depreciating, the dollar is appreciating, and most importantly, the US market, once things stabilize there, you're going to see a stronger commentary from most of their clients in terms of incremental, kind of order wins. So I think he needs to give in at least next 12 to 15 months, because as of now, fundamentals are not being considered. It's purely the sentimental effect which is playing out. So I think if he can hold on for the next, say, 12 to 15 months, I think he can definitely expect a decent risk reward, provided he has the patience and the conviction, because in these markets people get panicky. I fully agree with that, but I think selling good quality blue chip stocks in this kind of market will not be the right solution. So I think he should hold on, keep the conviction, and I think rewards would come in, but only after 12 to 15 months.
Yeah, hopefully that gives you some perspective. Thanks, Avinash, for that view. And TCS, of course, among a pack, as part of a pack that is the worst hit in trade today. So maybe also to a certain extent your losses are getting compounded by that and looks worse than it was obviously yesterday, down about 3.7% as we speak right now. Let's talk about the next question, and we've got Sadanand writing in from Goa. He's asking about Hindustan Copper, which is bought at levels of 305. Hold, sell or add more is the question, and normally I would go to Jatin on this one. But Avinash, I want to come to you, because ultimately we're talking about metal counters that are going to be a little wobbly, right? Because there's so much uncertainty on the global front. What is happening with the US tariffs? What is happening with China growth? And copper ultimately will move based on that underlying growth picture on the global stage. So would you hold on to this?
No, I think, see, specifically as regards Hindustan Copper is concerned, I think, this is a company which has got a fairly strong balance sheet. It's got a product monopoly in the Indian market. And I think, as you rightly pointed out, any further re-rating, from these levels can be possible only if metal prices start improving. There is some stability from the US market side. And as far as tariffs are concerned, we are yet not clear how badly, these companies which make metals, especially Hindustan Copper, would get impacted. Because typically, I would say that, the electrical wire and cable sector has been growing very rapidly. So there's a good domestic kind of tailwind. But as far as global metal prices, copper prices are concerned, unless there is some remarkable bounce back and that is sustainable, only then one could expect a big revival. So I think, if the investor can hold on for the next, say, 6 to 12 months, because I think clearly copper is one, input which is going to definitely go up in the longer term. In the short term, maybe for the next couple of quarters, you could find that the performances could be little wobbly and little volatile. So I think keep the, time frame slightly long term. And I don't think you're going to see a further cut, from these levels. It's already down by 50% for the investor. So I think he needs to hold on. Averaging would depend on the March quarter numbers. Once the annual commentary is out, at that point, one can take a fresh review.
All right, so comprehensive view there on Hind Copper. We've got our next caller from Srinagar. Yamin is calling us. Hi, Yamin. Good morning. How can we help you today?
Yeah, hello.
Can you hear
Hello?
me? Yes, we
this
can
is
hear you.
Yamin.
Hi, Yamin.
Yeah.
Please go ahead.
My query is regarding Inox Wind Limited.
Okay.
I'm holding around 1,200 shares at the price of 183.
Okay.
And it has went down to 153.
Yes.
I want an outlook for around 6 months. Should I hold or should I exit at this level and re-enter if it goes down?
Re-enter, yeah. Okay, so that's a fair question. Jatin, I'm coming to you, and he's lost a little bit of ground, as have a lot of other people, and he's got a relatively short time frame. What are the levels that you should look at in the near term? Where would you put that support, and should he extend his time frame at all?
No, see, in the case of Inox Wind, I think the crucial support is at around 130 odd levels. Below that, the support is at around 121. So we can broadly say that 130 to 120 is a range where we can expect Inox Wind to see some kind of a stability or this fall to subside. So I think as of now, he should hold on to his investment and look for a turnaround around the zone of 130 to 120 kind of a range. So as of now, hold is the suggestion, and we can expect a turnaround from the support zone of 130 to 120.
All right, so that's the view with respect to Inox Wind. The next counter that we're talking about is Capacite Infra Projects. Harshad from Pune has a query on this particular counter. He is holding 300 odd shares at an average price of 380. And he wants to know whether he can add more at the current levels, and his horizon is around a 2-year period. Avinash, I'll come to you if you have a view on Capacite Infra Projects.
Yeah, I think Mahima, he can definitely hold on. See, this company is a company which specializes in basically, as a EPC contractor. And basically, it's got very large clients like L&T, most of the reputed, construction houses actually are their vendors. So I think clearly they have an order book of almost 2,500 to 3,000 crores. So clearly, I think if you look at the current year valuations, they trade at around 12, 13 times, FY25 numbers. So I think, this business is giving a strong amount of visibility. But yes, I think since the investor has purchased it at a slightly higher level, unless, he gives a 12 to 18 month time frame, because margins are pretty healthy, around, 10 to 11% on the net level. And working capital management is very crucial. The company made recently a QIB with large institutional investors. So I think, the stock is definitely going to do well over a longer term period. But in the short term, maybe there could be little volatility. I would suggest that unless he's got a 12 to 15 month time frame, I think it would be advisable to at least nibble in into a small quantity and average his cost as of now.
All right, so that's the view with respect to Capacite Infra Projects. We have our next caller lined up. Anand from Andhra Pradesh is calling in. Anand, a very good morning to you. I believe you have a query on one of the IT counters, HCL Tech.
Yes, it's regarding the HCL Tech. I have bought around 1741.
Okay.
Around 20 shares. So I just want to know, can I add further now because it's corrected around 10% from where I have bought? So just want to know, like, can I add or do I need to wait for some time? I will be holding for long term, for
Long
2 to
term.
3 years more than.
All right. Okay. Avinash, HCL Tech is the counter, and I'll combine this question with Bhupendra's question as well. He wants to know context with respect to Wipro and Infosys as well. So 3 counters: HCL Tech, Wipro, and Infosys. Nifty IT, by the way, today is down by about 3% odd. All counters trading in red. What's the view like?
No, I think within these 3 counters, I think HCL Tech definitely seems to be better. So the second counter would be Infosys. And I think, HCL Tech is definitely coming down to very attractive levels. I think at best around 1500 or maybe 1475 could be levels where the stock would bottom out. And I think, the most important thing is most of these companies are sitting on order books at least for the next 12 to 18 months. In case of Infosys also, I would suggest that, if the investor can hold on for the next at least year and a half, most of these companies, both these companies have got very strong balance sheets. They don't have a concentrated mix of clients, unlike Wipro, which has got a large tilt towards the telecom sector. So my sense is that, Infosys and HCL Tech could definitely be accumulated at the current levels, provided the investor is willing to, remain invested here for the next 12 to 15 months. I think in the short term, my sense is the markets are worried as to what could happen because of the tariff issue. But I think IT is one sector where I think there could be a lot of stability, because this is one area where Indian companies are very price competitive. They offer quality IT services. So I think, both these companies should do well over the longer term. So I think you just need to bide some time here. But in the short term, yes, volatility will be there.
Bhupendra's question has been answered as well. And the next one is on ITD cementation. And this is a question from Satyan. He's holding 3,000 shares at a price of 125. So he's in the green, and how, right? So he's making quite a considerable amount of gains in this stock. He's wondering what the long-term charts are indicating for this going forward. And should you exit and re-enter? Is there an opportunity for a trade here, or should you continue to hold? Jatin, I'm not very certain, because he would have to book 12.5% on long-term capital gains, assuming that he would have to book more than that. So it's a considerable amount of gains that he would have to book, right? So what are the charts indicating? Where do you see support?
Yeah, see, in the case of ITD cementation, I think considering that he is sitting on a very decent amount of a profit, despite the tax component, I think he should consider some amount of profit booking. In the case of supports that I see on the weekly charts, we believe that 500 is a very crucial support from a short-term perspective. And if we can hold on till 480, then that's next crucial support. So anywhere between 500 to 480 is the long-term support area in the case of ITD cementation. However, I suggest to consider some amount of profit booking because I think considering the overall market conditions, I think some amount of profit booking is definitely suggested.
Okay, all right, some amount of profit booking. So take some money off the table, and not many counters that you can say that about in the current context. So kudos to you for having that kind of an investment that you've made. Our next caller is from Bengaluru. Murli is calling us. Hi Murli, how can we help you today?
Good morning.
Good morning.
Yeah, I've seen one company, unlike the company called Signature Global.
Yes.
Which is a real estate firm based on Gurugram.
Yes.
I think it's an exciting prospects ahead.
Okay.
It's a good return on equity, ROCE, and doubling the profit, or rather tripling the profit next 2 years. With a low base. So can I enter this at the current? Yeah, tell me.
I'm curious where you read this, Murli, doubling.
I had to go through some reviews, some brokerage reports. Not one, because one may be biased. So I have gone through a few reports and comments of others.
Okay, and you've not deployed yet, right?
One of the interviews are the management interviews also.
Yeah, you've not invested yet, right?
Yeah, I want to invest, considering that I'm willing to take a chance.
Yeah.
Based on fundamentals.
Do you have any other real estate stocks?
1060. Yeah, I have Godrej Properties under shares.
Okay, understood. Avinash, opinion on Signature Global? I'm not sure where he read this, but expectation of doubling, tripling of profit over the next 2 to 3 years?
No, I think, Alex, my sense is that, obviously long-term prospects are pretty solid considering the kind of inventory they are building and the kind of markets they operate. Because Gurgaon is a very strong market in terms of pricing. But I think, my sense is that even at these levels, one needs to be a little cautious. I think it's better to wait for the January to March quarter. My sense is that, of course, the rate cut cycle has happened, but I think the bigger issue is that, at these levels, immediately, I don't perceive that the stock looks extremely attractive and oversold. It's come down from its high. But if you ask me whether, the next 3 months or 6 months, one could expect some explosive numbers, it's difficult to say because I think clearly even if the investor takes a 2-year call, it's better that he waits for the March quarter. I think there's nothing to lose considering the fact that the stock is going to go up in a hurry. Opportunities will come in. And I think even if he does want to buy, Alex, I would suggest that he can deploy at best about 10% of his capital. I think it doesn't make sense to buy all the investments in one shot. So that would also give him the benefit of averaging. But my suggestion would be that wait for the March numbers to pan out. And obviously then there would be better clarity because probably by middle of April or end of April, you could get these numbers. And that would be a good time to accumulate. But as of now, it looks a little bit risky according to me.
If I'm wrong, Avinash, while some of these companies, real estate companies, have reported decent numbers and we're looking at pre-sale numbers, we're talking about a few that have disappointed as well. So I think that caution is warranted, right? And what is the metric that you would look at? Would you look at pre-sale number as well?
Exactly. I think in most of the real estate companies, Alex, pre-sale numbers are important and execution. I think, the timely execution of these projects is very important because the pre-sales number is one part, but secondly is the execution on the ground. And I think clearly, I think October to December is typically a very big season for, launches, pre-sale numbers. But I think typically now going forward, I think, from April onward, we'll have to see how execution takes off. So clearly on both these parameters, I think Signature Global definitely looks interesting. But I would say that, the stock has risen also very fast. So I think this correction which is happening is by those, participants who actually got stuck up at higher levels. So it's better that you wait for some time because in these kind of volatile markets, real estate is a high alpha sector. You need to time the investment also properly. So in case, since the investor has not yet made a fresh entry, at best he can buy 5% or 10% of his capital and wait for some further kind of correction, which can generate a better ROI for him going forward.
All right, that's an interesting, takeaway on Signature Global as well as what he mentioned because real estate always has a higher alpha when markets are falling. Just to give a bit more perspective in terms of 9 months FY25, versus the guidance that they had given. In terms of launches, they've achieved around 84%. In terms of pre-sales, they've achieved around 87% and collections is around 53% is achieved. So one last quarter will play a crucial role, like Avinash mentioned, as to how the guidance is being
and the
achieved.
metrics that you pointed out,
Exactly.
extremely important to track apart from pre-sales as well.
Exactly.
Thanks so much for bringing that up.
Yeah. So, okay, that was with respect to Signature Global. The next counter that we're talking about is Persistent Systems, again an IT counter in focus. Mahesh is holding around 3,600 odd shares at an average price of 500 rupees. He wants to know with respect to the charts, since he's saying 1-year outlook, and that's a significant amount of profit that he's sitting on because he's entered at the levels of 500 rupees and the stock is currently trading at 5,200 odd rupees. So his profits right now is 1.7 crores. So kudos for that, first of all, Mahesh, and the kind of patience with which he's held on to the counter. But okay, since he has been a long-term investor, Avinash, I'll again come back to you. Persistent System, what's the outlook like? Should he book profits at the current level to some extent, or should he continue to hold the entire holding that he has?
No, I think first of all, Mahima, as you rightly pointed out, the investor has entered the right price, so his margin of safety is very, very solid. He cannot, he has absolutely no issues even in the current market because his acquisition price is just about 500 rupees, and now the stock is almost more than 5,000. So my sense is that clearly, if the investor does not require funds, he can continue to hold, but a prudent strategy would be that at least, try to at least book 20-25% of your profit so that you could get advantage of the market, of some other growth opportunities, because, these markets are offering a lot of value. When the bounce back will come and when the markets will bounce back is a big question mark. But I think clearly we are nearing the bottom. And I think when we near the bottom, you get good quality companies also at attractive levels. But the key question is, do you have that kind of liquidity liquidity to infuse. So since he's made a decent profit, I think 20 to 25% of the profits can not only take out his capital cost, but give him the flexibility and the leverage to get into some other growth stocks. So I would say that, longer term prospects for Persistent are very good. Our sense is within the mid-cap IT pack, this is one company which is bound to do well. They have a good order book. The management commentary in the previous quarter was also very encouraging. So I think even FY26 is going to be a lot better. So I think there's nothing negative on the fundamental side. But I think prudently would call for at least some part booking, which helps him to keep also his liquidity intact.
That's a fair point, and you've shown patience, and kudos to you for having held on for the amount of time that you have and the gains that you've made. We have to slip into a very quick break. Avinash, do stay with us, and Jatin, I believe that we have to say goodbye. So thanks so much for joining us today, and pleasure speaking with you as always. We'll be back on the other side to take more of your questions. Do stay tuned.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम
Welcome back. You're watching Ask Profit, a show that gets all your stock related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the number that's flashing on your screens right now. We're also joined by Osho Krishnan, who is a senior research analyst and technical and derivative analyst at Angel One, who joins us now. Welcome to the show, Osho Krishnan. I'll go on to our next caller who's lined up. Shishir Mishra from Delhi is calling in. A very good morning to you, Shishir. How can we help you?
Good morning, ma'am. I have bought a Happiest Mind share, 100 shares at 846 rupees.
Okay.
And I'm a long-term investor, and my question is, should I hold it, or is it the right time to buy a little more?
Okay. Avinash, one more IT counter on your way. Happiest Minds is the counter. What's the view like?
So I think Happiest Minds is one of those companies, Mahima, which is very strong in the digital space. And I think they've got a very good marquee list of clients. My sense is, the last couple of quarters have been quite challenging, but I think the management is quite hopeful that coming year, they have a reasonably good order book. The execution also will be pretty good. And they expect a good traction from their US market, kind of customers. So I think, despite the fact that the investor has actually lost a little, he's down from his current price. I would say that, if he can continue to hold for the next, say, 12 to 18 months, I think the recovery in the digital business would come in quite significantly. There are other, markets which the company is trying to penetrate and possibly could give a further lever to their earnings, traction. So I think, he should hold on. I think he should not lose heart. It's a good company, a very strong management team, a strong bandwidth to understand the digital market. So all said and done, I think continue to hold, but I think don't expect a big revival in the March quarter. I think things should start improving, from the first quarter of FY26 onwards.
Right. That's the view on Happiest Mind. So hold is the view. Let's take the next question, and we've got Ambuja Cements that we're talking about next, and Hari from Bengaluru is asking, he's holding 115 shares, which he's bought at an average price of 559. He's currently incurring a loss, but he's wondering what the prospects are from a 6-month to 1-year time frame. Osho, morning to you, and what would you do with an Ambuja Cements on the charts?
Very good morning, Alex, and all the panelists. See, overall, the technical setup for Ambuja Cement is quite weak as of now because it is hovering below the short-term moving average also. But the buying price is approximately 10% or 20% from here onwards. But looking at the overall setup, the counter has already been into the oversold terrain. So I'm expecting that the zone of nearly 450, 445 construes a bullish gap on the weekly time frame. So that is a very strong support zone for this counter. So I'm expecting that this zone can provide some kind of a cushion to the kind of a sell-off that we are witnessing in this counter. And from there onwards, we can see some kind of consolidation or reversal once there will be buying traction or buying emergence in the whole market. So one should stay invested from a longer term duration. I am expecting that approximately the zone of 440, 445 should be seen as a very strong support zone. And from there onwards, one can see a kind of a reversal in this count.
Okay. Standard disclaimer, of course, Ambuja Cements, part of the Adani Group. This is NDTV Profit, part of the NDTV Group, which is owned by the Adani Group. The next question that I would like to take is on Bajaj Housing Finance. And we've got a viewer, Nagula Raju, who's writing in probably from Andhra Pradesh and asking about, okay, so we've got live visuals coming through.
Priority areas, what will be priority areas?
No, as I said that I am yet to join, so let me take over.
But you have been speaking about the growth of the market even during the budget conversation. But what, in that context, sir, what do you think, where is the market standing and how does the regulatory body play a role right now?
Well, I think I will not speak at this moment. Let me take over. Yeah? Thank you.
Thank you so
much. So the stage is set for Tuhin Kanta Pandey, who, remember, has served for a long time as DIPAM secretary and so is well versed with the markets. He actually was at the helm when the Life Insurance Corporation of India IPO took place, and he's been instrumental in that IPO and several other divestments that the government has done over the course of the last several years. He will take charge shortly, either later today or on Monday. And of course, you have Madhavi Puri Butch's term, which ends today. So we'll hear from him, I'm sure, sooner rather than later, and you will see regulations over the course of the next coming weeks that will be his, probably his brainchild. So let's talk about the next question. We've got Bajaj Housing Finance, as I was mentioning, that Nagula Raju got allotment of during the IPO stage, and he's wondering whether to hold or exit. He's got a long-term view on this. The stock is currently at 108. Do we have a visual of the change since issue price? If we can pull that up, let's try and do that, because it will provide a context for this conversation and this question. In the meanwhile, let me go across to Avinash. Avinash, what would you do with this one? Because it's not done a lot. And the prospects were very good. I think there was a lot of interest in the IPO stage. It was oversubscribed, and how we've seen assets under management grow at sub 30%. So what are the prospects here?
Alex, I think my sense is, this is a company which is funded by the Bajaj Finance, kind of entity. The issue price, as you know, is was 70 odd rupees. So I think that time the euphoria in the public issue market was really very, very strong. I mean, even in this market, this company is standing high. As far as the fundamentals are concerned, we believe that the next 2 to 3 years are going to be very rock solid for this company, because the balance sheet is large. The asset quality is well under control, and I think both the private as well as public opportunity. The government is also encouraging housing in a very big way. So despite the fact that previous 1 or 2 quarters were not very great, I think one possible thing is that steady growth will definitely come in, and I think Bajaj as a group is very well respected. My sense is that if the investor has at least a 2-year perspective in mind, he should hang on. He should not miss out on the bigger opportunity going forward. So, that definitely is something which we would like to reiterate, that it's a hold from our side.
Right, so that's the view with respect to Bajaj Housing, and hold is the view from Avinash. We have our next caller lined up. Adil from Srinagar again is calling us. Adil, a very good morning to you. How can we help you?
Hi, ma'am. I have a query regarding NIIT Limited.
Okay.
I'm holding 5,500 stocks at the rate of 153.
Okay.
And it has came down to 113. So I'm having a loss of 2.2 lakh rupees. Should I hold or should I sell this off?
Okay, Adil, just wanted to understand that you saw the fundamentals of the company when you bought this. What is it that attracted you to the stock?
It was basically some investor, I guess Vijay Kedi or someone else who purchased the chunk in this stock, So I also purchased this stock.
Okay.
No fundamentals.
Okay, all right. I got your question, Adil. Osho, I'll come to you on this one. NIIT Learning Systems is the counter. What are the charts looking like, and what are the supports and resistances that you're observing?
See, for this counter, we have seen a kind of a steep correction in the last couple of trading months, and now it is hovering at a very low levels of 110, 112 kind of a zone. But looking at the historical support, the zone of nearly 108 to 105 has given a very strong cushion to this counter. So I would advise not to exit this counter at current levels, because it has already seen a steep correction from a higher valuation towards the support zone now. So approximately 7-8 rupees kind of a slip can be seen in the short-term period, but the zone of 106, 105 has historically seen a decent cushioning in this counter before the rally it has seen in the month of August 24. So I'm expecting that one should stay invested with their investments in NIIT Limited, and in couple of months or couple of weeks, we can see some kind of respite in this counter. Technically, there has been no sign of pullback or decisive respite as of now, but I'm expecting that another 5 to 7 rupees kind of a downside move can provide a strong cushioning to this counter. So stay invested from a medium-term perspective. There is a high possibility that the buying price will be seen very soon from a 6 to 7 month kind of a time frame.
All right, just a bit of correction. It's NIIT Limited and not NIIT Learning Systems. Moving on to the next counter that we're talking about, it's Yatharth Hospitals. Amit Singh wants to know whether, from a medium-term perspective, whether this is a good counter to invest in, and by medium-term, he means 2 to 3 years. He's looking to buy around 500 odd shares. Avinash, do we have Avinash back? If yes, Yatharth Hospital is the counter. What's the outlook like, and from a 2 to 3 years perspective, is this the good entry levels to enter?
Yeah, I think Mahima, see, clearly Yatharth Hospitals operates in the in the Noida market and has been doing pretty well. In fact, numbers have also been quite encouraging. The stock has been partly beaten down because of poor market sentiment, and secondly, there were some corporate governance issues. But I think management has clarified that there's nothing of this sort, and things are back to normal. See, my sense is that if the investor has a 2 to 3 year horizon, the hospital space offers a very good opportunity. Healthcare is one area where I feel there's going to be a lot of growth coming in, considering the fact that the government is also supporting this sector and considering the specialty services offered by Yatharth. I would not be surprised that earnings would be bouncing back from FY26 and 27 onwards. So next 2 years are going to be pretty solid. They made a QIP of almost 600 odd crores, basically to fund on some new assets as well as for their working capital requirements. So the company is well funded. I don't think any further dilution is expected. So I think if he has the time frame of at least a couple of years, he could definitely chip in at the current level. But I think the risk reward would obviously come in from the longer term. In the short term, it's going to be the sentiment which is going to play out. Completely ignoring the fundamentals.
Speaking of sentiment playing out and ignoring fundamentals, let's pull up Polycab, let's pull up KEI Industries. And these are two counters that were beaten down very, very heavily in trade yesterday. They're making a bit of a comeback today. KEI was down 20+%. Polycab was down close to 20%, up about 2% right now. We've got Suresh from Hyderabad who's asking whether they can be bought right now, specifically these two counters, KEI and Polycab. And since they're from the same pack and also reacted together yesterday, let me go across to Osho to find out whether or not it can be bought right now. Osho, would you steer clear or would you dive in?
See, overall, I expect that such kind of correction has already been seen in the stocks like Polycab historically in the month of January 24. And after that, we have seen a very decent recovery also, and the counter has even tested the lifetime highs. But this time the situation is different because there is a new entrant. So obviously the market share is going to get some hampered because of the new entrant. But overall, the technical structure still prevails that the counter is at a decent zone to accumulate. So I would advise to start accumulating in this counter, but in a staggered manner, because once if there will be any kind of consolidation that can be seen in the coming future, then we can consolidation in the coming future, then only we can see some kind of higher momentum coming back to this counter. So I expect that there is a possibility of a strong pullback or revival in this counter. So one should definitely utilize this kind of a dip to accumulate from a medium to long term perspective in both the companies like Polycab and KEI.
So that's a technical perspective, but do bear in mind, of course, that there was a significant fundamental development yesterday which caused the entire raft of stocks to see a sharp drop. We've got our next caller. We've got Anant calling us from Bengaluru. Hi Anant, how can we help you today?
Good morning, Alex. I was calling in to check whether is it a good time to enter into Federal Bank and Karur Vysya Bank.
Okay, two counters. So why these two banks, Anant?
I have been noticing, these two banks are doing really good. Quarterly results are good. Federal Bank is a slow more, but it is moving good. However, it has fallen already from 220. I have been noticing, and it is now around 176, 178 in that mark. So results are good, and they're doing good. So corrections have also happened. So I thought,
so you're looking to buy this for your long-term portfolio, Anant?
Yeah. Around 2 to 3 years, I will keep.
Okay, so Federal and Karur Vysya Bank, right?
Correct.
Okay. Correct. Avinash, perspective on these two banks?
So Alex, I think as the viewer mentioned, Federal Bank has come out with a decent set of Q3 numbers. Even the management commentary has been encouraging. I think if he has a 2 to 3 year kind of time span, this could be the best time to accumulate banks because, a lot of panic has been created in the banking segment considering that, deposit growth would not happen. But now with the equity markets, meltdown, I think we are going to see a good revival in the deposit base of good quality banks. And I think Federal Bank has got a very large, exposure in southern India. Their asset quality has also been managed pretty well. The other bank, Karur Vysya, has also started turning around. I think, it's possibly one of those banks where a lot of large HNI investors have also started looking at it. They have built up decent positions. My sense is if you can give the next couple of years to these banks, definitely the banks like Federal Bank has the capacity to, at least double their balance sheet in the next, say, 2 to 3 years. And that definitely will reflect in better profitability. Karur Vysya Bank is like a slow turnaround case. I think it could take a slight longer period of time, but I think valuations appear to be quite attractive. So definitely a small allocation as of now at these levels would definitely yield a good risk reward, provided you keep a time frame of 18 to 24 months.
So that's the view with respect to both Federal Bank as well as Karur Vysya Bank. We have our next caller, Suresh Kumar from Hyderabad, is calling in. Suresh, a very good morning to you. How can we help you?
Yeah, hi. I wanted to know about CCL products and SPA. Hello?
Yeah, I can hear you, Suresh.
Yeah, CCL products, I bought it at 630 price around 100 shares.
Okay.
Can I average that one now or hold or sell?
All right.
And SPA, can I take an entry now?
Okay, got your question, Suresh. Osho, I'll come to you on this one. CCL products at the counter, what are the charts looking like, and can he make a fresh entry at the current levels?
In the past 3 months, this counter has been into a corrective phase, but looking at the monthly time frame and a broader time frame structure, it is having a very strong support around the zone of 550. So one should wait for another few weeks if there will be any kind of continued correction in this counter towards the zone of 550, 545. That will be an apt zone to start accumulating this counter from a short to medium term time frame. On the higher end, I am expecting that above the zone of 650, the counter will start gaining a strong momentum. So 545, 550 on the lower end and 650 on the higher end is the immediate range for this counter. A strong momentum will be seen once it sees a breakthrough beyond the zone of these levels in the coming period.
Osho, Avinash, thanks so much for joining in, for answering all of these questions for our viewers, and always a pleasure having you on the program. All right, now it's interesting times for the asset management company industry, AMC industry, and that's because new products are in the offing. You had the regulator, Securities and Exchange Board of India, overnight or last evening, in fact, released the categorization or the classification of a new avenue of investments for investors. And this is called specialized investment funds. If you recall, last year a consultation paper was released talking about a new asset class, and now that has been distilled to be called now specialized investment funds. It's an interesting prospect, and we'll find out what the industry thinks about it and what products could look like going forward. To talk about that and to talk about who should be considering investing in this, we've got Radhika Gupta, Managing Director and Chief Executive Officer of Edelweiss Mutual Fund, joining in. Radhika, as always, thanks so much for taking the time. And I remember that we'd spoken about this when the consultation paper was open, and you said that this is going to be an exciting space, both from the perspective of the manufacturer of these products as well as the investors. What are your initial thoughts on the classification that you saw? A lot of long-short options available.
So I think the classification is in line with expectations because, SEBI has really worked to co-create this with AMFI. And the idea here, I think the fundamental idea is to give access to manufacture products that could not be otherwise possible on the MF platform, which is why two of the categories, one is a multi-asset category and the second is the equity category, are focused on long short. Now, in a mutual fund structure, in a typical equity mutual fund, I can't do outright shorts. If I have a negative view on a stock, I can't express that. The use of derivatives is limited. So I think that has been enhanced meaningfully, and it's with the right intent, right? You've not allowed leverage, for instance. Exposure can't exceed 100%. So it's somewhere actually between what you would be allowed to do on a mutual fund platform and what you would be allowed to do on an AIF platform, but all for the better. I think it is very good flexibility.
Now, from the perspective of the offerings that are currently available, and you've pointed out the two options that I want to speak about, essentially, the category 3 AIFs, you would see a gravitation away from them likely into this new product, one, because of the kind of product that is being offered and the tax treatment. Would you agree?
Yeah, in part, I would say, and I don't want to sound alarm bells, but I would say that there are two parts to category 3 AIFs. They are more long only oriented funds and they are long short funds. I don't think this interferes too much with the long only category. I think this does potentially challenge the long short category because a lot of those kind of structures, 80 long, 20 short, etc., that existed on the category are now going to be offered on a mutual fund friendly format. with a lower entry ticket size, which is 10 lakhs, as I understand, and with, if structured right, perhaps better taxation terms, which is the real big delta in my view.
Which is the, so, yeah, please go ahead.
So could it pose a challenge to Cat 3 AIF on the long short side? I would reckon yes.
Okay. So I'm trying to understand the kind of investor that you envisage will gravitate to this.
Yeah.
Are you talking about a mutual fund investor that has cut their teeth, that has established a certain scale and size, that is looking for perhaps a differentiated product, more aggressive product? Or do you think that a guy who, or an investor who is investing currently in a Cat 3 AIF that is looking for a better product in terms of tax treatment, maybe a larger size, I'm not sure at this juncture, would that be the kind of expectation?
I think so. I mean, I think you have both. It's certainly not a new investor or retail or small investor product, and the ticket size has been kept at that. So I think a PMS or AIF investor, an investor who was perhaps trying to do some hedging directly with F&O instruments, can turn to this, or a mutual fund investor who's seasoned, who has the ticket size and wanted a little bit more. I think in terms of investment profile and solution, what these two categories will give you, and we should talk about the third category separately, but what the long short and the multi-asset category will give you is more nuanced risk-adjusted return solutions. So right now you have more fixed income solutions, you have more pure equity solutions on the mutual fund platform. This will give you solutions in the middle of the curve. So I think for people who are looking for that nuance of risk-adjusted returns, and of course it depends on the products that the industry creates, this may fit that space well.
So, Radhika, I'm just wondering about how you think investors should classify risk here, right? Because going back to the point of mutual fund investors, just by dint of, and despite the correction that we've seen since September, by dint of investing consistently over a period of time, perhaps from COVID lows, you have a large number of investors that will have more than 10 lakh available to invest. So what should the thinking be, in your opinion, in terms of the risk involved in investing in some of these products?
So, okay, by the way, just because you have 10 lakhs to invest doesn't mean you should jump into SIF. I think even if you are going to start investing in one of these SIFs, and I've been the greatest advocate of Dal Chawal, it's going to be a smaller part of your portfolio. This is unlikely to be your core portfolio. So let's clarify that. I think to be an SIF investor, I suspect 5-10% of your corpus will go into an SIF. These are new products. So you need to have a 1 to 2 crore liquid net worth to really start thinking about this. I think the way investors should think about risk, look, even on the mutual fund platform, hybrid products, which are risk-adjusted return products, have been very, very popular. I mean, why do hybrid funds exist? They solve the purpose of risk-adjusted returns. So if a long-short fund, for instance, by taking 80% equity exposure, 20% short, is able to generate some alpha with 60% market exposure instead of 100%, maybe the drawdowns are half of what market-based products are. That is how investors should think about it. So investors should think about it in terms of volatility drawdown. The reality is not every investor can absorb a 30% equity market loss.
100%. And you've summed it up so beautifully. Radhika, so I'm not sure if I'm going to get the opportunity to speak to you next week, and I just want you to use this platform and this opportunity to ask you to send a message out to all of the women investors that are tuning in and that will tune in over the course of next week. Of course, I like to think that we should be celebrating women every day, but from the perspective of the upcoming Women's Day, any message that you'd like to send out?
Well, so firstly, happy, I am not here next week, but, wishing all of the women investors and employees at Profit a wonderful Women's Day. And I do believe it should be celebrated every day. I think the only message to existing women investors, I think the message is keep going. The fact that you've taken the step isn't in itself enough. And don't worry if you make mistakes, because I think with women, you make a few mistakes and you're dissuaded in your journey. I think this is a journey in which you live, you learn, and you get better. To people who are not investing yet, I think a bigger message, don't believe that you're not capable of doing this. Pick up small and get started, because this is not something to outsource.
Wow. Thanks so much, Radhika, for joining in for that perspective, and always a pleasure speaking with you.
Thank you.
All right. That brings us to the end of this edition of Ask Profit from Mahima and myself and the team that put this show together. Thank you so much for watching. Do stay tuned. Lots coming up on NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम
Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE listed company every day. Today we're talking about a very, very interesting company from the technology space, Oracle Financial Services. And it's actually had a very strong 2024, of course, before we saw the correction in the broader markets, and that's also led to a little bit of precipitation in this stock as well. However, it does seem, with the way things are going, the prospects of the company seem strong. Yet, let's address how things could potentially pan out for the company. But before I do that, I want to tell you what this company does. So it does offer software for retail and corporate banking. It's largely related to the financial system, and that's where it focuses its software on. So it also offers software on risk and finance, financial crime and compliance management as well. And along with that, of course, it also provides the IT infrastructure management services. Moreover, it also does have business processing services. So BPOs are a part of the business, and it also provides consulting services along with the entire life cycle of applications used by financial institutions. So as you can see, it's essentially a company which has been veered towards addressing a lot of the needs of the financial services sector in general, and well, that's what it's been doing. At the moment, however, it's not so much about services as much as it's about products, because in fact, as for the FY24 revenues, 91% of its revenues did in fact come from products, and only about 9% came from services, which is why this is a very unique technology company where it's not so focused towards services as much as it's focused to financial services products. But we'll talk about that in a little more detail. What we usually do with all the companies, as usual, well, we talk about the fundamentals of the company, and this would include how the company is done in terms of its revenue, in terms of profitability, what kind of margins it throws up. And beyond that, we look at the balance sheet, the cash flows, and of course the return ratios. Moving beyond, we also take a look at the shareholding, street credentials, street coverage, and valuation. And these are some of the basics that we cover for every KYC in the company. On that note, let me also welcome in Rucha, who's going to also help us further elucidate how the company has done as far as this particular, stock is concerned. So Rucha, welcome to the show and thank you for joining us. Let's, as usual, start off with your top line, bottom line, and the profitability. How has this particular company done?
So I'll start with the income statement check. As you rightly mentioned, revenue came in at about 6,373 crore rupees in FY24. This actually pointed out to a 3-year CAGR, that is compounded annual growth rate of about 8.5%. EBIT stands at around 2,680, and 3-year CAGR again stands at 4.6, as you can see on your screens. Net profit at 2,219 crore rupees at about 8% CAGR. So though the numbers are good enough, in terms of the 3-year CAGR, this is a slightly mid-single digit growth over a 3-year, which is not really that much interesting. So that is why we've given this one a thumbs down. And just for clarity, the large 2 segments in the revenue consists of products and services, products of which consist around 91% of the revenue.
Right. So it's not been an amazing kind of growth, especially for the size, Oracle Financial Services is. It's not exactly a large cap company. We do know that. And, when it comes to its growth over the last few years, it's not been satisfactory. In fact, for a 66,000 market cap company, there are a lot of companies out there which have at least a double-digit growth, going forward. But that's not turned out for revenues and profitability, which is why we'll give this a thumbs down. However, there are plenty of factors to suggest that things could potentially be turning for Oracle Financial Services. And I just want to point out that the first 9 months of this particular financial year have been very, very strong for the company. A lot stronger as compared to what we've seen in terms of the 3-year CAGR. So that's something that we need to bear in mind. But let's move on and talk about the balance sheet. Well, this is a tech company. Look, so it's going to be a strong balance sheet. Of course, I'm not talking about the shareholders' equity. We should be actually be taking the net worth, but it's a debt-free company. And it has cash worth 4,700 crores on the books. So, well, very sorted. So it's going to be a thumbs up as far as the balance sheet is concerned. Now, moving on as well, I reckon that some of these particulars could see further improvement going on. But Rucha, how are cash flows looking at?
This one is a neutral rating over here because the cash flow conversion is not that great, below 100%, wherein in general, most IT companies have more than 100% of cash flow generation because largely most of them are debt-free over here and high cash rich. The CFO in terms of numbers stands at about 1,791 crore rupees, as you can see. So largely, as on FY24, largely it has remained around the 1,700 to 1,850 kind of levels, but the conversion, as I mentioned over here, stands between 65% to 75%, which is not a great number, but also not that bad to give this one a thumbs down. That is why we've given this one a neutral.
Right. So fair enough. Well, I guess that it's essentially comes down to EBIT, which is curtailing the rating for particular cash flows.
Actually, this is the conversion ratio.
This is the conversion ratio, right? So the conversion ratio, of course, being not as good as some of the other tech companies, because from what Rucha tells me, that some of these companies are about 100% conversion ratio, and hence a little bit of a challenge there. But that said, let's take a look at your return ratios. Now, look, this is a tech company, so the return ratios are going to be superior. There's no doubt about that. So your return on capital employed comes in at around 40% in FY24. And it's improved over FY22 and FY23. So naturally a thumbs up there. But if we just move on and talk about the shareholding pattern, how does this one look?
So largely, around 73% of the shareholding stands in with the promoters. So kind of good hold over the company. Though the free float stands at around 25%, but still, this one is a thumbs up because it's largely less volatile in nature. In terms of the institutional holdings, FIDI is a largely equal kind of weighting, 8.5 and 9.5, and the other stands at around 9.5. So largely good hold on the company, less volatile stock over here, hence this one is a thumbs up.
Okay, so thumbs up as far as shareholding is concerned. I just want to point out if there are some, important investors in Oracle Financial Services. And, as I was mentioning, that it has a market cap around 66,000 crores, which means there will be a lot of institutions who will, in fact, be invested in the company. So firstly, we have Life Insurance Corporation, which has about a near 2% stake. Kotak Mahindra, AMC, HDFC AMC also have stake, along with, of course, Motilal Oswal. It's actually a part of the Motilal Oswal Momentum Index as well, and rightly so, because like I said, 2024 was a very, very good year for OFSS. So these are some of the names that are invested in this particular company. But moving on, even if consider the FIIs, they have about 8.5% stake. And in terms of FIIs, we have another entity called Wessex, which is also in a part of the shareholding. But in general, overall, this is how things are looking as far as their shareholding is concerned. I'll move on and talk about the street credentials. And as far as street credentials are concerned, in the last 6 months, where we are looking at 26% returns, or rather, pardon me, this negative 26% returns. And of course, in the last 12 months, looking at returns of around 5.8% at the moment. So keeping an eye on some of these factors as well, they're clearly underperformed. So that's as far as your street credentials are concerned. Rucha, why don't you, take up the street coverage as well as valuations? How are these aspects looking here?
So as you rightly mentioned, returns are not that great, but in terms of street coverage, there is only Dolat Capital which is covering this stock and has a target price of about 11,400. Therefore, implies return potential of about 41% over here. So definitely a neutral rating, not a thumbs down or a thumbs up, because not much of a coverage that OFSS has on the street. In terms of valuations, this one stands about 26 to 27 times its FY26 EPS, and this one is actually cheaper than its other peers like Happiest Minds, Emphasis, Coforge. So other than Coforge, these two names traded about 30 to 33 times its FY26, and Coforge stands at around 40 times FY26 EPS. This was because Coforge run a lot in the last year, but OFSS since the last 3 months have come down because of its bad earnings, and that is why that kind of stock price correction has happened, and which is reflected in the valuations as well over here. So even Dolat Capital says that the third quarter was not really good, but the prospects in the fourth quarter seems to be fine from the company.
Okay, well, there you have it. That's, Oracle Financial Services. So that brings us to your overall rating, and we can take a look at how things are panning here. Firstly, when you take a look at, your income statement, that of course is a decline. But balance sheet looking good, cash flows and return ratios also looking good. And moving on, we also have street credentials and street coverage along with street valuations up. Street cred, however, is down because it has lost a little bit of in terms of price action, and has also underperformed the market. But remember that when you are a part of the momentum portfolios, when you do in fact see a correction, you also tend to see that much more correction in some of your momentum-based stocks. And considering the fact that Oracle Financial Services was one of them, where we are looking at that weakness as far as price action is concerned. So that brings us to an overall rating of 5 out of 8 on this particular company. But, want to move on and talk about a handful of other aspects here. And if we can actually revisit what's happened in the third quarter, particularly, Rucha, if you could actually quickly take us through these numbers here.
Yeah, so as I mentioned, third quarter was bad for the company. The revenue was up just modestly by 2.5%. Margin was down on a quarter-on-quarter basis, down by 5%. And even the margin in percentage terms came in at about 41% versus 44% last quarter. Net profit was down about 6%. And this was largely because of delay in milestone completion by the company. But Dollard Capital, which is the only brokerage house that covers this company, mentions that, this actually will bounce back in the fourth quarter, or is expected to bounce back in the fourth quarter. And a recovery in the implementation, which actually affected the third quarter, might be one of the key levers for growth in the fourth quarter. Apart from that, the ongoing license wins could also ensure visibility in the coming financial year. And therefore, they have given this one an accumulate rating and a target price of 11,400. Mind you, Oracle was one of the top outperformers in CY24. But because of the underperformance of the share price in last 3 months, the overall return over the last 6 months have come down by around 26%, as Agam had covered in street credentials over here. So disappointing third quarter, but Dollard Capital expects a recovery to come in from the fourth quarter.
Okay, well, actually, we do in fact have Rahul Jain. He's a director of research at Dollard Capital, who joins us to take us through what he actually, further elucidate what he makes of Oracle Financial Services. So, Rahul, firstly, good morning, and thank you so much for joining in. Since we were talking about this particular company, what we've seen is the growth has been lackluster, at least over the last 3 odd years. But we also saw a significant pickup in the share price of the company, which means that at least investors to a certain extent were expecting prospects to improve considerably. So my question then is that what are you making of this particular company at this point in time?
Yeah, hi. So basically, if you look at a growth rate in FY24 and to whatever degree we have for the 3 quarter, the growth rate has actually improved meaningfully from 4 to 5% CAGR the company used to do prior to these years. And this company basically is a product business. So there is a lead indicator in form of the license fees, which is a typical lead indicator for any product business. That part of the revenue segment has shown incredible growth in FY24 second half. And ever since, the stock has actually got alleviated because the growth were pretty significant in Q3 of last year. So basically, all this change in the growth matrix, both on the revenue basis as well as on the lead indicator basis, led to re-rating of the stock, and that's why we saw a significant up move. Of course, now we are seeing a bit pain in terms of PE for the mid-tier and also larger stocks, so it is taking that kind of a hit as well. However, having said that, since the growth rate for this business is improving versus what it used to see in the past, we are confident that the company should be performing better compared to other peers in the mid-tier space. That's our thought right now.
So Rahul, I actually want you to elaborate a little bit more when it comes to the company being a product business and how the licensing works in this case. So what does that mean for registering revenues? If you could, further elucidate, because this, of course, is not your usual, technology company which is listed on the Indian exchanges. The business model here is slightly different. If you could explain to our viewers how this particular aspect works here.
Right. So for any software business, the typical model is you sell the license, which is the first piece of revenue that gets recognized in your P&L, and then it follows up with the implementation of those licenses, which take typically 2 to 3 quarters of rollout, depending on how big the bank is, how many geographies it is spread into. And then the third element is the AMC, which is the annuity revenue, which you see on an annual basis. So this is the typical revenue model, and that's why I was talking about that matrix look healthy, which led to re-rating, because the license revenue for last fiscal was around 135 million versus a typical average around $90 million the company used to do prior to that. So it was a good 30-40% jump on that number, which basically led to re-rating of the stock. So that was where it started. And just one more point to add here is that this is a very high profitability business, which also supported the momentum here, because the profitability further improved to upwards of 45%. And that is where the incremental comfort comes in. And this kind of a business do not have any capex, so there's a lot of cash flow which get generated in the process, and all of it get distributed. If you look at their payout history for last 8-9 years, whatever cash flow they have generated, they've paid out 100% of that. So some of those things were also adding up to the re-rating thought process.
Well, okay, one question from my side over here. As you mentioned that the prospects look good and all of that, but IT as a general the sentiment seems to be down in the coming quarter as well, Rahul. And how different can OFSS be? Because in your note, you've mentioned that you expect a recovery in the fourth quarter and in FY26 as well. So can you explain to us what could actually be, beneficial for OFSS, and how can it be resistant to what is going on for the industry as a whole, IT industry as a whole?
Yeah, so of course, very broader aspect like any let's say US GDP or any developed market GDP, of course, is an important parameter and would also have its bearing on Oracle, just like any other IT services business. But here the bigger story lies that is banking segment in the Western world is going to go for a big modernization. So that is the theme out here. In fact, as I was mentioning that last year license signing was pretty strong. So one of the biggest factor was there was one market deal where they saw a very large bank moving from mainframe ecosystem to cloud deployment. I think this is a very big change that is shaping up. It may take some time, but if that plays out well, there are so many large banks which are very outdated on tech in the Western world. And if they move to the cloud, which is the big drive factor, I think Oracle could see a much better growth in next 10 years versus what it saw in last 10 years. And that's why I won't align it to the broader IT services business, because the business model and driving force are very different out here.
Business model is different, I understand. But talk to us more about the licensing part. Was only missing the milestone a problem in 3Q, and because of that the stock corrected almost 25% since the earnings. So I'm not able to do the maths over here, and what will happen suddenly that could poise to a recovery in the fourth quarter?
Yeah, so I would say one more uniqueness of this business versus, let's say, a services business is that the license win happen or get reported on a quarterly basis. And the repeat revenue nature in this kind of a business is as low as 45-50% versus 85-90% in case of IT services. And that is why there could be a lot of quarterly volatility that can happen. As I also said, there is more and more demand which is happening on the cloud side. The recognition of the revenue kinds of get deferred, but that adds up to the visibility into the future. So I'm not very worried about one specific quarter not doing well. Of course, the reaction is sharper with market as well as Q3 being weak. But we are sure that as it is going to continue to trend better on the growth path, the stock should ideally outperform the other mid-tier IT services space. That's our thought in this part.
Now that we have you with us, in general, if you leave OFSS aside, how are you rating the tech sector at the moment? I know that there's been a lot of rhetorics from the President of the United States that said, well, we have a lot of uncertainty with respect to the interest rate trajectory as well, which also has a lot of leaning for the financial sector as a whole. Which of course indirectly means what that indirectly means to the business for Indian technology companies. So your overall view of the Indian tech space at the moment, what are you making of it?
Yeah, I would highlight 2-3 things that forms our base opinion. So we were neutral to negative on the services space for some time, and these were a slide coming from the fact that the growth rate which we are anticipating versus what kind of P multiple these businesses were trading were slightly stretched, and that's what it required some kind of a correction which is underway right now. So we would possibly start liking some of this name post this correction. But prior to that, we were very selective in terms of what kind of valuation we were comfortable. So we were having more sells than buy in our rating thing. The current view which you are saying that how things are shaping under new administration, what we are seeing from an incremental perspective, I think my real worry point would be if the US GDP growth has to further deteriorate from here. That would definitely have a negative bearing on it. But outside of that, I just believe that the growth rate may not be as bad. And thus, we don't see a meaningful de-rating kind of a risk in the business.
Okay, on the services side, I understand, but let me talk to you more about the top tier companies. Infosys, TCS have corrected a lot bit from what they had hit in CY24. So what's your outlook on the top tier companies, especially the likes of Infi, TCS, HCL Technologies and LTI IT? Well, not TechM because it's largely more of the communication side, but on these three names.
Yeah, here also if we see go by the consensus estimate and our estimate is slightly lower than that, the street is building closer to 7 to 9% kind of a growth going into next fiscal. With the kind of economic data and disruption that we are observing, and also there is uncertainty, I think the guidance that we will hear from likes of Infosys, HCL Tech, who gives explicit guidance, if those numbers range around 5% or 6%, it will further lead to some de-rating or at least some cut in the estimate. So that would be the decisive factor going forward. We see there is a small risk of estimate cut that may happen in the month of April as these results will come in. And probably that is the time we would have the revised thought process and estimates accordingly. So those are the thought process. We think there could be some pain till April, and absolute correction we don't see much, but some bit of pain may come in the mindset given the fact that there could be some estimate cut that may happen in Q4 as well.
Okay. One last question from my side. Forget about the quarterly returns. I want to know what kind of returns are you expecting IT to give in FY26 as a whole? Do you think recovery could be expected in the second half?
I would say at least in large cap where we are thinking a rupee basis 9 to 10% growth can happen along with 2 to 3% dividend yield. So basically, once we see the bottoming here in probably around month of April and May post the new guidance get reset, some upside potential can happen because we don't see them to be crashing significantly in terms of growth thought process, neither from a valuation perspective. They were always pretty reasonable. So this 15% of correction there has brought them into the zone where they can trend. So if we expect 7% growth to continue, 20 to 24 multiple which they are trading today can sustain, and that's why 10-12% return is possible.
Okay, Rahul, one last question again because I'm very much curious. So do you think that the bottom is still not here for the top tier IT companies? Because I heard you mention that the bottom might come in April and not now.
So I was more mentioning from a growth point of view because we would get that guidance, explicit guidance in the month of April, not from stock perspective. Let's assume they talk about 6-7% growth, then our current estimate will stay hold at that level, and that's why the upside could be even better. But let's assume they have a slightly cautious view and they guide for, let's say, 4-6% kind of a growth. So we will do a small reset on our current estimate, and on basis that we may probably ascribe a more reasonable multiple than what it is trading now. And that's why I was saying April become a decisive point. So nevertheless, I think 5% as a bear case and 10-12% as a bull case is what you can think about as a for the top 3 IT names.
Okay, well, Rahul, point taken. Want to thank you for joining us and giving us that very comprehensive view on not just Oracle Financial Services, but also the entire financial service, technology space at the moment, which of course is looking at a lot of volatility for many reasons that Rahul has already mentioned to us. But on that note, it's a wrap on this edition of KYC. But stay tuned in. We'll be back in just a bit. We have lots more lined up. You're watching NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है,
Welcome to Markets at 12. This is Mahima Vachrajani. Before we move on to what's lined up for the show, let's take a quick look at how the markets are doing. Well, it's definitely not a good Friday for the markets. Let's pull up the benchmark indices as well as the broader markets and see how they're faring in trade. The Nifty is down by about 1.3%. The Sensex is also down by about 1.4%. In terms of the broader markets, the real pain is at the broader end of spectrum. The mid-cap 150 is down by about 2.7 odd percent, and the small cap 250 is down by about 2.8 odd percent. Let's pull up the breadth of the market and see how the advanced decline ratio looks like. There you go. There's about 6 odd advances only on the Nifty and 44 declines. In terms of Sensex, there's 3 odd advances versus that of 27 odd declines, and broader from an NSE perspective, there are only 168 advances versus that of 2000 odd declines. Let's also pull up the sectoral heat map and see how sectors are faring in trade. All sectors in red. It's only the India VIX that is in fact in green, but all sectors in red. So definitely markets not looking good. In terms of the NSE 500, let's pull up what counters are doing well despite the markets being down. Some counters like Jindal is up by about 15 odd percent, Home First up by 5 odd percent, KSP on the back of its earnings up by 4%, Star Health up by 3%. Some counters like Patanjali after inclusion in F&O down by about 10 odd percent, Century Textile down by about 9 odd percent, Reddington down by about 8 odd percent, and Deepak Fertilizer also down by about 8 odd percent. But in terms of the markets as a whole, not looking very nice. In fact, we'll also speak to Pankaj Murarka in a while to dissect as to how the markets will fare going ahead. Now, the Nifty is set to break 28-year record with a fall in 5 consecutive months, while Sensex declines for the 3 straight months. And Harsh joins us with top factors for the triggers for this fall. Harsh.
So not looking pretty on the index, and that's led one by how the US markets have really performed. First off, we saw quite a few cuts on US markets led by Nvidia, which has now fallen 20% from the highs. And it's on the back of weak commentary coming from Nvidia, but overall, the US growth outlook is looking slightly weaker. And the jobless claims at 240,000 versus the 220,000 expected, it definitely came in on the slightly higher side, which has led to that kind of sentiment creeping into US markets. We saw sharp cuts across the board. Let's though look at the next point. Largely, it's also the FII selling, which is leading to the kind of sell-off that we're seeing even today. We've seen FII selling of $13 billion in India in 2025 from Indian markets. So, and that is obviously the other key drag. The third piece is with regard to the way in which your Q3 GDP outlook is looking. It's not looking very pretty, and that number will obviously come out. Estimate is at 6.2%, and overall also the India growth number seems to be slowing, and that's causing some bit of tepidness in markets as well. Fourth point being, there's been EPS cuts across the board. We've seen a 1% EPS cut over the last month or so, or a couple of months or so since earnings have started. 1 year forward, EPS estimates have been cut by 1% thereabouts. On the Nifty, I'm talking about broader markets, it's even sharper. So that's the other thing. And fifth point being valuations. They were already quite elevated, and Jeffrey seems to suggest that there's a decent room for correction to align with Nifty valuations. They are expecting both the mid-cap as well as small-cap valuations to start to trend more towards the Nifty, but we're seeing falls on the Nifty as well, and therefore we'll have to see as to how this essentially plays out. But that's the note, greed and fear, which Jeffries generally puts out, which kind of conveys that.
Thanks for that, Harsh. Now let's get across somebody who's looked at various cycles to try and understand how bad is the current cycle, how bad can it get further. Remember, we were in a bull market just not too long ago. Pankaj Murarka of Renaissance Investment Managers Johnson right now with his thoughts. Pankaj, great having you. Thanks for taking the time out. And it does seem, Pankaj, that this 5 months of a downtick and the last 2 months of incessant selling, predominantly from the FIIs, has shaken up even the strongest of bulls. How are you thinking about the landscape currently?
Good afternoon, Neeraj. Yes, the correction has been sharp, Neeraj, but I think what really came as a surprise, if you just step back and look for a moment, there has been a meaningful slowdown in the economy, which was certainly not expected in September, October, or probably I think everyone underestimated the magnitude of growth slowdown. The fact that Nifty 50 companies will do a 6% earnings growth this year, probably the slowest in the last 5 years or probably in the last 7 or 8 years, is a reflection of the underlying slowdown that the economy is going and markets reflecting that. Having said that, I still think at the broader Nifty index level, my view is that we are closer to some sort of a trough on the index. It's difficult to call out exactly, any level or a day, whether it's today or tomorrow or after 5 days. But I think now we are at trough of earnings degrowth cycle or earnings downward revision cycle, and valuations at the Nifty 50 index level are pretty much in line with long-term averages in that sense. So, and more importantly, on a bottom-up basis, now you can look at stocks where you can certainly think, where stocks are offering 15-20% CAGR returns over the next 3 years, and despite moderation in growth. So I think at least at the large cap index level, I certainly think that we are closer to some sort of a trough. It's difficult to call out, as I said, whether it's today or the next week, but I certainly think in the next few weeks, we certainly make a trough at the broader index level.
Pankaj, the question is that if Donald Trump with his actions, right, and the tariff actions is kind of a bit of a hanging sword on the global trade. And in such a scenario, is it easy for money to flow into risk assets, or will the money say that let's wait on the sidelines until there is clarity around all of this?
So I agree with what you're saying. One, India has been at the receiving end of the fact that the money has been, there's been rotation of capital out of India to China and some of the other relatively cheaper emerging markets. So if you look at China or let's say even developed markets like the traditional export markets like Korea, until yesterday, like YTD, they were flat, whereas Indian markets were down 5 or 6%. We've seen a pretty relentless selling or a pretty sharp selling from FIs over the last 8 weeks at about $12-13 billion. But having said that, eventually over the medium term, Neeraj, my experience has been that the capital chases growth. While there are short-term cyclical growth headwinds in India, the long-term structural growth story of India remains very much in place. I don't think so anything has changed on that count. Tariffs can create some headwinds to India's growth, but I think despite those headwinds on a relative scale will be lower for India versus a lot of other countries, and probably hopefully by the end of the year we'll get a bilateral trade treaty from US between India and US, which can actually increase the international trade between the two countries. But having said that, even after baking headwinds from tariff, I still think India can do a 6.5% growth going into the next year. And at given that growth construct, I think markets are fairly priced. I don't know immediately over the next, let's say, 6 or 8 weeks, but even second half of the year, I certainly see capital flowing back into India because India will be a far more calmer and stable economy versus a lot of other markets or a lot of other countries in the world. And valuations would have or have already normalized.
Got it. Pankaj, so we have the GDP print today for whatever it's worth, right? And then I think crucial would be the commentary that comes in from corporates, let's say the last 15 days of March about how the Q4 has been. If the print today is good, and if the print later on for Q4, or at least the telltale signs around Q4 sound good, then we get out of this anemic growth, or we, let's say, presumably get out of this anemic growth pattern that we had fallen into Q1 and mainly into Q2. Is that a good enough antidote, or is that not enough?
Not really, Neeraj, because when we get the third quarter numbers today evening, we'll see some recovery in growth from the second quarter low, which was 5.4%, which was very bad. But yet the economy at this point of time is at a stage where probably growth recovery will be slightly more gradual and modest. We don't see a very sharp recovery in growth going into the next quarter itself. So I think growth recovery in the economy will be more back-ended towards the second half of this calendar year. So we have probably economy has, let me put it this way around, the economic activity has settled at a slightly lower level in that sense. So probably I think if we can get something like a 6.2, 6.3 kind of a print for the third quarter will not be a bad outcome. My understanding and our analysis is that the fourth quarter will not be any different than that. So probably economy is operating at about 6.5% growth or somewhere there. And any recovery from this will be more second half of this calendar year, probably hoping for a normal monsoon this year. So I think, meaning there are no quick fixes here in terms of economic recovery, because what's the slowdown that we're experiencing, it's almost 8 quarters old now. I think all of us are waking up to that a bit late, including the government. And when you have such a prolonged slowdown across multiple sectors of the economy, it's a very broad-based slowdown, because what started as a slowdown in rural consumption spread over to urban consumption. We've seen moderation in central government investments, private sector capex has been lackluster all throughout post-COVID as well. So given all of this, I think the growth recovery in the economy will be more gradual and back-ended in that sense.
All right, Mr. Murarka, Mahima also joining in. With respect to the Nifty IT, it's down by about 3% and it's currently, trading at its 7-month low. What has led to this downfall, and now that it is corrected so much, what are the pockets where you are seeing value right now?
Well, Mahima, I think today's correction is a rub-off of the overnight correction in Nasdaq, because in the short-term market just extrapolate trends, but and probably there is probably there are signs that while the AI-driven capex in US still continues to remain strong, but after having had such a strong investments from the, as we call the Magnificent Seven, over the last 2 years or 3 years, it seems that the capex there also in artificial intelligence will slow down probably towards the later part of this year and next year, which is not a bad thing. So even despite today's correction, last 1 year IT is still in the Indian context one of the outperforming sectors, because the sector has done pretty well. I think my view is that probably this correction is a good time to buy into IT companies. We like, especially I think at this point of time, there are some of the larger cap IT names like Tech Mahindra and Infosys really look pretty reasonable for investors willing to take a 1 year view.
So you are veering towards some of the large cap names, not because they are large cap by definition, but because you like their business models and the valuation combination better than what is there at the broader end of the spectrum in the IT space.
That's true, and in times like this, Neeraj, you're better off with higher certainty and lower risk. Probably we can revisit. I must confess, admit we already have some exposure to mid-cap ITs as well. But at this point of time, we are not looking to add more to the mid-cap, and probably will add incrementally to the large-cap one. Probably mid-caps one we can revisit probably, a quarter down the line.
Pankaj, one final question from my end. A lot of mid-sized and small-sized firms at the end of Q3, after delivering maybe half-decent numbers, pointed to a fairly strong Q4 and a positive scenario for FY26 at the very least. Now, they were maybe in the energy transition space, they were in the recycling space, they were in the EMS space. Now, all of those stocks had very high valuations. The valuations have come off. Is that still a no-go pocket? Companies which might be trading maybe slightly expensive, but are guiding to strong growth for FY26 as well. Is it a no-go, or would you be selectively choosy here?
One has to be very careful there, Neeraj, because as the froth unravels, the fact is, I'll just give you a slightly bigger picture context. In the last 3 years, about 300 odd companies have done IPOs stroke QIPs. My experience with previous bull markets is when growth is strong, you have this large number of new companies coming to the markets. Eventually, when the bull market ends, I still think we are mid-cycle in this bull market. Started in 2020, we are in 25. I still think this bull market has another 4-5 years. But eventually, by the end of this cycle, 25% of those new companies will go bust. So one has to be very careful, just not looking at the next 4 quarters earnings, but more importantly, what is more important at this point of time is the durability of business models. A lot of business models are untested, untried, and fragile, and they're business models which have come to the capital markets in a strong economic cycle and probably do not have the resilience to survive a bad economic cycle. And probably markets in that context are mispricing a lot of these stocks.
All right, Mr. Murarka, with respect to consumption, now that the tax relief has been announced in the budget, we are expecting some kind of boost in the consumption space. But what are the select pockets that you think, look attractive right now? Is it the staples that you're looking at? Is it the QSR space, the retail space, or even these new age tech platforms? What's the view like, and what pockets are you liking right now?
I think one is better off with staples and discretionary both. I'm saying staples at this point of time because the last 2 years growth in staples have been very meager. And I think as we start seeing revival in consumer sentiment and consumer spends and moderation in inflation, trickle-down effect of lower interest rates, higher employment and tax cuts flowing into the consumers' pockets over the course of the year, we'll start seeing, I would expect, some recovery in consumption. So staples would benefit because a lot of consumers over the last 2 years have significantly downtraded because of the high inflation and income levels not keeping up or real wages declining in that sense. So staples should see a recovery, and discretionary consumption should definitely see a significant recovery because of recovery in consumption or consumers having more money in their wallet. As far as digital companies are concerned, I think it's more company specific because each company has its own categories and business models. And the point there is the business model there are very evolving because the competitive dynamics and intensity is very steep and competitive dynamics keeps evolving. So I think that as an industry or that space is still not stabilized. For example, when we talk about beauty, now all of a sudden we have another round of competitive intensity because of Shein coming in and so on and so forth. So I think the challenge in that space in the D2C is that the competitive intensity is still yet to stabilize in that, which effectively gives us a sense that the competitive intensity will remain high in that space. So one has to be very careful in picking the right company, right business model, apart from valuations.
Pankaj, really appreciate you joining in, but an important day to have sane voices, and that's why the request. Thank you so much for taking the time out.
Thank you, Neeraj. Always a pleasure talking.
Likewise. And Mahima, that's somebody who's looked at many cycles and was constructive, is now saying that yes, we might find a bottom at some point of time, but there's no necessity that it will happen next week.
Right.
And there's no necessity that it will bounce back immediately. The bounce back could be more back-ended.
Back-ended, absolutely. And I hope that's, it comes soon. The bounce back should come soon. I mean, everybody out there is hoping for that. Let's also take a quick check on how Asian markets are doing. Let's pull up those indices. Shanghai is down by about 1.8 odd %. There's Nikkei, which is down by about 2.9 odd %. Kospi is also down by about 3.2 odd %. There you go. There's Hang Seng, which is also down by about 3.35 odd %. So all Asian market indices are down within the range of around 2 to 3 odd %. And that is also, having a sequential impact on the Indian markets as well. Now, in terms of some stocks to mark, let's pull up the NSE 500. And see the counters, and BSE is also one of the counter, of course, to keep on radar. Let's pull up the BSE share first and then pull up the NSE 500. The BSE shares are down by about 9 odd % today. And if we can pull up this 6 months chart as well for this particular counter, because BSE today is down by about 9 odd %. In the past 5 days, it's down by about 18 odd %. 1 month, it's down by about 11 odd %. And the BSE 500 stocks that you are seeing on your screen, this is the BSE chart, of course, down by about 9 odd %. In terms of the 6 months performance, however, it's been up around 69 odd %, but last 1 month has not been looking good for this particular counter. But with that, with persisting tariff fears, Trump has now confirmed that tariffs on Mexico and Canada will begin as soon as March 4th, triggering worries for the investors across the globe. We are now joined by my colleague Tamanna to outline macro factors which are hurting the sentiments. Yes, Tamanna.
If you're wondering why markets are behaving the way they are and where this fresh scare is coming from, look no further than the announcement made by US President Donald Trump. So all of this time since Trump took over as president for a second time, he's been talking about tough tariffs, and the street has been working with the assumption that this is more of a threat than something he will follow through. Now it's becoming clear that he will follow through, because here's what's happened. He's announced that 25% tariffs on Mexico and Canada, which were put on hold for a month, will take effect from the 4th of March. In fact, an additional 10% tariff on China, which he had also announced and put on hold, will take effect from the 4th of March as well. So this first set of tariffs are now going to be put in place. Furthermore, the reciprocal tariffs he talked about, which is that the US now charges the same duty that any country charges on their products. So matching those tariffs, that will come into place from the 2nd of April. That is where all countries, including India, have to be wary. Now, what is India doing so far? India is weighing tariff cuts on electric vehicles and luxury goods. This is a story we first broken here on NDTV Profit. The government panel will also be reviewing tariffs on US goods by March 15th. So on our end, India is preparing for a possibility of Trump tariffs. But having said that, there have been a lot of strong responses from around the world. So Canada, for example, the Canadian PM, Justin Trudeau, says Canada will have an immediate and extremely strong response. That is one set of responses which has come in. Of course, the European Union will also come out and respond. The EU has threatened to impose tariffs on US goods if Trump imposes new tariffs. So we are going into a situation which might turn into a tit for tat. Now, global trade war could simmer. So this is why markets are spooked. Of course, number one, you're looking at the possibility of a global trade war. Tariff wars, protectionist policies could slow global economy further. And then if that happens, that impacts pretty much every country, which is why you're seeing Indian markets react the way they are. In fact, listen in to what President Trump said.
The drugs continue to pour into our country, killing hundreds of thousands of people. We're losing substantially more than 100,000 people. I mean, dead. They're dead. The families are destroyed after that happens. So it's, it's not just that. That's the ultimate. But the families are absolutely destroyed. The drugs come in through Mexico. They come, a lot of them, not all of them, but a lot of them come from China. And that's why we did that. It's 10 plus 10. In case, was there confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10. And I think you're going to see, eventually you're going to see drugs stopping, because the country should not be allowing those drugs to come into the United States of America, and we're not going to allow it to happen. So that goes on the 4th of March. And then on the 2nd of April, we have reciprocal tariffs. That's reciprocal, where we charge countries what they're charging us.
All right. Now, another set of stocks that are not doing today is the IT pack, because all is not well for the entire IT space. The Nifty IT is down by about 4% and is seeing the biggest monthly fall since April 2022, and also trading at its 7th month low. Now, what are the major headwinds pulling the pack down? Rucha joins us with more details on that. Rucha?
The major headwind is number one, high US consumer inflation expectation. Now, this would mean a delayed rate cut. Number two is the discretionary demand, which the revival of which may be pushed away because of high expectations of inflation. And thirdly on my list is Capgemini's CY25 guidance, now which implies more uncertainty, which came out a couple of weeks back. And the thing which came out 2 nights back, that is NVIDIA's earnings, which was disappointed the street, and that is why the IT pack was down or volatile yesterday and is down in today's trade as well. The stocks that have fallen the most in 2025 include, at the top is Coforge, down about 26%. Remember that Coforge was one of the stocks which outperformed in calendar year 24 along with likes of Persistent. Persistent has been down by about 19% since the start of 2025. So largely, if you can see on your screen, the mid-cap names like Emphasis, Persistent, all are the top losing stocks since the start of 2025, and the ones which have lost the least include Infosys, Wipro, LTTS, down by about 10%, 6% and 3% respectively. Now in terms of valuations, while talking about the top tier companies, TCS trades at about 24.5 times FY26 PE, which is below its 5-year average. So if you look at the top tier IT companies on your screen right now, you will see that most of the top tier names are trading at or below their 5-year average, except for the like of Wipro, because Wipro and HCL Technologies have run up a lot in last 1 year. That is why these are not trading actually below, they are trading above their 5-year average. But the likes of Persistent, LTS and Emphasis, the mid-tier IT names, these are trading well above the 5-year average. Persistent is trading at around 50 times versus 38 times its 5-year average. So a lot of valuation concerns around the IT companies are also hitting them up right now. Now, lastly, let's look at what growth commentary they gave in the third quarter. Well, TCS mentioned that they are seeing early signs of revival in discretionary spending, especially in the banking and the retail space. Infosys also mentioned something on similar lines, wherein they are starting to see some positivity on the discretionary spends. HCL Technologies as well mentioned that improvement in discretionary spends is what they are looking forward to, and the tenure of deals are also getting shorter. But this was as on January, after which the 4 to 5 triggers which I mentioned at the start of this conversation have actually hit the IT pack as a whole, and therefore the next earnings seasons, that is the fourth quarter earnings season, will be very crucial, especially the commentary and what kind of guidance are they looking forward to in FY26 is of utmost importance for IT companies.
All right, thank you so much for that, Rucha. As she rightly mentioned, Q4 commentaries will be something to watch out for the entire IT space. Also, the global cues for IT not looking very nice with respect to the Capgemini results as well as the Nvidia numbers, and of course Microsoft, pointing towards shrinking of their data centers. All of these things combined is something that's hampering the entire IT space. Now, moving on to global narrative is against emerging markets, says Tahir Badshah of Invesco Mutual Fund when asked about his market outlook amid the bearish market sentiment and Trump's tariff decisions. And also here a view coming in from Harold van der Linde of HSBC talking about the US economy.
From the domestic side, I would like to argue that some of the requirements which the market has been looking for, especially from the point of view of restoration of growth, as well as in terms of, somewhat milder regulation, again, from the objective of trying to ensure that growth makes a comeback, have been put into motion, both in terms of, whether it be in the form of interest rates or whether it be in the form of, regulatory moves by the RBI and so on, and trying to ensure that liquidity in the system is improved and so on. And we all know about that. I think some of these things will probably take a little bit of time to percolate down into the system. My sense has been that, we are going to see this first half of calendar year 25 continue with some of these things. I think the bigger problem is the global overlay at this stage. I would like to think that some of the domestic counter-cyclical measures have probably already been taken in order to, restore back growth. Whether it proves to be cyclical or structural, we'll have to see. But at least we can, there are some of these measures which are probably, are likely to start paying off as we roll forward. But I think the narrative globally is obviously against us, is against most emerging markets at this stage, including ourselves, and especially when we have been at the other end of the spectrum as far as valuations are concerned. I think that is resulting in what we are seeing in front of us on a daily basis today.
All right, with that, we're completely out of time on this edition of Markets at 12. But stay tuned to NDTV Profit for more news and updates on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
बजट भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome to Profit Buzzers. My name is Puneet Zaveri and with me is Rucha Somaya, and together for the next 1 hour we will take you through the main key updates of what's been about the market and cover some of the most buzzing stocks in trade today. Let's first look at how the broader markets as well as the main indices have been performing. Let's pull up the Nifty 50 first, because we've seen a lot of pain in the market today. Starting since the session itself, we saw roughly about 500 to 600 points going down in just the first 5 minutes, and from then the downward trajectory has been on the Sensex. While on the Nifty, we can see that the bottom was roughly at 22,217, currently at 234, so not too away from the day's low as well. But it's been that kind of a day. It's been a lot of pressure for a lot of stocks. The Sensex down more than 1,000 points in trade today. Let's first quickly look at the top contributors of the Nifty, because you will see a lot of names there which will be on the downside. We have Infi as one of the biggest losers there, and we'll talk about that during the show. But Bharti as well as TCS, so IT definitely taking a knock. Mahindra and Mahindra as well. Before the numbers for February come out tomorrow, it is down in trade today, while the others also have seen a lot of pressure in trade. Apart from that, the whole auto pack as a whole today is also in focus because of the numbers as well. But if you see the Nifty auto, there you go, roughly about 2 to 4% of down move across the players. And I also just want to pull up a few more. Apollo Tyres, we can see roughly 2.64% down. MRF, all these stocks have today like a clutch of stocks. So Tata Motors, Apollo Tyres, Bosch Limited, MRF, Hero Motorcorp, Bharat Forge, all of these stocks have hit a 52-week low today. JK Tyre again is one man, and if you can pull up the 1 year chart of JK Tyre as well, that's one of the most stocks in the tire space that's been hammered, down almost 4% today. If we can bring up the 1 year chart, I think that will show us the pressure that the stock has been over the last year, so down almost 47% in trade today. But we are also seeing a lot of moves on the mid cap and the small cap space, Rucha, and that's also been under pressure as well.
As you said, blood path across the markets is what we are looking at here right now, and that definitely is not great. Nifty mid-cap 150 down about 1.5%, small cap 250 down about almost 3%, and mid and small caps are the ones which started the downtrend over here. But let's also look at the constituents of what are driving the mid-cap 150 index down. If you can pull that up, you'll see that the top losing stock is Patanjali. Well, it actually hit about lower circuit in today's trade, but it's a little bit off the day's low. This is also followed by Reddington. This one is an IT company, Century Textiles, Deepak Fertilizers, but up in the green we have Jindal, Home First, and all this is actually, I'm talking about BSE 500. But moving on to what I was talking about, Nifty mid-cap 150, which are actually pulling the stock up, is Star Health as well, which is up about 3% in trade. Bandhan Bank, banking stocks were doing well yesterday, but as Puneet also mentioned, the banks as the index is also down in trade. But let's also look at the small cap index. Well, the small cap 100 index, this one is also not doing well. The kind of constituents that we are looking at is Zensar Technologies down about 7%, Piramal Pharma down about again 7%. So these are really big numbers, and if you look at the green side, we have City Union Bank, Blue Star, which is just up about 2% to 1%. So on the decline side, we have a decline of nearly 10% on trades, but on the green side, we have stocks which are trading largely flat or either 1 or 2% up in trade. So that's really strange about the markets, Puneet. But let me also focus on the Nifty IT pack. Well, IT has been taking a hit since last 2 sessions, and there are a lot of headwinds which are triggering this one. I'll start with the first one, which is high US consumer inflation expectation that came in a few days back, and the actual data will come out towards the end of the month. High inflation essentially means that the rate cuts would be delayed, and this would affect the clients' discretionary spending and in turn affect the top line of IT companies. So one of those headwinds is the US consumer inflation expectations, which were at a decade high. Next one is Capgemini's CY25 guidance definitely pointed towards a weak set of discretionary spending again, and therefore an uncertainty in the upcoming calendar year. Last one is disappointing NVIDIA earnings. NVIDIA earnings came in on Wednesday overnight and actually disappointed the street, and that is why Nifty IT was also volatile in trade yesterday. And as Puneet mentioned, Infosys is the top Nifty losing stock, as we could see. So definitely very much clear impact on how global cues affect the Nifty IT and a lot of Indian IT names. And let's also talk about the stocks which have fallen the most since 2025. As you can look on your screens, most of the mid-cap names, Coforge, Emphasis, Persistent, all have lost about 20 to 25% since the start of CY25, and mind you, these were the ones which were the top performers in CY24. Likes of Persistent, Coforge, these gave about 60 to 70% returns in the last year. So definitely pullback in terms of mid-cap IT names. But let's also talk about the top tier names. TCS, Tech Mahindra, Infosys are also in the same basket, down about 15% to 10% in trade. But the least losing one was LTTS, which is an ER&D company, but LTTS largely has been flat. Not much of returns, not much of downward returns has the stock given to the investors. But valuation is of a key concern, and this is what actually triggered the downfall, especially in the mid-cap and small cap space. Let's move on to the valuations bit. Most of the top tier companies are actually trading at or below their their 5-year average. But as you can look on your screen, the mid-cap IT names, LTM, Coforge, Emphasis, these are trading actually above their 5-year average. Coforge, Emphasis, 36.3 versus 24.4 times its 5-year average. So this one is definitely a concern over here. Persistent, look at Persistent trading at 50 times at FY26 PE, but 5-year average is 38 times. So this is the key concern, especially for the mid-cap space. The growth commentary in the third quarter earnings, as we can have a look, TCS has mentioned that they are seeing revival in the discretionary spending, especially in the BFSI and the retail space. Infosys also mentioned about the same. HCL Technologies also said that they are seeing improvement in discretionary technology spending, and the tenure of deals are also getting shorter. So So, largely the commentary over here is very much important, but mind you, this was in the start of January. But now what will be important is the commentary which will come out in April because of their fourth quarter earnings, and we'll definitely see what the management has to say, whether they are maintaining or, achieving the kind of guidance they have given for FY26 and what is their outlook for FY25 is what we will be looking at, Puneet.
Definitely, and thanks for that detailed overview as well. And, the Nifty IT as a whole, as we can see, has been under pressure over the last couple of months as well. But let's get in some expert opinion on that note. We spoke to some leading market voices like Harold Van Linde of HSBC as well as Tahir Badshah of Invesco. Listen to what they had to say.
Money is moving in the direction of the United States, but that is changing as well. So if we see that money is moving out of the US and bond yields come off, then money would go back into emerging markets. That could be a first positive for markets such as India. I mean, it would be positive for other markets as well. If I talk to foreign investors, the key concerns that come up are twofold. One is, what if there's something really bad with Indian earnings? Maybe it's worse than we think it is. That is just normal that comes up. If earnings are being downgraded, people just don't know where the bottom is. But the comparison we, for example, make is with Indonesia. Indonesia invested a lot, like India has done over the last couple of years, infrastructure, roads and railroads and ports and these sort of things. And that has led to increased competition domestically and a decline in margin in certain sectors. So is that something that will play out in India as well? That's uncertain for now. But I think it's fair to say that most of the earnings downgrades we've seen. The other concern that foreign investors have is what are the locals are doing? Because if they don't really want to buy these markets anymore, there could be that there's further downside here. So the foreigners are looking at the locals are looking at the foreigners. We still are not clear where the earnings are ending up. As you say, rightly say, some money has flown back into the US over the last couple of months or so. But I think that might be changing, actually.
From the domestic side, I would like to argue that some of the requirements which the market has been looking for, especially from the point of view of restoration of growth, as well as in terms of, somewhat milder regulation, again, from the objective of trying to ensure that growth makes a comeback, have been put into motion, both in terms of, whether it be in the form of interest rates or whether it be in the form of, regulatory moves by the RBI and so on, and trying to ensure that liquidity in the system is improved and so on. We all know about that. I think some of these things will probably take a little bit of time to percolate down into the system. My sense has been that, we are going to see this first half of calendar year 25 continue with some of these things. I think the bigger problem is the global overlay at this stage. I would like to think that some of the domestic counter-cyclical measures have probably already been taken in order to, restore back growth. Whether it proves to be cyclical or structural, we'll have to see. But at least we can, there are some of these measures which are probably, are likely to start paying off as we roll forward. But I think the narrative globally is obviously against us, is against most emerging markets at this stage, including ourselves, and especially when we have been at the other end of the spectrum as far as valuations are concerned. I think that is resulting in what we are seeing in front of us on a daily basis today.
Well, that was the view from HSBC as well as Invesco on this market correction as well as what's happening in the IT space. But let me get on our guest, Raghvendra Kedia, the founder of Prosperity Advisors. Raghvendra, thanks so much for joining us and very good afternoon to you. Let me bring up, the first question specifically on, the markets. Essentially, we've seen a lot of pressure for the small cap as well as the mid cap space. Any kind of view that you have, and then I'll get to IT in a bit. What is your view specifically currently on the markets as a whole?
Broadly, we believe that the correction has come too much and too fast, and there are some silver linings or some positive upbeat cues what we would take from here. First of all, we see that the US 10-year yields, which was the reason for the market sell-off globally, they are slightly cooling off. So that's a positive where we expect some kind of liquidity and inflows from the US and global markets. Second, the valuations look attractive for India. And as we start with the Q1 earnings, by April, we would see some kind of base effect to play and positivity to come in. There has been significant liquidity stimulus packages in China, which would actually percolate down for specifically to metal sector and the global demand coming from the China space. So that's again another positive. In terms of the local factor, there is a positive where the Ministry of Finance and the Reserve Bank of India are trying hard to push in liquidity measures where banking sector, specifically private banks, would lead the way. So we believe that all these global and local factors, along with some kind of reforms, push from Modi 3.0 with the policy continuity, could see their positive effect in the stock prices in the economy, and a bottom formation might happen with March month, and we would see a recovery in the overall market starting April, which will be a new financial year as well.
Mr. Kedia, one very quickly I want to ask, generally March as a month we see a lot of tax loss harvesting, that is why in most of the March month over the years we have seen a sell-off happening, but this is I think preponed to February. So do you think March could be a sell-off or some kind of recovery is expected there?
Well, Rucha, I would believe that it would be a middle of both things. The sell-off has been, as you said, preponed, and the recovery, which usually happens starting March, might happen in the second half of March. So it could be a slow lull March where we won't see significant correction or a significant recovery. I would be happy to have a pleasant surprise where the market recovers in the second half of March. So if I have to take where we would expect the first 15 days of March to just settle down and the entire negativity to pacify further, and the second half of March would be slightly positive signs, and starting April, it could be a recovery path for the broader market. So yes, there could be a lot of triggers in terms of tax efficiency measures or in terms of some bottom fishing happening or the final leg of sell-off from the global funds. But we are very upbeat about a recovery starting April.
We all would expect a pleasant surprise, isn't it? But I think the markets are actually shocking us than surprising. But lastly, on the IT pack, what do you think of the top tier names of IT? IT has been a bloodbath over the last few sessions and something which is related to the global cues. Very quickly, because I really want to move on to Coal India, which is up next.
So we believe US corporate tax rate cuts and some kind of order book flows from the US markets and the dollar strength would be positive for IT. We are bullish in the overall IT pack, and Persistent Systems remains our top pick with a 25% upside from current levels. So we are bullish on software companies and believe that mid-cap IT would outperform.
Okay, thank you so much for that. But let's get to our next buzzing stock, Coal India. This one is actually in the green midst the bloodbath that the Dalal Street is facing right now. And this comes on the back of the company announcing price hikes. Sumit, who's tracked this closely, joins in with more details.
Well, yes, Coal India would remain in focus given the fact that they have announced this price hike of around 300 rupees per ton, which will be effective from the 1st of May 2025. Now, do remember that yesterday on Heard on Street, which is the dealer check that we do, we had indicated that there is a possibility of a price hike announcement on Coal India. So do keep watching NDTV Profit and stay tuned to the Heard on Street segment on India Market Close at 2:30 p.m. Now, this price hike which has been implemented is on the entire volume which comes out from one of the key subsidiaries. Now, that is NCL, that is Northern Coalfields. Now, this subsidiary produced nearly 136 million metric tons of coal in FY24, which is nearly 18% of the overall sales volume of the company. Now, about 86% of this coal produced is dispatched to power sector, and its main product includes non-coking coal. Now, as per the company, this will increase the overall Coal India's revenue by close to 3,877 crore rupees, and analysts believe that this entire amount of top line will flow through to the company's EBITDA, and that will aid the company's FY26 EBITDA by in fact around 8 to 9% as per their estimate. Now, do remember that the last price hike by Coal India was taken back in Jan 2018 for lower grade coal, which is nearly 70% of the total volumes for the company, and this is mainly used for power generation. So this price hike announcement coming in is quite positive for the company as per analysts, and they also believe that this price hike will offset any downtick in volume that they are expecting in FY26. However, if there's a volume uptick that comes in, then obviously the benefit to the EBITDA will be much higher as per the analyst.
Well, this one was up about 3.5% and now has actually given up most of the gains and is up just about 1.2% in trade. But Mr. Kedia, coming back to you, what do you think of Coal India? Well, mixed views from brokerages is what we had heard in the morning.
Well, we are upbeat about Coal India. First of all, the company has a very generous dividend payout of around 6 to 7% per year. And if you look on the valuation metrics, Coal India is clocking an earning per share on a full year basis of around 36 rupees. So at 360 rupees, the P multiple comes at around 10x, which is very attractive to invest at current levels. We believe that the volume growth would continue, and this price hike, which has come after 6 or 7 years, is a positive catalyst for good times ahead for the stock price. So we believe that a 20 to 25% upside, even from current levels of 370, is possible for a target of around 450. And icing on the cake, a generous dividend payout of around 25 rupees per year would also come in. So Coal India at 370 is a buy. It's a low risk, high reward stock at current levels.
High reward, yeah, well, definitely that is what investors are looking forward to, Mr. Kedia. So 450 is kind of the target that he's looking forward to. But another set of stocks which will be in focus is the auto pack. Well, the February auto sales numbers will start coming in from tomorrow, and we'll see whether the demand is still weak or has it been stabilized. Puneet, who tracks this sector closely, joins in with more details.
Well, thanks for that. So, it's been a quarter and a month as a whole of, slowdown in demand, and that would be visible. So it's estimated to be a weak as well as a subdued month in terms of sale. When you first look at, the biggest player, of course, I want to just pull out and start with Eicher Motors, expected to have a 12% growth on a year-on-year basis. And that's going to be one of the highest in this particular month. And that is, of course, led by the company's change in strategy post quarter two earnings to focus more on sales rather than EBITDA margins. That is, of course, has impacted the stock post its quarter three earnings with a margin fall of about 120 basis points. But, in terms of sales performance, it is expected to have another strong quarter, more than 80,000 units. That was the target. Apart from that, I want to address TVS Motors as well. 8.61% growth is expected as per analyst. And what's interesting is that most brokerages have pointed out that scooter sales have actually been doing better compared to motorcycles in this month, and that has been one of the biggest beneficiaries for someone like a TVS Motors. They did launch the TVS Jupiter 110, and that has at least a 2-week waiting according to Motilal Oswal. They also see the Ronin bike has also done well. In terms of Bajaj Auto specifically, while the sales have dwindled in the last couple of months, in this particular month it's expected to have roughly 6% growth, and while that's lower than the company's target of 6 to 8%, it's still a decent set of number. The Chetak EV has also been doing well versus the Jupiter in some aspects, and the iQube as well, based on the metal body. So the new one, finally on Hero, it's been a disappointing year as a whole, and that trend continues. When you look at the passenger vehicle makers, Mahindra is expected to be one of the biggest beneficiaries and continuing its growth. While it's lower from the 20% we saw in the first half, at 13% it's the highest amongst the passenger vehicle makers specifically. We've seen that footfalls have been impacted in this particular quarter, and the rural market has been growing very well. So that's the reason we'll see Maruti also reports some growth. And when compared to someone like a Tata Motors, it's a decent growth for Maruti Suzuki as well. With Hyundai, it's continuing its negative sentiment as well. While Motilal has mentioned that the Creta EV has created excitement, the booking numbers aren't out yet, but it's expected to be a subdued start. At least it's hoping to pick it up later on. When you look at the commercial vehicle makers, again, it's a year that was expected to have lower growth because of elections among other key factors. And in this particular month, we're going to see VECV as being one of the biggest beneficiaries over a double-digit growth. That has been one of the trends that we've seen over the last 4 months as well. And while the CV segment continues to be a slowdown, the smaller players are much more affected. Apart from that, the agri demand also is expected to pick up from March. So watch out for this. Apart from that, the other two players, the legacy ones, aren't expected to have a very strong show. And finally, on tractors, this one's going to be very interesting because Mahindra has been outperforming Escorts month on month in the last 9 months. So that's one of the key aspects. And what's going to be interesting is also that for Escorts, it is expected to have a better month, not a fall in this particular month. But yes, that is one of the key things to watch out for. So it's going to be a month where Hero and Tata Motors are expected to underperform, while on the upside, watch out for Eicher Motors and Mahindra as well as TVS to be the biggest beneficiaries and sales growth in this particular month.
Well, definitely wonderful analysis over there. Well, that were the kind of expectations of Puneet. But Mr. Keda, coming back to you, which one do you think will or might outperform and, would be a better bet for this financial year?
We believe that, as Puneet indicated, there could be some disappointment coming from Hero MotoCorp. And on the valuation metrics, if the stock comes to around 3,600 or 3,650, that could be a good entry point. We believe there could be a catalyst event in Hero MotoCorp where a subsidiary could get listed in the upcoming financial year. So that's a positive we look in terms of a special situation. And broadly, we are bullish on two-wheelers versus commercial vehicles or passenger vehicles, four-wheelers. So with that focus on two-wheelers being outperforming, Hero MotoCorp at levels of 3,600, 3,700 would become our top pick in the entire auto and auto ancillary space.
Okay, well, all right, let's also shift focus to Ola Electric. The February sales numbers reported was at 25,000, but the Vahan data showed around 8,390. Puneet, tell us more about this discrepancy.
Well, it's a very interesting space. Now, Ola Electric, like other automakers, does not report its wholesale numbers. This is actual retails, and that's because most of the stores that they currently have is their own. So when you look at the sales number, the company just about an hour ago released an exchange filings that they've had 25,000 in terms of sales of electric vehicles in the month of February of 2025. This is actual sales that people like you and me can purchase. But as you rightly said, the discrepancy is there with Vahan. Now, Vahan, of course, is the government portal which has the retail registrations of vehicles specifically or into two-wheelers as well as the four-wheelers as well as the commercial vehicle as well. And there the number that's visible in Vahan is 8,390. Now, why this particular discrepancy as well as what is something that you should watch out for? Now, the company has mentioned that, on February 19, they put out an exchange filing specifically. And here you can see this was the number from January. So it's a sizable fall of about 180% compared to the previous month. And the discrepancy and the key reasons mentioned is that they released a press release and an exchange filing on 19th of February that the registration numbers will be temporarily impacted in the month of February. What does that mean? That the sales will be continuing, but the registration won't happen in this particular month, and that's because there is an ongoing negotiation with two of its registered agencies currently, namely, it's a Rosmeta Digital as well as Shimit International Private Limited, and both these entities, they are under negotiation for registration aspects. What's likely to happen, and that's these vehicles will get registered in March, and we'll see a very inflated number there. But for now, it's expected to have, it's mentioned that sales is number, but this particular discrepancy is going to cause some kind of confusion in the market going forward as well. But the March number, which is expected to have a strong month essentially compared to last year as well, will be a very inflated number and have one-off as well. But watch out for this stock going forward as well.
Definitely, Ola is an interesting one. Well, this one is down about 2% in trade. Mr. Kede, Ola has been an interesting name, and there are a lot of mixed views about this stock. Investors, traders, everyone is confused about what to do with this one. What's your opinion?
Well, Ola Electric would be in competition with the giants like Hero MotoCorp, TVS, Bajaj Auto, and these companies go all in terms of their EV, where they have a distribution network of 50 years, a goodwill of 50 plus years, and a financial might much more than Ola Electric. So we believe that the competition, margin pressure, and overall sales for Ola would be very challenging in quarters ahead. Plus, the huge import coming in from Chinese players in the unsegregated, unorganized market for two-wheelers would also impact Ola Electric. So we believe that it is an avoid even in spite of the severe correction, facing stiff competition from Indian existing players and the overall imports of EV two-wheelers coming from China. So it's an avoid on both counts. Again, the market share is coming down. There is margin pressure, and this new data where there is a discrepancy for specifically to Feb month versus Jan month, where the Vahan data is significantly lower for sales, is a yellow flag for us. So we would avoid Ola Electric even at current levels.
Well, definitely a red flag over there at current levels, but it's time for a quick break. Do stay put. There's a lot of action on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American countries.
Welcome back to Profit Buzzers. Another stock in focus is Jubilant FoodWorks. After the company hosted their first ever in-person analyst meet, my colleague Mahima joins us with key highlights and what are brokerages saying about the analyst meet. Mahima.
Right. So, in terms of key takeaways from Jubilant's first physical analyst meet, they've showcased how they've capitalized on their tech in their business, as well as the pivot to building platforms to secure higher growth going forward. They have aspirations of double-digit revenue as well as profit growth. In terms of Domino's store count, management is confident that they'll, go to 3,000 stores by FY28. They're expecting a 200 basis points consolidation in net profit margin by FY28. This is something that the street has definitely not liked. In terms of targets, they are targeting to build food platforms of sales worth rupees 10 billion each. In terms of dine-in, the management said that they continue to see strong tailwinds, but management is confident of growth going ahead. In terms of Popeyes, once the unit economics is in place, the company can ramp up store expansion is the commentary that we've received. In terms of what brokerages are making out of these key takeaways, Morgan Stanley remains overweight with a target price of 781. What makes them bullish is, first, they expect outperformance to continue, which has been the case in the past few quarters as compared to the peers. Management's single-minded focus will drive the like-for-like growth, and top-line growth is in line, and it's with regards to keeping an eye on profitable growth as well. Macquarie, on the other hand, has maintained outperformance and cut target price to 575 from 600. What they're saying is that they're disappointed by the delayed margin recovery, and they've also cut their EPS estimates by around 4% over FY26 to 27. Jefferies has given a target price of 680. They remain excited about the growth agenda. Double-digit same-store sales growth due to innovation will continue going ahead as well, is what they're saying, and margin guidance, however, may disappoint. And lastly, JP Morgan has rated it neutral with a target price of 700. What they're saying is that it's like its initiative to strengthen competition is something that they like, but valuations cap is an absolute upside right now for Jubilant FoodWorks. So this is the overall view of key takeaways as well as of what brokerages are making out of Jubilant FoodWorks analyst meet.
Well, Mahima, thanks for that. Raghavendra, let me come to you first. In specifically for Jubilant FoodWorks, we have seen that while the demand trajectory hasn't been very strong, the stock is still up substantially over the last 1 year, about 30%. What is your outlook specifically on Jubilant FoodWorks and any kind of, future growth or guidance or anything that you can share with us?
Well, Puneet, if you look at the full year earning per share, EPS of Jubilant FoodWorks, Domino's Pizza, what's primarily more popular as, the full year EPS stands at 4 rupees, which is very trivial. If you see, that gives a P multiple of around 150, 160 times to the EPS. That's astronomical valuations. That doesn't give us any comfort. Even the promoter holding of 42% is not very comforting. So on a very high expensive valuation metrics, we would avoid this stock. Now, if you want to buy a pizza earlier, if you want to get it home delivered, Jubilant FoodWorks or Domino's Pizza was a most popular or only choice you would have had. But with this QSR and Swiggy, Zomato's giving you a plethora of choices in terms of many different pizza brands available online, which could be faster or cheaper, there is some kind of pressure which would come into the volumes and market share for Jubilant FoodWorks primary pizza sales in the years ahead. So versus a cloud kitchen model, it is a Jubilant FoodWorks Domino's is an asset heavy model that is also a concern for us in the quarters ahead. So at expensive valuations of 150 times P multiple, we would avoid the stock even at current levels in spite of the correction in the stock prices.
Raghvendra, on that note, let me welcome in Akshay Bhagwat as well. Akshay, before I come to you, let me just go across to my colleague Mahima again, because as summer knocks on, we'll see the summer stocks sizzle or fizzle out. That's going to be one of the key questions. And what are some of the stocks that you need to watch out for? Mahima brings us the full list.
Right, so there's a whole host of stocks, that can benefit from the summers coming in. It's already February and heat waves are being issued. And now there are different pockets in which I've divided these stocks. First up is beverages. Varun Beverage, which is one of the largest franchisee of PepsiCo in India. There's United Breweries, which manufactures both alcoholic as well as non-alcoholic beverages. And beer, largest largest market share is garnered by United Breweries. Tata Consumer, on the other hand, also, sells water under the Himalayan brand. So Tata Consumer will also be in focus. In terms of juices, Dabur, 15% of revenue for Dabur comes from juices, both the brand that is Real as well as Active are Daburs, and around 53% of market share for juices comes from Dabur. ITC operates under the brand of Be Natural, and around 5% of market share is garnered by Be Natural in juices. The next line of segment is bottling as well as packaging companies. AMD Industries is one of them. It packages articles being used in soft drink, beverages as well as water, beer and liquor as well. In terms of Hindustan Foods, it's one of the most diversified FMCG play and manufactures for marquee brands in India. And Orient Beverages is the one who supplies bottles and packaging for Bisleri. So all of these three counters will be in focus on the back of packaging. Now in terms of ice creams, Vadilal Industries will be in focus. Around 16% of total organized market share is held by Vadilal. And Hudson Agro is very big when it comes to southern markets because they have a strong hold in the southern India. In terms of AC cooling systems, Voltas, Blue Star, Symphony, Lloyds, Whirlpool, Johnson Hitachi as well as Orient Electric will be in focus for selling their ACs, refrigerators as well as coolers and fans. And lastly, Prickly Heat Powder, Imami will be in focus. Dermicool plus Navratna, both of these brands are of Imami, and around 40% market share is garnered by them. And lastly, Zydus Wellness will be in focus as Nycil has around 34% market share. So all of these counters, combined together, will be in focus on the back of summer kicking in.
Well, thank you so much for that. Let's welcome in Akshay Bhagwat, the Senior VP at GM Financial Services. And yes, along with us is Mr. KDS still joined in. Thank you so much for joining us, gentlemen. Definitely, Akshay, my first question to you will be around the markets first. What are the charts looking like? Do you think that this will come down to the support level of 21,800 or still there is room for upside?
Good afternoon. So the new FNO series, that's the March series, has started on a very, very sad note, you can say, because the way the market breadth is today is kind of mind-boggling, the kind of sell-off we are noting in the mid and the small cap space. And the Nifty index, in all likelihood, is heading for the key support zone of 21,800. So probably this is the sixth month as we enter March, which starts off on a very bearish note. And looking at the broader parameters, I believe there has to be some bit of a respite bounce once it reaches the levels of 2800. So yes, if you were to ask me what is the probability of the bounce, the probability is very high. But from where we are currently trading, there is still more room of 200 to 300 odd points. So that's still the last leg of pain point which is left in the market. So yes, be ready for bargain hunting. But levels 21,800 to 21,900 are the vital zone from where you can expect some bit of a relief rally in the market.
Raghavendra, would you also feel like these summer stocks that we spoke about, a lot of plays here, apart from FMCG, the AC ones are expected to have a good quarter as well. Any of the names that you like? And let me just pitch in the EMS companies as well, the likes of Amber, EPAC. Do you see these ones also gaining share in this particular quarter?
Well, most of them are beaten down with the overall market correction. So if there is any recovery in the market, we could see some price pop coming in entire pack, be it the summer stocks across white goods or beverages or the manufacturing EMS space. What we particularly like is Tata Consumer Products Limited in the beverages space, where they make the Himalaya brand and actually the Copper Water brand also in a few states of India. So Tata Consumer, which has corrected from 1270 levels to 970, on the large cap space, that remains our pick in this summer sizzling stock. And on the electronic part of it, we believe Havells, which owns the brand Lloyd's air conditioner. So it is now owning the white goods brand of Lloyd's, which has a very good presence. And the recent correction in the stock price due to the announcement of Ultratech into wires and cable business has had some impact, or in terms of some price impact on Havells. But we believe that the stock has corrected to levels of 1400, 1410, which makes it a very good entry point. And any pop in terms of the market recovery could see significant upside in Havells to levels of around 1600 or 1650. So that is a 15 to 20% upside, we believe, in the next 9 to 12 months in Havells. And Tata Consumer Products would be another stock from the entire stocks we discussed in terms of the summer sizzling stock or the sector. If you take it as a whole, beverages, Tata Consumer Products, and white goods, Havells India.
Got the view, and very interesting view, Raghavendra, on Havells. As a stock, it's not done too much after falling from its highs. But and the business momentum also hasn't been very strong for the Lloyd's brand as a whole. But another stock in focus is Indigo, as the company has seen strong air traffic in January of 2025 with domestic market share of almost 65%. My colleague Somit joins in with more details on the same. Somit.
Well, yes, Indigo is standing out amongst today's trade. In fact, that stock is still managing to stay in the green despite the weakness that we are seeing in market, and that is purely on the back of two factors. Firstly, the air traffic data that has come in for the month of January, which suggests that Indigo's air traffic has been pretty much solid. If you look at the industry growth, it was around 11% on a YY basis in the month of January, while Indigo's air traffic has grown nearly 20% on a YY basis. So clear 900 basis points beat that we are seeing compared to what the industry growth was. Apart from that, the company has seen a slight increase in its market share at around 65%, while its passenger load factor, which is a measure of capacity utilization, remained at the higher level of around 90% in the month of January. The second factor is the fact that Axis Capital has also upgraded its rating on the stock to buy from add, and have also hiked the target price to 5,450 from an earlier target price of 5,100. They are saying that Indigo is the best play on rising discretionary consumption. The focus on the company's focus on gaining international market share is quite strong, and domestic market share is also remaining pretty much stable. They're expecting yields, which measures average fare per passenger per kilometer, to remain stable going forward, and they are saying that aircraft addition will be gradual, but it will be stronger for Indigo going forward compared to other players.
Thanks, Amit, for giving us those key details as well. Let me get an Akshay Bhagwat first. Akshay, I just have a two-pronged question. One, definitely on Indigo, what does the chart suggest? And also, what Raghavendra mentioned, that the cables and wires segment yesterday saw a deep correction across stocks like KEI, Polycab, RR Kabel, and some impact on Havels as well. If you could give your technical view on both these aspects and what should investors do as of now based on charts?
Yeah. So first of all, on the price chart of Indigo, well, from a short to medium term front, the view is neutral. It's trading in a range which we call this as a symmetrical triangle in technical parlance, 4600 to 4100. This is the broader range from a short to medium term scenario, but the longer term charts are still strong. So the advice is to hold if you are positionally placed with an investment perspective. Your stop loss will be 3800, and the expectation is that the stock should stage a breakout soon above 4600, post which you might see levels of 5000 to 5200. Now moving on to the cable and wire space, we are looking at stocks which had a serious correction after the news. And here, if you were to look at stocks like Polycab, clearly the technical setup is weak. And if one were to hunt for supports where there could be some respite buying, they're pretty far off. 4000 is the level in Polycab, which is an important support. I think from a risk reward payoff, those will be good levels to get into the stock from a positional perspective. And for KEI Industries, which was the other stock which took a strong hammering, again, a triple top breakdown has seen strong selling on the technical price charts. But here, 2750 is the nearby support from where you can expect some bit of a bounce back. So out of the two stocks, if I have to select one, then I would go for KEI Industries because the support is pretty close by and the broader charts are still strong from a long-term perspective. So 2750 is the level where you can consider buying KEI Industries.
Thank you so much. We have our next set of stocks around order wins, and Anushi has tracked this closely, joins us to give us more details.
A clutch of order wins in focus. First, I'll start off with Transrail Lighting. Now, the company has secured new orders worth about 2,750 crore, and this is mainly in the transmission and distribution business that we are looking at. The year-to-date order inflows with this has crossed the 7,400 crore mark, which marks again a 90% of a growth compared to last year. If you look at the unexecuted order book of the company, that stands about 11,500 crore. This is as of the December 24 figure that we are looking at. The next one in focus is Cornex Microsystem. Here, the unit has been awarded a 325 crore of a project by Southeastern Railways. And if we consider the 9-month FY25 revenue of 106.7 crore, this is a significant order win that we are looking at. The project is to install the coverage on 688 route kilometer and covers various sections and divisions with the expectation to complete this project within next 1,000 days. In the railway space only, the Rail Vikas Nigam is also in focus. RVNL has received a letter of acceptance from Central Railway for a 136 crore of a project, and this is to build a new power station to help trains carry heavier loads on the line. This includes designing, supplying and setting up all the equipment. If you look at the order book of the company, that stands at about 97,000 crore, and the management in FY26 expects the order book to reach the 1.5 lakh crore scale. Last one in the focus is PSP project, wherein the company has got work orders worth 1,764 crore, and they have received work orders from Adani Airport Holdings worth about 647 crore, which is to be executed in next 18 months. Along with that, there are a couple of other orders as well in the 1,764 crore orders that we are looking at. This includes construction of Adani Medicity for Ahmedabad, Adani Realty for Ahmedabad residential project, as well for design and construction of leadership worth about 147 crore from Adani Enterprises, and another work order worth about 223 crore from Ahmedabad International Airport. If you look at the order book position of the company, the total order inflows stood at about 3,478 crore, and the order book as of the December 24 figure stood at 6,417 crore. So these are the couple of orders in focus in trade today.
Well, for sure, but definitely these are the stocks which are not doing well in trade. Mr. Keda, what do you think of the likes of RVNL? This has been beaten down a lot, but good prospects is what the street analysts estimates.
Well, the order book is impressive for RVNL, and we believe that as far as we have Mr. Ashwini Vaishnav as the Minister of Railways, whose big focus is on railway automation and overall upgradation, the overall rail sector would continue to do well in terms of their order book growth. This recent price correction, we largely believe, is where they have these rail stocks or PSU stocks went up too fast in the entire 2024, 2023. And there has been some kind of profit booking and market-driven correction. But RVNL at levels of 330 is attractive. Translate lighting, if you see at levels of 520, is not expensive in terms of valuation metrics. So we believe that as far as the order inflow is robust, as far as their execution track record is impressive, we can stay invested in these stocks. And if you are not owning, well, this price correction can be taken as an entry opportunity in overall rail specific stocks.
Okay, well, also let's take a look at some other sectoral action. Hyderabad-based pharma player Granules India will be in the spotlight after US FDA has issued a warning letter to its facility in the state. Varsha will join in with more details on how will this impact the company and more.
Granules will be in focus today as their Gagillapur facility has received warning letter. Now, earlier in December 24, the US FDA has classified Gagillapur facility as official action indication, that is OAI status. Now, following this OAI status, facility on 27th Feb had received warning letter from the US FDA. Now, this is a very big news for this company. Let's see why and what this warning letter means. Now, if you see that currently there are 10 pending approvals from the Gagillapur facility which will get impacted. The newer filings are being done from Vizag and Granules Life Sciences facility. Now, why this is important? Because Gagillapur is one of the largest single unit manufacturing site which contributes almost 60 to 65% to the overall revenue of the company. Facility has capacity of 23,200 tons per annum of formulation intermediates and 26.8 billion units for finished doses. Further, FDA action, that is import alert, could impact supplies. Now, till date, if I were to speak, Granules has gone through almost 24 US FDA inspections since 2009 and Gagillapur facility has been inspected 6 times. Lastly, if you see, the company is engaging with third-party independent consultant for a detailed review of the site cleaning protocols and cross-contamination controls. It has also started working closely with additional independent experts to develop and implement protocols that reinforce best practices.
Well, thanks for that, Varsha. Akshay, let me come across to you first. We've seen stocks getting impacted today on the back of news flow, and Granules is also one of them. Any kind of view that you have on Granules, as well as let me get from the previous Anushki mentioned on Kernex system as well. Both these stocks seen a lot of price movement. Any kind of outlook on of charts on both these stocks?
So Granules, the technical price chart reading is negative, and we had a fresh round of selling after it broke past the support zone of 530. This happened a couple of weeks back. Currently, the targets which are coming based on the price projection is roughly around 400 to 420 zone. So you can expect some more pain to go from the current levels of 468. Probably 400, 420 is where the stock may see some kind of buying action. Moving to Kernex systems. So Kernex Microsystems, here the price structure is negative but highly oversold. So there's a very high probability that it is nearing a potential support zone of around 750 to 780, from where you can anticipate some strong pullback in the stock. Expect a bounce back from the supports I have given. Hold the stock from the current levels or consider averaging it in case you have, because the bounce back can easily see a recovery till 900 to 925.
You, Akshay, Raghavendra, any kind of outlook that you have on Granules as well as anything on Kernex system as well, because a lot of price action there, but fundamentally, what is your view on these stocks?
Granules, we would definitely avoid. We would avoid catching a falling knife, and this US FDA violation notice is not the first time this plant has got. So prevention is better than cure. The company could have taken and should have taken some measures to have this violation or not being happening at all. So we believe that there could be further price negativity impact in terms of Granules India. Kernex has been beaten down significantly in terms of price. So we would wait and watch for some kind of recovery. So it's a hold approach on Kernex Micro right now. But on Granules India, we would continue to avoid in spite of this recent price collapse. And we believe that this could continue further in the days ahead.
Got that view, but Raghavendra as well as Akshay, thanks so much for joining us and taking us through a whole host of these queries. We look forward to our next conversation. Thanks so much for joining us today. But with that, viewers, that's all the time we have on this edition of Profit Buzzers. Stay tuned to NDTV Profit for more.
very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Powered by Canara Bank. Together we can. And National Insurance Company Limited. Trusted since 1906.
जब भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day.
Hello and welcome. You are watching Top Trades on NDTV Profit with me, Somit Sarkar. Well, the markets continue to remain at the day's lowest point. The Nifty is down 1.9% in trade, while when it comes to the mid and small cap indices, they have fallen more than 3% in trade. When it comes to the FNO stocks, few stocks that are still managing to hold on to green, it's City Union Bank, Coal India, Shriram Finance, HDFC Bank and Bandhan Bank. But on the losing side, there are many names that have been worst in trade. In fact, if you look at some of the top FNO losers today, it's BSE, which had hit a lower circuit of 10%. Patanjali Foods, first day enters the FNO space and the stock is down around 10% in trade. Irida is down around 8%. Granules decline on the back of the warning letter that it has received for its Gagillapur plant. Tata Tech, MCX, IndusInd Bank all down around 6 to 7% in trade. Well, when it comes to sectoral indices, if you look at Nifty, all the sectoral indices in fact are in red today, but Nifty IT has declined the most, followed by Nifty Auto among the major sectoral indices. Well, let's also welcome in Naresh Solanki, the head fundamental research with Anand Arathi, and try to understand what has triggered the fresh shots in the market. Well, coming to you, sir, firstly, what are the new reasons that could have led to this kind of a fall in the markets?
Yeah, good afternoon. I think the ongoing global volatility, especially the announcement of additional tariffs, 10% tariffs by Trump in China, has actually impacted the global markets in a sense that a lot of these tariffs, what actually they will do is that they will initially in short to medium term force various companies to revamp and restructure their supply chains. And this actually impacts the overall manufacturing supply chain for all the global companies which are operating in more than one country, and realign all their sourcing places and their manufacturing places. So initially it would be a turbulent and it would definitely impact negatively for the global growth. So these are the factors which have been one of the key reasons. And the second is the sustained FI selling by the FIs. If you look at the data of last 4 to 5 months, then you can clearly see a big picture, which is that a lot of funds are selling across the Asian markets and are going back to either US or European markets. If we talk about the FI flows and the ETF flows, so this has been happening for 2 to 3 months, and this is again due to the fact that global volatilities, especially post the Trump administration coming back to the power, is also adding to this. So I think we have been seeing these short-term volatility impacting even our markets as well.
Right. So one stock specifically that I wanted to discuss with you was BSE. It's a top FNO loser in trade. It's down around 10%. Is weak markets the major reason behind this fall?
First of all, we do not have any recommendation on this stock or coverage, so can't comment on the price. But I think broadly what we have been seeing is that a lot of large cap space, the companies who have been trading at a premium valuations have not been able to sustain the valuation because of the sentiments in the market, and a lot of valuation derating is also happening across different sectors. So today's fall might be because of that. Plus, if you see the overall market turnover in the market, which has also fallen significantly, especially in last 3 to 4 months, so that could also be ringing bell for the investors in order of how the results might come in the near future because of that, and what could be the impact of lack of trades or volumes happening in the market.
Right. Well, IT, as I was talking about, is the top sectoral loser in trade. It's down over 4% in trade, the biggest monthly fall that we have seen since April 2022. What are the major headwinds pulling the pack down? Let's get in Rucha to understand more.
The major headwind is number one, high US consumer inflation expectation. Now this would mean a delayed rate cut. Number two is the discretionary demand, the revival of which may be pushed away because of high expectations of inflation. And thirdly on my list is Capgemini's CY25 guidance, now which implies more uncertainty, which came out a couple of weeks back. And the thing which came out 2 nights back, that is Nvidia's earnings, which was disappointed the street, and that is why the IT pack was down or volatile yesterday. And is down in today's trade as well. The stocks which have fallen the most in 2025 include at the top is Coforge, down about 26%. Remember that Coforge was one of the stocks which outperformed in calendar year 24 along with likes of Persistent. Persistent has been down by about 19% since the start of 2025. So largely, if you can see on your screen, the mid-cap names like Emphasis, Persistent, all are the top losing stocks since the start of 2025, and the ones which have lost the least include Infosys, Wipro, LTTS down by about 10%, 6% and 3% respectively. Now in terms of valuations, while talking about the top tier companies, TCS trades at about 24.5 times FY26 PE, which is below its 5-year average. So if you look at the top tier IT companies on your screen right now, you will see that most of the top tier names are trading at or below their 5-year average, except for the like of Wipro, because Wipro and HCL Technologies have run up a lot in last 1 year. That is why these are not trading actually below, they are trading above their 5-year average. But the likes of Persistent, LTS and Emphasis, the mid-tier IT names, these are trading well above the 5-year average. A Persistent is trading at around 50 times versus 38 times its 5-year average. So a lot of valuation concerns around the IT companies are also hitting them up right now. Now lastly, let's look at what growth commentary they gave in the third quarter. Well, TCS mentioned that they are seeing early signs of revival in discretionary spending, especially in the banking and the retail space. Infosys also mentioned something on similar lines, wherein they are starting to see some positivity under discretionary spends. HCL Technologies as well mentioned that improvement in discretionary spends is what they are looking forward to, and the tenure of deals are also getting shorter. But this was as on January, after which the 4 to 5 triggers which I mentioned at the start of this conversation have actually hit the IT pack as a whole, and therefore the next earnings seasons, that is the fourth quarter earnings season, will be very crucial, especially the commentary and what kind of guidance are they looking forward to in FY26 is of utmost importance for IT companies.
Right. Well, thank you, Rucha, for that detailed understanding on why the Nifty IT pack is down. Narendra, how are you looking at the IT sector overall? Do you think that the fall is much more than what it should be? And any value buys that you are finding at this juncture when it comes to the Nifty IT index? Any stocks that look attractive?
Yeah. I think during Q3 results, what we've seen is that IT was just starting to show signs of turning around, and things were looking good for the near to medium term. But since the recent data came in and the kind of outlook the Trump administration has would definitely have impact on their internal economy. If you see the latest jobless claims data and then the things happening in the technological front, where the outlook is also it looks like it's slowing down. So things have again started to behave in a manner wherein it again looks like it is not going anywhere, and it would again drag around. So things are looking big before they actually improve. So right now we have a cautiously positive kind of a look on the overall IT space, and we have a preference towards larger names in the overall space like TCS, Infosys, and HCL Tech.
Right. Well, another stock that has been in fact outperforming the markets, that is Coal India. Now, the major reason why the stock is up is purely the fact that the company had taken a price hike of around 300 rupees per ton, and this will be effective from the 1st of May 2025. Now, this price hike possibility actually was indicated on the Heard on Street segment that we had yesterday at 2:30 p.m. on India market close, and it actually came out to be true, and the price hike implemented is on the entire volume that comes out from the company's one of the subsidiaries, in fact one of the key subsidiaries, that is Northern Coalfields. Now this subsidiary produced nearly 136 million metric tons of coal in FY24, which is nearly 18% of the overall sales mix, volume mix for the company. Now as per the company, this price hike could lead to higher revenues of close to 3,877 crore rupees, and analysts believe that this entire incremental revenue would directly flow through to to the company's EBITDA, and hence the FY26 EBITDA could see an easy upgrade of nearly 8 to 9%. And they also believe that the last price hike was taken back in 2018, and post that we are seeing this price hike, so it's a major positive coming in for Coal India, and they believe that this price hike could easily offset if there is any volume decline that is seen in FY26. In fact, they also say that if there is a volume increase that comes in for the next financial year, then the actual benefit that would come into the EBITDA could be much higher than the 8 to 9% that they are estimating at this moment. Narendra, any views when it comes to Coal India?
Yeah, definitely this price hike is a positive sign for the company. And the only thing which was lagging for the company was the slowness in the volume pickup. But if you look at the overall picture of the power sector, and then I think a decent volume growth of around 4 to 6% should be there for next 3 to 5 years. So overall, things are well positioned, and post this price hike, I think it's a bit more sweetener for the investors.
Right. Well, another stock that remains in focus is Ola. The company came out with a statement where they're saying that the Feb sales were around 25,000, but there is a difference when it comes to the Vahan data. We have Punit joining us to explain exactly why this difference is there in the numbers reported by Ola and the Vahan.
Well, it's a very interesting space. Now, Ola Electric, like other automakers, does not report its wholesale numbers. This is actual retails, and that's because most of the stores that they currently have is their own. So when you look at the sales number, the company just about an hour ago released an exchange filings that they've had 25,000 in terms of sales of electric vehicles in the month of February of 2025. This is actual sales that people like you and me can purchase. But as you rightly said, the discrepancy is there with Vahan. Now, Vahan, of course, is the government portal which has the retail registrations of vehicles specifically, or into two-wheelers as well as the four-wheelers, as well as the commercial vehicle as well. And there the number that's visible in Vahan is 8,390. Now, why this particular discrepancy, as well as what is something that you should watch out for? Now, the company has mentioned that, on February 19, they put out an exchange filing specifically, and here you can see this was the number from January. So it's a sizable fall of about 180% compared to the previous month. And the discrepancy and the key reasons mentioned is that they released a press release and an exchange filing on 19th of February that the registration numbers will be temporarily impacted in the month of February. What does that mean? That the sales will be continuing, but the registration won't happen in this particular month, and that's because there is an ongoing negotiation with two of its registered agencies currently, namely, it's Rosmeta Digital as well as Shimit International Private Limited, and both these entities, they are under negotiation for registration aspects. What's likely to happen, and that's these vehicles will get registered in March, and we'll see a very inflated number there. But for now, it's expected to have, it's mentioned that sales is number, but this particular discrepancy is going to cause some kind of confusion in the market going forward as well. But the March number, which is expected to have a strong month, essentially compared to last year as well, will be a very inflated number and have one-off as well. But watch out for this stock going forward as well.
Right. Narendra, have you looked into Ola as a stock? Do you think that all the bad things or all the negative announcements that were expected to come in is now over them, and the stock could reverse from here on if the markets continue to remain stable?
Yeah, the stock, we do not have any recommendations right now. Neither do we have any coverage on the stock, so we won't be able to comment on the price aspect of the stock.
But I believe Anand Rathi also comes out with their auto channel check. Any expectations or any outperformers that you see on that front for the month of Feb at least?
Yeah, definitely. So for overall auto sector, we are more positive on two-wheelers and tractor segment. So especially M&M is one of our top picks, and TVS Motor is another from the two-wheeler segment. And in four-wheelers passenger vehicle segments, our relative underperformance would be maybe there in comparison with two-wheeler players, but among four-wheelers, our top pick is the Maruti Suzuki. So these three names are of preference in the auto sector.
Right. Well, apart from the auto numbers which are expected to come in from tomorrow for the month of Feb, it's the summer stocks that we need to keep an eye out for, because summer is actually knocking the door. The temperatures out there has been on a rise. So will the stocks sizzle or fizzle? Let's get in Mahima to understand which are the stocks that we need to watch out for this summer.
So there's a whole host of stocks, that can benefit from the summers coming in. It's already February and heat waves are being issued. And now there are different pockets in which I've divided these stocks. First up is beverages. Varun Beverage, which is one of the largest franchisee of PepsiCo in India. There's United Breweries, which manufactures both alcoholic as well as non-alcoholic beverages and beer. Largest segment is largest market share is garnered by United Breweries. Tata Consumer, on the other hand, also sells water under the Himalayan brand. So Tata Consumer will also be in focus. In terms of juices, Dabur, 15% of revenue for Dabur comes from juices, both the brand that is Real as well as Active are Daburs, and around 53% of market share for juices comes from Dabur. ITC operates under the brand of Be Natural, and around 5% of market share is garnered by Be Natural in juices. The next line of segment is bottling as well as packaging companies. AMD Industries is one of them. It packages articles being used in soft drink beverages as well as water, beer and liquor as well. In terms of Hindustan Foods, it's one of the most diversified FMCG play and manufactures for murky brands in India. And Orient Beverages is the one who supplies bottles and packaging for Bisleri. So all of these three counters will be in focus on the back of packaging. Now in terms of ice creams, Vadilal Industries will be in focus. Around 16% of total organized market share is held by Vadilal. And Hudson Agro is very big when it comes to southern markets because they have a strong hold in the southern India. In terms of AC cooling systems, Voltas, Blue Star, Symphony, Lloyds, Whirlpool, Johnson Hitachi as well as Orient Electric will be in focus for selling their ACs, refrigerators as well as coolers and fans. And lastly, Prickly Heat Powder, Imami will be in focus. Dermicool plus Navratna, both of these brands are of Imami and around 40% market share is garnered by them. And lastly, Zydus Wellness will be in focus as Nycil has around 34% market share. So all of these counters, combined together, will be in focus on the back of summer kicking in.
Right. Well, Narendra, any views on this FMCG names that would remain in focus for the next couple of months? In fact, these companies derive a significant part of the revenue in the first quarter of FY26. So any names that stand out for you?
Yes, definitely. We are also positive on the FMCG and durable segment, especially post-budget. The kind of spend we are seeing should increase, and the rural, which is already showing some signs of improvement. Urban space also we expect things to improve from April quarter onwards. And as the news of heat wave, we think that the Voltas is one of our top picks to ride this summer wave. And then United Breweries also is one of the stock where you can see the positive impact of this coming in.
Right. Well, another stock that remains in focus is Granules India. Now, this is after US FDA came out with a warning letter on the company's Gagillapur unit, which generates most of the revenue for the company. We have Varsha joining us with more details on this.
Thank you for that. So yes, Granules Gagillapur facility has received a warning letter. Now earlier in December 24, the same facility, that is Gagillapur, was classified as official action indicated. Now following the OAI status, facility on 27th Feb, that is yesterday, has received a warning letter from the US FDA. Now what does this mean and why this is important? Currently there are 10 pending approvals from the Gagillapur facility which will get impacted, and the newer filings will be done from Vizag and Granules Life Sciences facilities. Now this is important, and that's the reason why the stock is down, because Gagillapur is one of the largest single unit manufacturing site for granules, which contributes almost 60 to 65% of revenue, of the overall revenue, and the facility has capacity of 23,200 tons per annum of formulation intermediates and 26.8 billion units for finished dosage. Further FDA action, that is import alert, could impact supplies. Till date, if you see, Granules has gone through almost 24 US FDA inspections since 2009, and Gagillapur facility has been inspected almost 6 to 7 times. Lastly, the company is engaging with third-party independent consultant for a detailed review of the site's cleaning protocols and cross-contamination controls.
Right. Narendra, any views when it comes to Granules India? Do you think they can come over this big impact or big hit that has come to their books?
Yeah, currently we do not have any recommendation on the stock, but yeah, definitely this facility is one of the largest facilities and key contributor to the overall revenues of the company. So definitely impact would be there, and I think it would be critical how soon this alert can be handled by the company. So the impact would be depending upon the time it takes for resolution of this. So, but definitely in near term, there will be a negative impact in the company.
Well, Jubilant FoodWorks conducted their first ever physical analyst meet. What were the key takeaways and what are the analyst view coming in post that? We have Mahima joining us with more details on the same.
You know, in terms of key takeaways from Jubilant's first physical analyst meet, they've showcased how they've capitalized on their tech in their business, as well as the pivot to building platforms to secure higher growth going forward. They have aspirations of double-digit revenue as well as profit growth. In terms of Domino's store count, management is confident that they'll go to 3,000 stores by FY28. They're expecting a 200 basis points consolidation in net profit margin by FY28. This is something that the street has definitely not liked. In terms of targets, they are targeting to build food platforms of sales worth rupees 10 billion each. In terms of dine-in, the management said that they continue to see strong tailwinds, but management is confident of growth going ahead. In terms of Popeyes, once the unit economics is in place, the company can ramp up store expansion is the commentary that we've received. In terms of what brokerages are making out of these key takeaways, Morgan Stanley remains overweight with a target price of 781. What makes them bullish is, first, they expect outperformance to continue, which has been the case in the past few quarters as compared to the peers. Management's single-minded focus will drive the like-for-like growth, and top-line growth is in line, and it's with regards to keeping an eye on profitable growth as well. Macquarie, on the other hand, has maintained outperformance and cut target price to 575 from 600. What they're saying is that they're disappointed by the delayed margin recovery, and they've also cut their EPS estimates by around 4% over FY26 to 27. Jefferies has given a target price of 680. They remain excited about the growth agenda. Double-digit same-store sales growth due to innovation will continue going ahead as well, is what they're saying, and margin guidance, however, may disappoint. And lastly, JP Morgan has rated it neutral with a target price of 700. What they're saying is that it's like its initiative to strengthen competition is something that they like, but valuations cap is an absolute upside right now for Jubilant FoodWorks. So this is the overall view of key takeaways as well as of what brokerages are making out of Jubilant FoodWorks analyst meet.
Right, Mahima, thank you for giving us all those details. Narendra, any view on Jubilant FoodWorks or on the entire QSR space? Any top picks that you're getting here?
Yeah, right now do not have any recommendation on Jubilant Food. But overall, this space, I think if you look at it, the competition is very high, and the input price risk is also there for the space. So I think you have to have a cautious view on this stock, and the valuation is also very critical aspect of the whole thing that you have to analyze. So I think it would remain stable and cautiously positive outcome of the overall space.
Narendra, a couple of days back, the RBI relaxation that came in, especially for the microfinance space, that seems to be beneficial specifically for banks like Bandhan Bank or IndusInd Bank. Now, Bandhan Bank at least has been positive in trade, but IndusInd Bank is trading 6% lower. Any specific concerns that you see when it comes to IndusInd Bank?
Yeah, I think the overall announcement by the RBI is positive for the NBFC banks, especially those who are having exposure to microfinance institutions and the NBFCs in general. So we have a positive outlook on all these things. Coming to the IndusInd Bank, I think the NPA situation is more worrying for the overall investors' point of view. So it would be critical to see how the NPA situation pans out from here onwards for the bank. And coming to the other sectoral stocks, I think L&T Finance is one of the good stocks where you can find good improvements happening. Then Chola is another, then Aptus Value Housing Finance is also one of the good stocks where this impact would be positive for the overall business.
Right. Now, if you look at for this month entirely, Nifty Realty is down around 14%. Any value buys that you're seeing when it comes to the Nifty or the real estate space after this sharp decline in the month of Feb?
I think at this point in time, we would be not looking at this space right now. let the market settle, and also let the overall growth environment, the macro environment come back to the high growth phase, and then I think realty would be a better uh, uh, area to look at for investment.
Right. And when it comes to specifically the oil and gas space, any views on that front? That index is down around 10% in trade, and given the fact that oil prices are down, at least this should be beneficial for oil marketing companies, right?
Yeah, so we are positive overall on this segment, and if you look at the overall things, I think the refining margins are also going to improve. So we are positive on BPCL, HPCL stocks.
Well, thank you, sir. Thank you for joining us and explaining and giving us your view on the markets and the stocks we discussed. Well, with that, it's a wrap on this edition of Top Trade. Stay tuned and keep watching NDTV Profit.
Powered by Canara Bank. Together we can. And National Insurance Company Limited. Trusted since 1906.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
बजट भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी. हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं.
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है.
AI बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए.
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Good afternoon and thanks so much for tuning into India Market Close right here on NDTV Profit with me, Neeraj Shah and Harsh Sehta. And well, to say the least, it's not looking a very pretty picture. In fact, if I can just get the outings up on the wall and just show you what's moving and what's not. And yes, I mean, this is the really painful fall today. We're now sub 22,150 and therefore over 4,000 points from all-time highs. Except for India VIX, everything in the red. So that's the other statistic. And if you pull up the Nifty 50 heat map, I mean, the fact that we are running a point called markets weak, I think that's an understatement. Markets are not just weak. Markets have really plummeted today. Everything has given way. And if you look at the Nifty IT in particular with the 4.3% gash is really sulking in trade. And there are some gainers, by the way. And imagine what would have happened if there was no HDFC Bank, which is up about 1.3% in the green. That would have been even more terrible. But on the flip side, IndusInd 6.5% gone. Look at the IT gashes in Tech Mahindra, Wipro, Infosys, TCS, 4% down a piece for each of them. I don't remember the last time I really saw this. So it's very painful, fairly concerning. And to mention that as I give it to Harsh, it's not necessarily the worst performing index because small caps yet again are doing even worse than the large caps, Harsh.
Well, yes, they are. So there's a deep gash both on the Nifty mid cap and small cap. The breadth of the market looking difficult. Of course, the Nifty breadth, we just saw that Nifty 50, 3% shaved off the Nifty mid cap, or it's 3% more actually shaved off the Nifty mid cap. The Nifty small cap also roughly 3% plus lower. So pressure on both of those with regard to broader markets. Let's also look at the advanced decline. There you go. 2070 declines to just about 160 advances, and that's where the concern lies and has been all through this calendar year. We've seen the advanced decline remain extremely weak, the breadth remain extremely weak, and that is not showing any sign of improvement, Neeraj. And that is also an indication that you could continue to see weakness because the breadth just looking extraordinarily weak in that sense. And that's one of the many indicators we look at. And even when we are zooming out, Neeraj, in calendar year to date, you're looking at a similar kind of a breadth where it's been very difficult.
Yeah, it is looking very difficult, and which is why today I think we are doing a slight deviation from that, from the normal market parlance that we do, because we're getting in some heavy duty voices to try and understand what to do in a scenario like this, because this is, to a lot of people, this would be unnerving. I mean, we've been seeing losses every single day, but you would want this to taper down, the losses to taper down. Unfortunately, today at the end of the week, with the first day of Donald Trump saying that tariffs are here, the markets have lost more than what they've lost in the recent few days, and that is the worry actually. So bear that in mind. At some point of time this will stabilize, I'm sure of it. 2 years out, the markets will be higher than where they are. Surely they will be. Great time to build a portfolio, selectively, most certainly. Will the portfolio go down if you buy today? Very likely it could. But just the point that for people who are already invested to see this losses is not great stuff. And today, Harsh, the broader end of the spectrum, a lot of stocks sulking in trade.
Yeah, and Neeraj, we were just analyzing as to what is contributing to this. And we pulled out a few points with regard to that. Let's look at some of those. One of the factors is, of course, weak global cues coming through. The US markets particularly were weaker in trade yesterday, and that has also had an impact on our markets. Nvidia's earnings, or rather commentary, not particularly enthused. The market not particularly enthused by it. Stock was down 8.5%, $250 billion of market cap wiped out, now down 20% from the highs. All of those stats not looking pretty, but you're looking at, nonetheless, the US macro also not looking very good. So you're looking at jobless claims which came in higher than expected. Now whether to take that positively or negatively is again a question, because ideally if jobless claims are higher than expectations, then ideally rates should come off, which is positive. But likely the market reading this as a negative on the growth front. So US growth concerns clearly there. You also have everything with regard to tariffs, which is playing out. The other piece is FII selling, $13 billion now in calendar year 2025 for India. You have a weak domestic macro. You'll have the Q3 GDP data coming in, likely to be at 6.2%. But if it were to disappoint, you could well see a reaction on that tomorrow as well. So not looking pretty on that count either. Got cut in earnings estimates around 1% or so in terms of EPS estimates 1 year forward being cut. 1222 now being the FY26 EPS. And 18.5 times is where the Nifty currently trades at, roughly at that EPS number. And broader market valuations were punchy, don't look particularly cheap already. You're seeing Jefferies in their marquee note, Greed and Fear, suggesting that the correction is even now warranted, and it has to correct towards the Nifty 50 valuation, broader markets, for it to be for it to make sense. So maybe some bit of more correction is what they are penciling in. But let's get in some expert opinion on that note. We spoke to some leading market voices like Herald van der Linde of HSBC as well as Tahir Badshah of Invesco Mutual Fund, listening to some of their views on what's happening.
Money is moving in the direction of the United States, but that is changing as well. So if we see that money is moving out of the US and bond yields come off, then money would go back into emerging markets. That could be a first positive for markets such as India. I mean, it would be positive for other markets as well. If I talk to foreign investors, the key concerns that come up are twofold. One is, what if there's something really bad with Indian earnings? Maybe it's worse than we think it is. That is just normal, that comes up. If earnings are being downgraded, people just don't know where the bottom is. But the comparison we, for example, make is with Indonesia. Indonesia invested a lot, like India has done over the last couple of years, infrastructure, roads and railroads and ports and these sort of things. And that has led to increased competition domestically and a decline in margin in certain sectors. So is that something that will play out in India as well? That's uncertain for now. But I think it's fair to say that most of the earnings downgrades we've seen. The other concern that foreign investors have is what are the locals are doing? Because if they don't really want to buy this market anymore, there could be that there's further downside here. So the foreigners are looking at the locals are looking at the foreigners. We still are not clear where the earnings are ending up. As you say, rightly say, some money has flown back into the US over the last couple of months or so. But I think that might be changing, actually.
All right, let's get in somebody who doesn't have nerves of steel but nerves of titanium. By his own admission, Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers. And we need that, Manish, right now, because a lot of experienced voices as well are finally saying that, okay, this is now becoming a bit difficult to comprehend the pain. And the reason why it's important to get you today, Manish, is I remember that at about 23,500, when you had said 22,000 is a level which the markets could go to, a voice or two may have scoffed. We are now almost there. How do you see the landscape now from here on?
So Neeraj, I reiterate again the fact that on 4th of June 2024, Nifty was at 22,000. It was very fairly valued. And 1 year has elapsed, more than 1 year has elapsed, or closer to 1 year has elapsed between that. You have some earnings growth. And in the euphoria of the third term, of the incumbent government, we took the markets to 26,000. I think that got corrected and we are back to almost 22,000. I, by and large, genuinely believe that bulk of the froth is out of the markets, whether you consider the mid and small cap, whether you consider the large cap, whether you consider Nifty 500. Broadly, we are done. That's not to say that tomorrow onwards the markets are going to have a V-shaped recovery. It's going to be a U-shaped recovery. And, the things that are troubling the markets right now, apart from the valuation part, which was there, that has got corrected. Valuations are no longer a problem. Now, the not known factor is basically the tariff issue. And if we have done some work on this, and we believe that this tariff thing again is blown out of proportion when it comes to reciprocal tariffs. Of course, we'll see the final print whenever that comes, as far as India is concerned. But I think the differential duty is just about 5%. Of course, there are segments where the duty could be, like your agriculture will have a differential duty of 20%, or in automobiles will have a differential duty of 20%, and so on and so forth. There could be outliers, but on a weighted basis, India's basket, the differential duty is just about 5%. Whether that warrants such a scare and such a drubbing in the marketplace, I have my doubts. So all fingers crossed, but it now seems to suggest that we are actually traversing on the extremes. The world doesn't come to an end at any time. Every time it looks like that the world is going to come to an end. India is going to come to an end, but it doesn't happen that way. And, slowly and steadily, the markets will try to absorb all the negatives and then we move forward. But broadly, all the negatives, according to me, are there in the price.
Okay, so that's the big fundamental view, and let's get in a big technical view as well, and then combine both of these. Gautam Shah, founder of Goldilocks Premium Research, with us as well. Gautam, great having you. Thanks for joining in. I would love to know, Gautam, how are you thinking about this from a charts perspective? Because Manish Sonthalia is saying that the bulk of the pain may now finally be out. Some part of it in select pockets might be overdone as well. Are you sensing that circa 22,000 on the Nifty or whatever levels we may be on the small caps, that a bulk of the pain is out? Could we be close to bottoming out?
Good afternoon, Neeraj. In bull markets, it's always overdone on the way up, and in downtrends, it's always overdone on the way down. That's how markets are. And I think we've just been in a classical downtrend for the last 5 months, making lower tops and lower bottoms. But I think what's really surprised a lot of market participants is that for the first time, India has gone completely off track, in the sense of what global markets have done in these last 5 months. In the context of the rise that we saw in the last couple of years, we've retraced about 40% of the 18-month-long bull market that we saw. That's March 23 all the way to October 24. So keeping that in mind, the studies are oversold, but then the market has not shown any intent to rebound or recover from any level. I think a couple of weeks back, we were watching the 22,800 number. We stayed around there for about 7-10 days. And then once that number broke, what you've seen in the last 10 days is that the large caps and the top 100 have now come under pressure. They were relatively resilient in the last 3.5 months. So for the market to capitulate, you want the large caps to correct, which is what is happening. Now, in terms of numbers, I would say 21,800 is really an extremely important number where I feel the market can try to stabilize. A lot of the negatives I do believe is in the price. And as the market tries to discount the April earnings, I do believe that over the next couple of weeks, we should find some sort of a bottom and stabilize. So mid caps and small caps definitely offer great value at these prices. But I would disagree with the large caps because I think they've just come under pressure only now. And there is some more room for the large caps to go on the downside. So do not bottom fish there.
Okay. Interesting views coming through. Don't bottom fish and at the large cap end. But Manish, Harsh also joining in, quickly wanting your view. So I'll take a cue from what Gautam was actually saying, Manish. He's suggesting that markets on both sides swing to extremes. You believe that 22,000 is largely fair value. Was fair value 4th of June, likely remains so now, in around. Do you believe that there is therefore a chance, given SIPs, given the number of new investors coming into Indian equity markets, that you could see a swing on the other side in terms of, is there further downside from here as a result of some of these factors?
Yeah, I think, the Nifty 50 is really not portraying the correct picture of what is happening in the marketplace. Even if you look at the Nifty 50 nets, they are now crumbling big time. So, probably the broader markets are trading at closer to 17, 18,000 on the Nifty equivalent. That's the sort of pain that you're seeing in the broader markets. Whether that's justified, I would strongly believe no. And it all, it all depends on how the earnings shape up. And I think, by and large, in the backdrop of the, the reciprocal tariffs and all of this, India, by and large, is a domestic-centric economy. Our share of global trade is not that big. Not to undermine the trade balance with the United States. That is the talking point of all the weakness all around the globe. But on the upside, that 26,000 was clearly a euphoria moment, and that has got corrected. Probably the market, is not reflecting the true pain on a market-wide basis. Nifty 50 is hiding a lot of things. And markets broadly would offer more value in the mid and small cap space as opposed to the large cap. I agree to that fact. And the last bit of capitulation always happens in the large cap space. And now that, you're seeing a big capitulation on Nifty 50, again seem to suggest that we are somewhere close to the bottom.
Okay. So, okay. Now, I would love to know, Manish, and then we will try and take that question to Gautam as well about, where do people fish? Let's assume, Manish, that people didn't have money, right? Or everybody's invested, but people can swap. Loss harvesting is a great methodology as well, right? Per se. And you get into some stocks that you always wanted but couldn't buy, and now they might be at the same prices. So I would love to know, Manish, and I'll read the MK strategy note, that's the sell side, but they are saying that 22,000 is good. You are saying this is good. Where is it that you find comfort as pockets that you would keep an eye out for, if not buy currently?
So basically, consumption is the next big theme in Indian markets over the next many years on the back of the leeway that has been given in the budget, plus the 8th pay commission, which is going to get announced in the next year. That creates a good buffer for consumption stocks, and discretionary consumption would really do well. Financials, they hardly are impacted due to, whatever is happening on account of reciprocal tariffs. So banks, NBFCs, insurance, capital market, these are the areas where bulk of the value resides on every downtake. And obviously, due to the readjustment of reciprocal tariffs or whatever you may call it, I do find good value in the technology and the pharma space as well. Of course, the final word of that will be taken when you actually see the announcements of the tariffs or the embargo on manpower in terms of H-1B visa and so on and so forth. But all these sectors do offer great value, according to me. Where you can really,
Manish, I'm sorry, I'll have to cut in. Gautam, stay on as well because PM Modi is speaking. I have to cut across.
ये केवल भारत में यूरोपियन कमीशन की पहली यात्रा नहीं, बल्कि यह किसी भी एक देश में यूरोपियन कमीशन का पहला इतना व्यापक एंगेजमेंट है और साथ ही कमीशन के नए कार्यकाल की सबसे पहली यात्राओं में से एक है। इस ऐतिहासिक अवसर पर मैं यूरोपियन कमीशन प्रेसिडेंट और कॉलेज ऑफ कमिश्नर्स का भारत में हार्दिक स्वागत करता हूं। फ्रेंड्स, भारत और ईयू की 2 दशकों की स्ट्रेटेजिक पार्टनरशिप नेचुरल है, ऑर्गेनिक है। इसके मूल में ट्रस्ट है, लोकतांत्रिक मूल्यों में साझा विश्वास है, शेयर्ड प्रोग्रेस और प्रॉस्पेरिटी के लिए साझा कमिटमेंट है। इसी स्पिरिट में कल और आज अलग अलग सेक्टर की लगभग 20 मंत्री स्तर की बैठकें हुई है। विभिन्न क्षेत्रीय और वैश्विक मुद्दों पर सिंसियर और मीनिंगफुल चर्चा हुई है। हमारी पार्टनरशिप को
That's well, some sound bites on the India-EU FTA. Well, and we have our guests. Gentlemen, thank you for being patient with us today. Manish, I'll come to you first. You were finishing your point. Harsh just remembered that every single time that you are here, PM Modi tends to speak as well. So the last time the same thing had happened. But sorry, please finish your point and then we'll ask the same question to Gautam.
Yeah, so I think these were some of the areas where I find relatively more comfort. I mean, see, everything has fallen and so everything looks very appealing. But I think what has been time tested in India is basically your 3 PEG number. So any sector, any industry, any company, broadly, if you are very sure about the earnings growth, and if the market P is, let's say, market earnings growth is, let's say, 10% or 12%, and the P multiples on Nifty 50 is around 20, 22, so two times. I mean, if you are able to find value across segments, mid cap, small cap, large cap, which is in that ballpark valuation range of 2 PEG, then broadly you are okay. I don't see too much of a pain, provided you get your earnings right. There is value across the board, but I think the investment side of things, the so-called long-dated order book position, still can be, let go, and you could actually buy into a consumption and a financials and financialization and insurance and ITs and farmers of the world. You will be broadly relatively well placed. The cyclicality element in these sectors would be relatively on the positive side, as opposed to the investment related things where the cyclicality will now be on the negative side.
Gautam, Neeraj and me were just chatting that you have a knack for identifying turnarounds. At what point or what are the sectors, is consumption one of them, where you're seeing a possible turnaround at this point?
Two things here. Firstly, if you talk about Nifty levels, obviously it's very difficult to pinpoint a level from where we could bottom out, but we can definitely use the technical tools to put out some numbers. So I would want to believe that 21,800 or 21,200, which was the low around which the election results were announced. So I think from any of these two numbers, I would want to believe that the market becomes a buy. And any which way, from a risk-reward perspective and from a margin of safety perspective, the market is already a buy. The only thing is you'll have to keep a 12 to 18 month time frame. If you try to make money at the market over the next 2 to 3 months, it might still be challenging. Having said that, I think the next big opportunity is really financial services. I think the takeaways from the budget has been financial services friendly, with more, money in the hands of consumers. The takeaway from the RBI has been excellent in the recent past. In terms of valuations, financial services and banks are extremely well valued at this point of time. And the ratio charts are great because financial services is really the last man standing in the overall scheme of things with all that has happened in the last 5 months. So I do believe that banks, NBFCs, insurance companies, are a space that will do exceedingly well. And as the market stabilizes, they offer great value and great margin of safety. I would follow that up with another sector which we have liked is metals. And I think with how they are placed right now, I mean, look at a JSW Steel, it's 3-4% away from lifetime high. So some of the top metal stocks have actually stood out really well. So these two would be my favorite pockets. I'm actually quite bearish on IT and Pharma. I think Pharma is going to see a lot more downside. We've covered a few sell calls on IT in the last 1 week. And I think there is a down cycle that's going to play out on IT as well. So I'm just sticking to financial services and metals for now in terms of opportunity.
I'm tempted to ask this to you because I would have anyways asked you, right? IT 4% lower today. Now, you may have covered it. We're talking for the first time in a number of days. How much more downside do you see for IT from where Nifty IT is currently?
I think everybody in the market today is just forgetting the context of the rise. The IT index moved up 20,000 points. 26,000 became a 46,000 in a matter of about 18 months. So I think all the positives were in the price, and given the commentary that has come from the US and the feelers that have come from the US and the slowdown that we seem to be going through, it's pretty clear that many of these expensive IT stocks cannot stay the way they have been for many, many months. I think IT was a sector that was safe till last week. The breakdown has happened in just 5 days back, and now you are seeing some terrible setups in the entire IT pack. I would want to believe that there is another 7 to 8% downside for the IT index, and I think all top stocks will correct, including the mid-cap IT. So please do not get in there. Do not bottom fish there. I think financial services is your best bet.
Financial services being the best bet. Manish, quickly on to you. I mean, we did speak about the Nifty IT index and IT stocks being down 4%. I wonder if you have a view there. As well as I wanted to also try and touch upon auto, because that one is also under pressure today. The numbers, at least right at the offset, the preview numbers, they don't look too bright for the month of February. We're betting on consumption, but auto not really looking bright. What's your sense on both of these?
So, talking about numbers as far as IT is concerned, if you were to look out into the future because of rupee depreciation, because you are coming off a low cycle, as far as the IT space is concerned, you had a lot of order book positions over the last 2 years, not too much of execution. All of that will manifest itself in terms of revenue numbers, EBITDA and profits. So obviously, if you were to extrapolate the numbers, what we have today into 27, bulk of the IT names, decent ones, would be trading at 25 to 27 times FY27 number. That's not prohibitively expensive. And if the IT index was to fall another 5%, you will be in the ballpark of where Nifty valuations are, or maybe slightly expensive than Nifty valuations. But given the nature of that business, they have always traded at expensive valuation to the Nifty 50. So I do find a lot of value there. And given the propensity that India's rupee has further downside over the next 1.5 years, that will act as a cushion. And obviously, these are very high quality businesses where now artificial intelligence, you are getting many more deals, both at the GCC level as well as the third party IT vendors. So that's my take on the IT space. As far as auto space is concerned, look, this space is basically disadvantaged from a reciprocal tariffs point of view. I mean, the differential tariffs on automobiles per se is basically around 20-23%. That is to say that if India was to export automobiles out of India to the US, the differential duty is that they are not charging, they are charging some 2-3%, and we are charging on whatever we import from their country in terms of automobiles at closer to around 28% or thereabout. So that's a negative for the automobiles per se. This sort of a problem is not there for the auto comms per se. So auto and auto comms, the differential tariffs is not that big, but automobiles, yes, the differential tariff is very big. And from an export point of view, automobiles will be a disadvantaged space. But as far as domestic consumption is concerned, I think, look, this whole cut in, the income tax is going to be felt after a while. That is to say, in the next 3 quarters, you're going to see the positive effects of consumption play out. It doesn't happen very quickly, and doesn't happen automatically and very immediately. But over a period of time, again, the auto space, I think, will likely find, given that currently the SIAM, etc., are also talking about very muted numbers for the PV space. You are seeing this sort of a headwind in the automobile space, the passenger vehicle space. But I think that doesn't stand good for the two-wheeler space, particularly the premium segment of the two-wheeler space. Those are the segments which are likely to do better. But on an overall basis, I think within the next 2-3 quarters, you're likely to see pullback or buying even in the automobile space.
Buying in the automobile space, even though today not looking pretty at all. Let's pull up a TVS Motor, let's pull up an M&M, let's pull up a Motherson, Ashok Leyland. All of them down anything between 4 and 6%. M&M another 5.5% lower. But anyway, thank you so much, Manish, Gautam, for joining us this afternoon, giving us all of that perspective. Always a pleasure speaking with and taking your views. And while we are at it, also joined by Ruchit Jain, Vice President, Equity and Technical Research at Motilal Oswal. Good afternoon, Ruchit. Want to quickly take your view on the index first. What's the sense like? There's plenty of pain. What next? We have a fresh week at the end of today.
Yeah, hi, very good afternoon. Well, certainly plenty of pain was already there in the mid cap and the small cap space since last few trading sessions, although the index was consolidating within a narrow range. But today we have seen that the large cap stocks too have joined the momentum on the downside. And that's why we have seen a continuation of the downtrend on the index as well. Now the weekly charts, next support comes around 21,800 followed by 21,500. But I think in such kind of markets where the large caps are also giving up, I think no, not sure whether market will take their hold on that support or not. But 21,800 is the logical support technically where we can see on the weekly chart is coming. So until we see any change of momentum, just because support is there, one should not do any kind of bottom fishing. Recently also we saw that 22,800 was a very good support where the market saw some consolidation, some minor pullback moves were there, but ultimately when the trend remains negative, supports tend to get breached one after the another. So I think unless we see any kind of reversals of buying coming in the broader markets, the trend still remains negative. And maybe one should reassess the situation if we get it around 21,800.
Ruchit, are you brave enough to give us picks this afternoon?
Yeah, hi Neeraj. Yes, picks are there, but I'll make it a mixed bag with one buy and one sell explanation. So what we are doing that we are recommending our clients, those who are looking to buy any stocks, to stay only with those stocks which are outperforming in the falling market. Very few are there, but at least the risk remains lesser over there. So one of them is HDFC Bank, which we can clearly see is not correcting. And in fact, Neeraj, if you see, some of the stocks such as HDFC Bank, Bajaj Finance, Kotak Bank, these are some names where SRF, these are some names where in last 3 or 4 years, they have not shown that kind of rally when the entire market was doing good. So we have seen a good enough time-wise correction of consolidation in these stocks. And now when the markets are falling, these are the stocks where we are not seeing any kind of correction. So relatively, I think the downside seems to be limited in these names which have not shown any significant rally in the last market up move. So I think HDFC Bank perfectly fixed within that strategy. So one can look for buying opportunity in HDFC Bank at current levels. For traders, one should keep stop below 1685, potential targets around 1790, 1800. And on the short side, Glenmark is looking weak. In fact, the entire pharma space, if we look at recently, post that announcements that some tariff would be there on the pharma companies in the US. So I think a relative underperformance has been seen. And until that uncertainty is out, I think pharma would continue to underperform. So Glenmark is one stock which is showing a low top, low bottom structure amongst the other names as well. So one can go short on Glenmark futures with stop loss about 1310 for potential targets around 1200.
Okay, thanks for that quick take, Ruchit. It's that time of the show where we slip into a quick commercial break. On the other side, we'll have, of course, more news, heard on the street especially. An interesting day to get some insights there on what's happening in dealing rooms. And, of course, we'll focus in on a couple of other sectors and stocks which are in focus. Stay tuned.
Powered by Canara Bank. Together we can. And National Insurance Company Limited. Trusted since 1906.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
बजट भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching India Market Close here on NDTV Profit. It's a tough day of trade and it's though a good time. We've taken views from market experts on what possible levels could be. Now it's time to take stock of what dealing rooms are talking about. What's the chatter there? What's going on? Samit, as always, every day, brings us all the chatter from dealing groups. Samit.
Yes, what I'm understanding right now is that market seems to be quite nervous ahead of the GDP data. They're expecting some kind of a miss and weakness to come in when it comes to the GDP data specifically. Apart from that, dealers are also indicating that weaker global cues are also adding off to this selling pressure that we are seeing in the markets, and they're not seeing any fresh large positions being taken by HNIs. In fact, they're expecting similar conditions to continue at least for the next couple of weeks. Now, when it comes to stock specific action, IT is one of the sectors that we are watching out for. It is the top sector loser in trade, but couple of stocks stocks that are seeing some kind of buy flows when it comes to IT space. That is, first is Oracle Finance and the second one is Coforge. Small buying actions seen on the FI desk on these two counters. Then there is PI Industries. Long only funds are actively accumulating this counter at the lower levels. The stock has also recovered from day's low sharply, despite the fact that broader markets and benchmark have continued to remain on the lower side. And last stock that is in focus is IGL. Now, what I understand is DIs are accumulating this counter at lower level. Strong CNG vehicle car addition is something that we should watch out for when it comes to IGL, and dealers are also indicating that there could be a volume surprise that could come in for IGL going forward. So keep an eye out for IGL in trade.
Okay, so those are some stocks for you. But Samit, the other talking point is with regard to MSCI and the adjustment that, or the impact of the adjustment, and what the flows could essentially mean on specific counters. Talk to us about that.
Well, yes, today in the last half an hour, when is what we are expecting the MSCI flows to come in. Now, around 850 million to $1 billion of flows are expected because of the changes that are already announced. So key stocks that we need to watch out for. Firstly, it's Hyundai, where around 255 million of inflows are expected, which is nearly 11 times its 20-day moving average. Then there is IndusInd Bank, which could see an inflow of close to 258 million on the back of higher weightage. Apart from that, there is Zomato, Varun Beverages, around 96 to 107 million of inflow expected. Mankind Pharma, Torrent Pharma, PB Fintech, Torrent Power could see inflows anywhere between 8 to 48 million So keep an eye out for these stocks. Around 850 to $1 billion of inflows expected in the last 1 hour, but it would be important to see whether that would turn the FI number on the buy side or not.
Wow, interesting. Thanks so much, Samit, for that. But joining us, in fact, which is already with us, but joining us, Kunal Shah as well, Senior Technical and Derivative Analyst at Mirae Asset Sharekhan. Let me come to you first, Kunal. Want your quick take on IndusInd Bank. I mean, the stock taking a bit of a beating in trade today. Of course, flows seem to be positive for IndusInd, but nonetheless, stock down 5+%. What's the sense here?
Good afternoon. Firstly, if we talk about the stock structure, I think IndusInd Bank already had witnessed a sharp correction from the high levels. Now, in the last 1 month or so, we had seen a good pullback in the stock, and then after that, the stock was consolidating. We were expecting the stock to go on the higher end, pick out on the upside, but we saw a rejection in yesterday's trading session, and today the follow-up selling pressure has come in. So this low, that is the 1015, that was broken in today's trading session, and now the trend has reversed again on the downside. So we expect this to continue on the lower end, and the stock can test the levels of 940, 930 on the downside. So still it's looking bearish. Any pullback, already the stock is down by 6.5%. Any pullback could be an opportunity to sell the stock.
Okay. The other thing is there a trade in any of the large or mid-sized IT names, since tech is the sector that has gotten beaten down the most, right? So that would be my one principal question. And Kunal, based on either the derivative positions or the charts as you may have seen, what is your call on the 2 or 3 most popular or liquid IT names today?
Yeah, I think Neeraj, first we talk about on the IT space. The Nifty IT index had broken its 200 DMA, which is now placed at 40,705. And the last time when we had met, we had talked that we are trading for the IT index near a very critical support zone, and if this is breached, the fall could be very steeper, because before the 200 DMA had got broken down, the structure had already become weak. There were lower high, lower low formations which were clearly visible. And post that, the correction has been sharp on the IT space. So for the IT space, if we look at on a large cap, I think still IT has some downside left even from the current levels. You might get a pullback that could be possible in the sector, but again, that pullback would be an opportunity to look on the exit side, because your short-term trend has changed for the IT index. Once your 200 DMA is breached, you have seen already the correction. Now the pullback could play out on the higher end, and again, then you could see correction on the lower front. So out here, on the IT perspective, I will not be very aggressively bullish. But just from a trading perspective, if somebody wants to have a look at it, I think from the lower levels where the gap will be built for TCS somewhere around 3,360, 3,700 zone, that could be a good opportunity to enter. We are currently trading at 3,475. So maybe a more 100 points on the downside, and then you might find a support at those levels. That could be a good entry zone for a pullback trade. And one can again look for high levels of 3,600, 650 on the upside.
Ruchit, curious to know your views with regard to an M&M. What's the sense like on charts? It's down another 5% today. Time to go long at all?
The short-term trend definitely remains a bit of corrective or negative in the near term, because if I look at the positional charts, then I think after about 2.5 years time, the stock has given a breakdown below its weekly 40 moving average for the first time recently. So I think some more pain could be there in the stock, although it has not changed the longer term trend, which still remains positive. But the major support now for within this long term would be seen somewhere around 2,400 kind of levels. So I think, yes, if one is looking from a bit mid to long term perspective, then one should keep a buy and dip strategy for the stock. And any dip towards the 2,400 mark, if it comes, then I think the risk reward ratio will become very favorable to go long over there.
Very interesting. Okay, Ruchit, thanks for that. We'll let you go on that note. Thanks for coming in, speaking with us. What's the broader trend with regard to auto, Kunal, if I can quickly ask you?
I think if you look at the Nifty Auto Index, it had already corrected sharply from the high levels. There was a phase of downward consolidation from 24,000 mark to 22,000 mark on the Nifty Auto Index. We have broken on the downside. So still some downside is left in the entire space. So I believe the Nifty Auto Index could touch the mark of 19,800 on the downside, for currently trading at 20,500. So still the view remains negative on that perspective. And one stock which has already seen a lot of beating from the high levels, that is Tata Motors, still looks weak on the chart, can touch the levels of 600 on the downside, currently trading at 626.
Well, okay, so those are some ideas, but like we said, I think what is not doing well is tech. The index is down 4%. Biggest monthly fall since April 2022. What are the major headwinds pulling down the stocks, and what are the stocks that have fallen the most, not just today, but over the last few days? And Rucha Johnson for the same, and I dare say, Rucha, if from amongst the fallen quote-unquote heroes, are there any of the stocks which actually have given out fairly reasonable guidance as well, if you have it at the back of your memory?
Yeah, definitely. But before that, Neeraj, I would like to point out the headwinds, right? A couple of headwinds that have come out after the companies announced their third quarter results. Number one is the high US consumer inflation expectations. Now, this means that the rate cuts could be delayed, and therefore it could impact discretionary demand and the top line of IT companies. The other one is Capgemini's CY25 results came in, which pointed out towards uncertainty and again a weak discretionary outlook. And also recently the disappointing Nvidia earnings is another headwind that have come up, and because of which over the past few sessions IT has been underperforming and giving negative returns over here. But as you rightly mentioned, there are a few stocks. In fact, all the stocks of the Nifty IT have given negative returns since the start of 2025. The top loser is Coforge, negative 26% returns. Likes of Emphasis and Persistent as well. So largely the mid-cap names have been the worst performance over here. But the ones which have given less negative returns are Infosys, Wipro down about 10% and 6% respectively, and LTTS largely remained flat, down about 3% since the start of 2025. This is because the ER&D space has largely been unaffected as compared to what the software services players are. But valuations again have been key concerns, and the small cap and mid cap valuations were the trigger of such a downfall in the Dalal Street. So talking about that, well, most of the mid cap names are trading above their 5-year average PE. The likes of Persistent trading at about 50 times its FY26 PE. versus its 5-year average of about 38 times. So that's a huge kind of gap that one is seeing over here. Likes of Coforge trading at around 37 times versus a 5-year average PE of 34 times. So mind you, likes of Coforge and Persistent, these were the top performers in CY24, but CY25 have largely been disappointing. Now, talking about the growth commentary which the management had given in the third quarter, TCS had said that they are seeing early signs of revival, especially in the BFSI retail space. Infosys also mentioned the same. HCL Technologies also saw an improvement in discretionary spend and smaller deal wins. But that was in the start of January when the third quarter earnings came in. A lot of things have changed from January to where we are currently, the 5 pointers which I mentioned at the start of this conversation. So these will likely weigh heavy on the fourth quarter earnings, and therefore the commentary, especially around how the US clients are behaving and talking to the IT companies, will be a key thing to watch out for in the upcoming results.
Thanks a lot for that, Rucha. So, well, select names more expensive than 5-year averages, select names not so much, but all of them without exception down and out in trade today. At the lowest point is the Nifty IT today, 4.36% lower. Neeraj Devan, independent market expert, Johnson. Neeraj, while we're talking about a clutch of sectors and the market pain, since we're on the subject of IT, would love to understand, we've been asking this to almost everybody, is this pain to be bought into?
See, as far good afternoon, sir. If you're specifically asking about IT.
IT, yes, right now. We're starting with that, yes.
Yeah. So I think that you need some more clarity as far as IT is concerned. Till now you have not got any clarity on what can be, US view on, IT related visas and, the businesses coming from India, to US. I think the IT is one space where for some time, though I've been advising other sectors of IT, I've been a little cautious right now. Though in the last couple of days, including today, the fall has been a lot. And I feel that there will be some stock-specific, pockets where one can look at specifically the large cap IT space. Some of the larger numbers, which larger companies have been doing well. Like Oracle is one of them, which had been coming out with very good results. So you can look at very specific selectively, but I think still, you need to get some more clarity as far as IT is concerned as a sector.
Okay. So a little bit of a wait and watch, it seems. Kunal, let me get your picks out of the way. Your picks for this afternoon?
Yeah, I think there will be 2 calls, one on the sell side and one on the buy side. First, I will discuss the sell idea, and that is Zomato. Zomato in today's trading session has given us a breakdown on the technical charts. So the stock has given a rejection from the 20 DMA. So any pullback would be an opportunity to sell, currently trading at 221, 222 zone. One can initiate a sell at the current levels, keep a stop loss of 230 on the upside, and looks for target of 210 to 204 on the downside. So Zomato March future is what you have to sell. The second is on the buy side, and over here the stock is Coal India. I think the stock has already seen a bottom formation a couple of days back, and now we are seeing the follow-up move in the stock. The stock has also surpassed its recent swing high, plus trading above the 20 DMA as well. So this could extend the rally towards the mark of 380, 384 on the higher end. So Coal India is a buy at the current levels, 371, 365 should be a stop loss on the downside.
Okay, so those are some names for you. Zomato, Coal India. Now, we'll rather go back to what we were speaking about, autos. The Nifty Auto Index is down 4%. Top auto players have or are near 52-week lows now. Puneet joins us with what's really keeping the auto index subdued. Puneet.
Well, thanks for that. So just the clutch of stocks first. Tata Motors and Hero MotoCorp specifically have hit 52-week low today. Apart from that, we're seeing a clutch of other names such as Ola Electric, Samvardhana Motherson Wiring, Bosch, Bharat Forge, and all the tire makers, MRF, Apollo Tyres, SIAD, have hit 52-week low today. Now, it's important to look at, the 5 key aspects, according to me, that have been impacting, these particular stocks. The first one is, of course, that the retail sales have slowed down. And, we were just looking at, the wholesale data specifically, which is expected to come tomorrow, the preview as we speak about. when you compare that to retail sales, that is a very big differential. Maruti, for example, had roughly 2 lakhs of retails in January. It's come down to 1,11,000, and it is not the only one. Hyundai has seen it fall from 60,000 to 36,000. So that domestic demand trend, which was a stronghold in the low single digit for two-wheeler space, that's also reduced in this particular time frame. The second reason, of course, is the tariffs uncertainty in the global market, and I want to extend that point specifically on the outlook of export market as well. We've seen Mercedes-Benz again come out in this particular year and said the sales will be actually lower than the previous year, whereas the previous year the sales are actually fallen more than 30%. So essentially it's a very, very poor outlook and a weak outlook that the automakers are giving in the export market specifically. And most of the auto component makers that cater to these domestic export players, specifically like Mercedes, the likes of Samvardhana Motherson, Endurance, they are also impacted because of that, because of course the demand momentum has cooled off. So that's one of the third reasons. The fourth ones, of course, auto ancillaries majorly impacted due to weak export outlook. And the one positive point in all of this could be that what Mr. Manish Suntale also highlighted, that the component reciprocal tariffs is negligible. It's at roughly 7.5%. So whatever we import in terms of auto components is taxed at 7.5%. If that tariff comes in, it could be at that impact, but it's much lower than the 20% which might be on auto OEMs. And finally, tire makers. Tire makers are impacted because of high natural rubber prices and of course the export market. So it's a double whammy for those players. So JK Tires and all those companies are down almost 47% from the highs. But these are some of the key reasons. While domestic export pressure, of course, on demand consists, for tire makers, it's also the raw material prices.
Okay. All right. So the auto space, definitely a space we would want to watch out for, because would likely even benefit from the freed up 1 lakh crore of tax benefit which will go to individuals. Neeraj Diwan, you reckon it's an opportunity, the auto pack at this point? And if so, where is it that you would find it best to deploy?
I feel that this is an opportunity for sure. So, but one needs to be stock specific. There are these strong stocks like Mahindra & Mahindra and Maruti, which are not corrected earlier. They were always trading at premium valuations. So I think their correction in these kind of stocks can be an opportunity. So one should accumulate stocks like Mahindra & Mahindra, Maruti, which will benefit definitely because of, like you rightly mentioned, the tax cuts, plus some liquidity infusion when RBI is doing. Interest rates will come down because one cut has happened, couple of more cuts can happen this year. So there can be multiple trigger points for them. So in this correction, one should be accumulating these kind of stocks.
Okay. Names, if at all I can nudge you, Neeraj. You did mention M&M, you did mention Maruti. M&M is in a bit of a free fall of sorts. Would you wait or would you deploy at this point? If so, how much? If you were to deploy 100, how much would you deploy of that right away?
Yeah, that's what I mentioned. One needs to accumulate. You should not buy altogether at these prices, because no one knows whether we are close to a bottom or some more downside, or whether market may rebound from these levels. That's something which you're not very clear about. But once you start accumulating at these levels, for sure, if someone is looking at investing 100 rupees in auto stocks, I think he should put at least 20-25 rupees in these kind of levels.
Okay. All right. So maybe a quarter to be put right up. But time to slip into a very short break, actually. We leave you with an important conversation. We caught up with the CEO of NSE, Ashish Kumar Chauhan, on the sidelines of the Mumbai Tech Week 2025, and he spoke about their expansion plans, the frenzy in the primary market, and about the new SEBI chief. Listen in.
Our current building, where we have the data center and also office, we are slowly moving out people, because there is a huge requirement for increasing the data racks for our members as well as ourselves. So we have asked today only Honorable CM, when I met him informally, for giving us space in nearby, so that it's easy for us to commute and connect. And so hopefully he will consider and give us some land to construct our new building there.
Definitely, sir. So, considering the IPO exuberance also, and NSE had facilitated most of the IPOs last year, and more of that exuberance is expected. How do you feel looking at the market right now? What kind of exuberance is going to continue this year?
In a way, there are more people I met today also in this conference, which is Mumbai Tech Week version 2, second year. And there are many more people wanting to come with their IPOs, and the pricing is the issue that basically if you have a target, then you have an issue. But otherwise, idea is that all Indian entrepreneurs should be able to get funding from angel investors, venture capitalists, private equity, but also if they don't get it from those people, they can come into the markets, and we have 110 million, that is 11 crore investors who will participate in your dream.
But you're optimistic about it for this year and the coming time as well?
Oh, absolutely. For me, India's future is starting now. And all of us have to participate, and this is the best time to invest in India's future and the world's future.
So are you also excited about the new SEBI chief working together and a new chapter starting?
No, he's a brilliant man. We have worked together on sort of different roles in LIC, disinvestment, and many other things over last almost half a decade or more. And I'm sure his coming here will bring a fresh breath of air to the regulatory framework.
Powered by Canara Bank. Together we can. And National Insurance Company Limited. Trusted since 1906.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
बजट भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स
Some spikes, I must say. India Cements, JB Chemical, Hyundai Motors, all of them have moved up in the last few minutes of trade. JB Chemicals up 3.5%. Is strength in India Cements. Look at that spike there. And Hyundai should come up on your screen as well. Motilal Oswal, 2.5% as well. Let's see what Hyundai is up to. HEG has gained quite strongly as well in the last few minutes of trade. So there are a few winners. Now, presumably some of this might be due to MSCI adjustments, but there is some strength clearly in Hyundai individually for sure. While large cap autos is suffering, Ruchit, any thoughts on Hyundai? Okay, sorry, Kunal. Kunal, any thoughts on Hyundai, because it's had a good move, and if you don't track that one because of limited charts, give me a chart check on India Cements.
Yeah, I think the data is quite limited, and I don't track the chart because of the low volumes. So that's an avoid. The second one, what you talk about India Cement. India Cement, if you look at the chart, technical chart, the stock had already seen a sharp fall from 380 to the mark of 260. Then there was a pullback, and again we have seen a correction from the swing high. So I think now again pullback would be an opportunity to exit. Today we are seeing a reversal candle that has been formed, but this would mean that the stock could go towards the mark of 270, and again that would be an opportunity to again exit your long position.
Some of these have happened because of flows coming in due to the rebalancing as well. So some of that institutional flows will have that bearing. Okay, what if let's figure out, me and Harsh have spoken about some, let's figure out what are the three stocks that coming up on Varsha's list today. Varsha.
Thank you, Neeraj. So let me start with Granules, which is in focus on the back of its Gagillapur facility receiving warning letter. Earlier in December 24, the US FDA had classified this facility as official action indicated. Now, why this is important? Because currently there are 10 pending approvals from the Gagillapur facility which will get impacted. The newer filings will be done from Vizag and Granules Life Sciences facility. Now, this is why the stock is under pressure so much, because Gagillapur is one of the largest single unit manufacturing site which contributes 60 to 65% to the overall revenue and has capacity of 23,200 tons per annum of formulation intermediates and 26.8 billion units for finished dosage. Until date, if you see, Granules had gone through almost 24 US FDA inspections since 2009, and Gagillapur facility has been inspected 6 to 7 times. Next on my list is Coal India. They've announced price hike of rupees 300 per ton with respect to May 2025, and this price hike possibility was indicated in yesterday's Heard of Street also, and this price hike is on entire volume from one of its subsidiaries, that is NCL, which produced 136 metric ton of coal in FY24, which forms almost 18% of volume mix, and about 86% of the coal produced is dispatched to the power sector, and its main products include non-coking coal. This will help in increasing revenue by rupees 3,877 crore, and the entire amount is expected to flow through the EBITDA, while analysts see this EBITDA aiding by 8 to 9% in FY26. Analysts believe the above price hike should offset lower coal volume. Last on my list is KSB, which came out with its Q4 numbers. Overall good set of numbers. Revenue was up almost 21%. Margins were at 13.5%. Net profit was up 33%. If you see, the overall order book for the company stands at around 2,250 crore as of December 2024.
Okay, thanks so much for that, Varsha, for bringing us that. Of course, some key newsmakers, and on the back of that, you're seeing at least 2 out of those 3 up nearly 2% on a day like this. Not bad at all. Neeraj, curious to know, we've seen Coal India fall from those highs. Starting to see value at this point. Of course, the news is positive, around 3,800 odd crore in terms of top line, likely to get added every 12 months as a result of this change in pricing. But what's the sense like?
Yeah, though the news that has come is definitely positive. Even before this you saw that Coal India had stopped falling now because it was kind of making a base around these levels. And valuation-wise also, if you see long-term averages, I think it is now at a good valuation where one can look at investing again, because you've seen these cycles in Coal India. It makes a high and then it corrects 40% from those levels. So I think once someone is looking at even value from these levels plus dividend yield, I think it's a good bet to invest into.
Okay. Kunal, any of these on your radar from a technical perspective? A KSB, a Coal India, both doing well in trade. And what should one do with the granules down 8.5%? How should you play that trade very quickly?
Yeah, I think Coal India is what we discussed as a call buy as well. That was one of our buy calls. So we are bullish on the stock. The technical chart structure looks quite attractive. As we mentioned that the base has been formed on the lower end, and now we can see a good rally on the higher end that could take the stock towards the levels of 396 on the upside.
And what about granules? What should one do? How should one play that trade?
The granules already in today's trading session, the stock has already witnessed a breakdown. So the support for the stock was placed at around the zone of 500, and then we broke in today's trading session. So the structure is weak. Any pullback would be an opportunity to sell. The next support for the stock on the downside, what I see is at around the levels of 400, 390. So it could fall towards those levels. Pullback would be an ideal opportunity to go short into. 500 is a strong resistance on the upside.
Okay. Let me quickly also take your view, Neeraj, with regard to something like a BSE. Down 11.5% now. It's around the 4,500 levels. So it's corrected again significantly and very sharply. Do you expect some bit of more correction here? Would you go long? Would you avoid capital market play, duopoly, as well as one of the beneficiaries to all things regulatory that's happening in that particular space?
Yeah, see, whether it's close to the bottom or the correction over in BSC is difficult to say. But I think at these levels, one who had been wanting to get into BSC, start looking at it again. So I think that 41, 4200 would be a good level to get into BSC for a little long-term investment. So any fall from these levels close to that level, I think should be an opportunity to get into this. And besides this, other wealth management, brokerage, those picks also, those specifically wealth management companies which are related to stock market, those also you've seen a good correction happening there. And those will also be beneficiary of the interest rate cut which is announced in the budget. So even those one should be looking at investing at these levels.
Your top picks in that space, I'm curious to know. You have a Nuvama Wealth which is trading at currently 21 times trailing 12 months. A Prudent Corp is at 37 times. Motilal Oswal is at 11 times trailing 12 months. And Angel One has also fallen today. So some of those capital market plays also taking a bit of a beating. 14 times trailing 12 months. This was a darling at one point, Angel One. The rally that we saw on the stock was very solid, Neeraj. Would any of these feature? And if so, just give us your maybe a couple of points of rationale.
I'm looking more at asset management companies, something like Nippon Asset Management. I think there I feel one should look at because those are long-term good franchisees and they're very strong compliance and very strong, management and the way they function. So I think that is one which one can look at. That should be one which is top on the list.
Okay. Kunal, curious to have your view with regard to a BSE and some of these capital market plays.
I think BSE, if you look at the stock in yesterday's trading session, had already given a breakdown below 20 DMA, and post that we have seen follow-up selling pressure in today's trading session as well. So the structure has become now weak. Now pullback would be an opportunity to exit. The resistance for the stock is now placed at 5,000. So any pullback towards 5,000 would be an exit opportunity. The stock can again come down towards the mark of 4,400 on the downside.
Okay. Well, gentlemen, stay on. One pocket which is not doing well is IT. The other pocket, which is really not doing well is autos. Now, before I get to why is it that auto would be doing what it is doing, let's try and tell you a set of numbers that you should keep an eye out for, because the auto sales numbers will start coming in from tomorrow. And Puneet, try and bifurcate this for us, all of December and some bit of Jan. Right? You've spoken about how some companies have a very strong demand. I wonder if it's lasting well into Feb.
Well, a one-word answer would be no. It's a weak demand trend that's expected to see in this particular month, and that's spread.
Buy anything?
And right now I'm licking my wounds right now, so as to say. But essentially, in this particular fall, it's been a very, very interesting fall across sales, across parameters, across companies, and the stocks have reacted on Q3 earnings as well. So let's pull up the two-wheeler names first, because essentially here we're going to see one of the biggest winners will be Eicher Motors, Royal Enfield, of course, up almost 12% in this particular month, and that's going to be one of the highest growth across categories seen in a company like this. One other aspect is that scooters are seeing better performance compared to motorcycles, and that's where the second one, TVS Motor, comes into play. That's an 8% growth expected on a year-on-year basis or something like that. The other aspect is that for Royal Enfield, the marketing push is clearly visible on terms of sales, but not in terms of price performance. What's interesting, as one Motilal Oswal trend has said, that the Chetak EV has been outpacing the iQube EV of TVS in certain markets because of its metal body. So the growth is visible there, but the domestic sales have faltered for Bajaj, and hence it's going to be expected to be the third biggest in terms of growth. Finally, on Hero MotoCorp, the rural trend is currently doing pretty well across the two-wheeler makers, but that isn't visible for Hero MotoCorp, so expected to be a downtrend. For 9 months out of the 10 months, it has put out a lower growth number in 7 out of those 10 months. So definitely not a good pretty picture there. For the passenger vehicle makers, it's a very interesting trend that we are seeing. Footfalls, while continue to rise in the rural regions, it's visible in some portion for Maruti. Sales numbers expected to have a 3% growth, but not in terms of exceptional growth seen in something like an M&M. While the growth has come down to 13% versus 20% in the first half, we are seeing, at least a very positive momentum. It is one of the biggest growth drivers in terms of the passenger vehicle market. And for Tata Motors, it's another month where a 5% fall is expected. Overall, in the 10 months, it's fallen by 4%. That's another key aspect. Discount levels, although high, have reduced from the December 24 levels. So that's one thing to watch out for. And the other aspects on Hyundai, because Motilal has said that for Creta EV, while it's attracting significant interest and positive feedback, conversations remain moderate currently. So that's something to watch out for going forward. Finally, on commercial vehicle makers, nothing too much to talk about except VECV. Another strong month in this particular month of February is expected to come. CV segment continue to face a slowdown. Smaller players are impacted more, but VECV's new product portfolio has accepted well. And finally, on tractors as well, it's going to be very interesting for tractors, because Mahindra has come out and mentioned that a 15% growth is expected in fourth quarter. In this month, is expected to have a 10% growth. But Motilal Oswal has pointed at certain regions of Maharashtra and Karnataka have seen crop prices of tur dal, soybean and cotton decline by 25% in the last couple of months. So that has, of course, impacted demand. So any kind of qualitative aspect in terms of demand would be something to watch out for. Of course, Escorts also making a comeback with the North Belt finally seeing some growth. Rabi sowing has been better. That's what's expected to come in for tractors. But overall, Hero and Tata Motors will be biggest misses in this month, while Mahindra, Eicher and TVS will be the three big gainers to watch out for tomorrow.
Okay. Thanks for that, Puneet. Now, Neeraj, we've had issues or other beliefs that a Tesla entry or some others will mar some of the EV players. Mahindra presumably has been taking a hit because of that. Trying to understand, are you negative, are you bearish because of all of these, or you reckon that the concerns are overblown?
No, I think right now the concerns are overblown, because one, we don't know what entry point Tesla will come at. And right now, if they're going to have a factory in India or not have a factory in India is also a question mark, because of a lot of things like what even the statement Trump made. So right now I think it's overblown because Mahindra is at a space where they're able to come out with their SUVs or EVs at a much lower point, which I think Tesla will be able to come. And with the kind of infrastructure and the demand which is there for the product, I think this is not so easy to breach into a market and take the place which Mahindra has or Maruti has. I think they have a place which is becoming stronger only. We've seen so many other entrants coming. So Tesla will come definitely at a price point. We have to see how it comes and what kind of volume they grow into. Right now, Mahindra and Maruti are huge volumes there. So to reach something very close to even a fraction of the volume will take a long time for someone like Tesla. So I think right now it seems to be overblown as far as the threat is concerned.
Okay, talking auto, on the sidelines of the CI Delhi Leadership Conclave, my colleague Shrimi exclusively spoke to the Hero Enterprises chairman Sunil Kant Munjal about Tesla's entry into India. He also spoke about the move signaling a shift towards high-performance, eco-friendly vehicles. Listen in to his perspective.
Well, Tesla is certainly one of the leading companies in the world, even though there are some Chinese companies manufacturing more than Tesla. But Tesla has been an example of how a high-performing vehicle can be a clean vehicle. The earlier impression was you can be one or the other. They demonstrated and they broke the mold. And of course, subsequently, many more have followed. Today, I think even though Tesla eventually at some point may or may not come, and I think it will come, but there will be many, many more in India and coming from other places, which will actually build the new backbone of the clean mobility as an industry.
But don't you see it's going to be a threat for the domestic industry maybe?
I don't see any one sector or one company as a threat. It's always a challenge that gets thrown up when more and more, but even if any company, by the way, even today you can import. Yes. It's just that the duties are high and the duties are likely to be lowered. It will not be for one company alone. It's a universal regulation. Yes. So others can bring goods in, including Indian companies. So as I said a little bit earlier, some of these are challenges, but they are not things to be only scared of. We have to figure out a way to make ourselves more adept at this and more able to respond to the changes that the world is asking for and the environment and the ecosystem is asking for, and in many cases the customers and consumers are asking for.
Now, well, that's all things auto. Frankly, the index not doing well at all in trade, and pretty much all constituents trading in the red. And Ashok Leyland now 6% lower, and M&M too 5.5%, and that's been the kind of trend we've seen pretty much through today. But let's switch focus to consumption. Jubilant FoodWorks has been in focus. Company hosted their very first in-person analyst meet. Mahima joins us with the key highlights of that meet and how brokerages are really assessing what the management had to say.
In terms of key takeaways from Jubilant's first physical analyst meet, they've showcased how they've capitalized on their tech in their business, as well as the pivot to building platforms to secure higher growth going forward. They have aspirations of double-digit revenue as well as profit growth. In terms of Domino's store count, management is confident that they'll go to 3,000 stores by FY28. They're expecting a 200 basis points consolidation in net profit margin by FY28. This is something that the street has definitely not liked. In terms of targets, they are targeting to build food platforms of sales worth rupees 10 billion each. In terms of dine-in, the management said that they continue to see strong tailwinds, but management is confident of growth going ahead. In terms of Popeyes, once the unit economics is in place, the company can ramp up store expansion, is the commentary that we've received. In terms of what brokerages are making out of these key takeaways, Morgan Stanley remains overweight with a target price of 781. What makes them bullish is, first, they expect outperformance to continue, which has been the case in the past few quarters as compared to the peers. Management's single-minded focus will drive the like-for-like growth, and top-line growth is in line, and
it's with regards to keeping an eye on profitable growth as well. Macquarie, on the other hand, has maintained outperformance and cut target price to 575 from 600. What they're saying is that they're disappointed by the delayed margin recovery, and they've also cut their EPS estimates by around 4% over FY 26 to 27. Jefferies has given a target price of 680. They remain excited about the growth agenda. Double-digit same-store sales growth due to innovation will continue going ahead as well, is what they're saying, and margin guidance, however, may disappoint. And lastly, JP Morgan has rated it neutral with a target price of 700. What they're saying is that it's like its initiative to strengthen competition is something that they like, but valuations cap is an absolute upside right now for Jubilant FoodWorks. So this is the overall view of key takeaways as well as of what brokerages are making out of Jubilant FoodWorks analyst meet.
Thanks for that. Mahima stock not looking pretty at all, 6.5% lower in trade. Neeraj, actually, before I come to you, Kunal, time to actually give viewers perspective on BTST. Would you at all at this point be brave enough to suggest a trade?
Overall, I think the kind of closing what the market is giving you, it indicates that even Monday could be a good gap down that could come into the market. So I'll be avoiding any BTST call right now.
Okay. Now, in terms of the larger macro, of course, US global looking weak at the start of day today. But there are, of course, certain other macro factors that we will watch out for through this weekend and on to Monday. One, you have US personal income, US personal spending, some of those data points coming through. The China PMI data will come in, Japan manufacturing PMI, the India Forex reserves, India loan and deposit growth numbers, as well as India GDP growth numbers. I think that's going to hold the key with regard to how markets respond pretty much all through next week. Pallavi with us to kind of break down what we can expect from India's GDP growth numbers. Pallavi.
Right, Harsh. So India's economic growth is expected to actually see a little bit of an uptick. That's for Q3 of the ongoing financial year, and that's compared to what we had seen in Q2. Now, GDP is estimated to grow by 6.2% in the October-December period. That's according to a poll by Bloomberg of over 40 economists. That's compared to a print of 5.4% that we had seen in Q2. But let's also remember that even despite the uptick, GDP growth for Q3 is expected to come in significantly lower than what it was for the same quarter and year back, when we actually saw GDP growth at 8.6%. Meanwhile, GVA is expected to grow by 6.2% as well. Now, alongside data for Q3, we're also going to be seeing the second advance estimates that the Ministry of Statistics will put out. We'd already seen the first advance estimates being presented before the budget, and that had pegged GDP growth for the full fiscal year at 6.4%. Currently, economists polled expect the second advance estimates to peg GDP growth a tad lower at about 6.3%. Now, so what is the basis of the sequential uptick that we're expecting in the numbers? First up, of course, is government capex. We did see the government slow down on spending in the first half of the year, and ever since we have seen a little bit of a ramp up on capex by the government that's expected to benefit the economy. We've also seen major kharif crops outperform. The output is expected to be better than was earlier thought, and that's expected to further boost rural sentiment as well. Some consumer-focused sectors also saw a little bit of a pickup owing to festive season demand, along with some improvement on a sequential basis again in merchandise as well as in services exports. Now, coming to industry-wise data, agriculture, like we spoke about, is expected to perform well, and that's largely going to help prop up rural sentiment. Urban consumption remains slow, and that's expected to dampen service sector demand as well.
Okay, that's pretty detailed. Thanks so much, Pallavi, for that. Neeraj, quick views with regard to GDP, 6.2%. In your view, a weak print, you expect some bit of acceleration later through the year?
I think later through the year, I think this last quarter can be a little better than what already been priced into. I think everyone expecting after the bad quarter, second quarter, and not too good third quarter, everyone expecting that maybe the fourth quarter will also not show any too much improvement. But I'm feeling that the kind of government steps that are being taken, liquidity infusion, and then you see a lot of order flow also coming to most of these companies. You see a lot of order announcements which has happened over the last few days. So I think that may also help. And even execution picks up normally as liquidity is improving. So I feel that the GDP should pick up, and what is priced in is already the worst. I think from here you can see some improvement.
Worst priced in. All right, Neeraj, as well as Kunal, we're going to have to let you go, but thank you so much for coming in and giving us all of those views pretty much through the last hour of trade. It's a tough day. We're somewhere in a difficult position. Are we holding on to 22K? 100 was the question. We've at the moment holding on. 22,100 is the print on our screen for now on the Nifty, but nearly 2% lower. So the pain really pronounced, and the pain even more pronounced in the broader markets. Let's pull up the broader market indices. The Nifty mid cap down 2.3 odd percent, and the Nifty small cap, which was down 3%, has seen a bit of a pullback. So we're seeing a decentish kind of pullback on both of those indices. So positive, some bit of positivity if I can call it at all. But let's look at the week as well. Let's look at it through the week. The Nifty 50, the Nifty mid cap as well as the Nifty small cap. The Nifty 50 through the week has done roughly 2 odd percent, and that's largely what we've done today as well. So negative 2% on the Nifty 50. We've closed for the day as well as for the week. The Nifty mid cap, I'd be curious to know how we've done through the week. Nearly 4% lower. A bulk of that again coming today. The Nifty small cap 4.5%, and a bulk of that also coming today. Nearly half, more than half of that coming today. So that's how the week has played out. Let's look at the breadth today, because that's the other thing that really stood out. With 2%, 2.5% lower, the breadth, while it improved towards the fag end, maybe in the last hour or so, continues to remain very, very weak. 6:1 in favor of the declines, and that's been largely the trend through 2025 calendar year, and that's playing out this week as well as today. Last off, I want to look at sectors today, because we've seen IT and auto under strong pressure. And no surprise there, 4.2% down on the Nifty IT, 3.7% on the Nifty Auto. But some other sectors I want to quickly mark out. 2.5% on the Nifty FMCG, so consumption taking a bit of a knock. You're seeing 2.8% on the Nifty PSU Bank. So while the Nifty Bank outperformed the index, you saw Nifty PSU Bank do negative 2.8. So clear pressure on that count. And among other indices, the Nifty Infra in the broader markets and the Nifty Pharma 2% lower as well. But broadly, that's how it played out. The Nifty Private Bank did relatively okay, along with the Nifty Metal and the Nifty Realty, which seemed to outperform the Nifty 50 index. So tough, but not as tough in some of those pockets. Last off, the BSE 500 top gainers, top losers. Want to quickly mark out some individual names. Those are some stocks ought to be on your radar. Granules, Reddington, also among some newsmakers. Sensar Tech was also one of the newsmakers today. And Jubilant Food, of course, closes 7% lower in trade today. But on the positive side as well, you'll see a JB Chem, a Home First. We saw some spikes in some of those counters, which did fairly well for themselves. But with that, completely out of time on this edition of India Market Close. From Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Powered by Canara Bank. Together we can. And National Insurance Company Limited. Trusted since 1906.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी. हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं.
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है.
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए.
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight into the show. Viewer, sell-off intensifies in the market. Nifty closed the last trading session with cuts of over 400 points, down 1.8%. This was recorded as Nifty records longest monthly losing streak in 28 years. This is the 5th consecutive month of the losses in a row. All sectoral indices record losses in February. Realty, IT fall the most. Nifty Realty records worst month since March 2020, whereas Nifty IT records worst month since 35 months. For the FMCG, February was the worst month, records worst decline since October 2008. It's been a painful start to the March FNO series. The rout intensifies after US President Donald Trump's tariffs on Canada and Mexico kick in from March 4. Reciprocal tariffs on most countries will come into force from April 2nd. The Indian market is weighing tariff cuts on EVs, luxury goods, and as a reaction to this, Canada PM Justin Trudeau says that the country will have an immediate and extremely strong response. Additionally, the European Union threatens to impose tariffs on US goods if Trump imposes new tariffs. A global trade war simmering has sent shockwaves across the equity markets of the world. Donald Trump announces plans to double the universal tariff on Chinese imports to 20%. In a Truth Social post, Trump cites the smuggling of illicit drugs like fentanyl into the US as a key reason for the move. He argued that import taxes would pressure other countries to curb drug trafficking. IT sector shatters April 2022 records, cracking over 4%. Investor wealth worth 1.4 lakh crore wiped out from the Nifty IT index. The index is breaking on the back of a couple of reasons. Factors like high US consumer inflation expectation would mean delayed rate cuts. Additionally, discretionary demand revival may be pushed away. Capgemini CY25 guidance implies more uncertainty. Nvidia's earnings disappoint as well. Life insurance companies in India have demonstrated resilience and compounded at a healthy rate over the past 5 years, weathering multiple challenges, ranging from regulatory changes to the impact of COVID-19. Despite these headwinds, the sector has continued to exhibit robust performance, with several private insurance delivering a compounded value of new business growth of 15% or more annually. Indian life insurers have seen derating owing to multiple reasons. Investec prefers Max Financial and HDFC Life. On the other hand, Investec upgrades ICICI Prudent Pru Life to buy on valuation comfort. Despite a fall in the market, here are a list of cooling stocks and that investors must keep an eye on. Going into the summer season, from the beverage pack, Varun Beverages, United Breweries and Tata Consumers, juice makers, Dabur and ITC will be in focus as well. And one must never forget that when summer beckons, ice cream stocks, Vadilan Industries and Hudson Agro gain the most. UBS has come out with a note on oil marketing companies. Says crude in the mid-$70 range indicates healthy integrated margins. High crude premiums coupled with narrow light heavy spreads to impact profitability. UBS says LPG under recovery continues. HPCL most levered to potential government grant. Jefferies says the supply catch-up will support volumes for the real estate sector. With elections in base, Jefferies expects rising supply in 2025. Recent promoter buying from the open market signals confidence in underlying business. In this regard, Jefferies prefers DLF, Godrej Properties and Macrotech. Jefferies maintains buy rating on Apollo Hospital with a target price of 7,900. Jefferies says that sustainability of 5 to 7% average revenue per occupied bed growth for company is a key debate. Bed additions for organized players are around 2% of their existing capacity. The additions will only be in a phased manner over 3 to 5 years. Indigo soars on the back of a strong January 2025 air traffic data. The company reports around 65% domestic market share and passenger load factor close to 90%. Brokerage firm Axis Capital upgrades the stock to buy from add. Additionally, it hikes targets to 5,450 rupees from 5,100 rupees. Axis Cap says that Indigo is the best play on rising discretionary consumption. Cites Indigo's focus on gaining international market share while domestic share stays intact. Coal India announces price hike of 300 rupees per ton with effect from May 2025. Coal India's price hike was implemented on entire volume from subsidiary NCL. The last price hike under FSA took place in January 2018 for lower grade coal. Analysts believe that above price hike should offset lower coal volume. Angel One share price fell to its lowest level in over 6 months. The company informs about data leakages. The broker was alerted by its dark web monitoring partner about the unauthorized access to clients' data yesterday. After analyzing Angel, doubt that some of the Angel One's AWS resources were compromised. Angel One told exchanges that it took immediate action and changed all credentials of the AWS cloud service and other applications. The brokerage has consulted external forensic partner to investigate and validate the impact of the incident and analyze the root cause of the breach. US FDA issues warning letter to Granules Gagillapur facility. The warning letter follows a December official action indicated status. The warning letter may delay approximately 10 pending approvals. Newer filings are being done from Vizag and Granules Live facility. Shares of Transrail lighting and engineering procurement and construction players surges nearly 5%. This after the company announced securing of new orders worth 2,752 crore rupees, primarily from the transmission and distribution segment. Year-on-year, order inflows crossed 7,400 crore rupees with a growth of 90%. The company has an unexecuted order book of 11,499 crore rupees as on December 24. Another stock buzzing on the back of order win is Kernex Micro. The company has been awarded projects by Southeastern Railways. Project is to install Kavach on 688 route kilometers. The project covers the sections of the Kharagpur and Chakradharpur and will be completed within 1,000 days. Rail Vikas Nigam receives letter of acceptance from Central Railway. The contract is valued at 136 crore rupees. The order is to build a new power station on Bhusawal and Khandwa line. The current win includes designing, supplying and setting up all the equipment. PSB Projects is trading lower today. This despite work order worth 647 crore rupees from Adani Airport Holdings. Additionally, the company will construct Adani